Taman Capital and RBL Bank. Two stocks that might be in focus, Vodafone Idea. Yesterday also, the stock had gained as much as 7%, and ahead of 26th of September, when Supreme Court hears AGR plea, the stock will remain in the focus. And one stock that continues to see a move higher, Axis Bank, for the last 7 or 8 trading sessions, it has been moving higher, and yesterday also, it has seen short covering.
Okay, so Darshan, thank you so much for the update in the world of F&O. But on that note, we're going to actually step into a very short break. After the break, we'll get to the latest cues from Wall Street on the other side. Welcome back to Power Breakfast on CNBC TV18. Now, US President Donald Trump at the United Nations General Assembly met last evening and accused China and India of funding Russia's ongoing war in Ukraine. He even called out NATO countries purchasing Russian energy. Listen in.
China and India are the primary funders of the ongoing war by continuing to purchase Russian oil. But inexcusably, even NATO countries have not cut off much Russian energy and Russian energy products, which, as you know, I found out about 2 weeks ago, and I wasn't happy. Think of it. They're funding the war against themselves. Who the hell ever heard of that one?
And in the US markets, Wall Street ended lower, with S&P 500 now falling from its record highs and snapping its 3-day gaining streak. We have CNBC's Kate Rogers, who's getting us a wrap on all the action that happened on Wall Street.
Markets were lower across the major averages Tuesday amid new doubts about the sustainability of the AI boom and fresh comments from Fed Chair Jerome Powell. The Dow sliding 89, the S&P 500 snapping a 3-day winning streak down 37, the tech-heavy Nasdaq falling 216. Tech stocks led the major indices lower on Tuesday after Powell suggested that asset prices are at elevated levels, although he also noted that he does not think financial stability is at risk. Speaking to business leaders in Rhode Island, Powell said that weakness in the labor market is outweighing concerns about high inflation as the Fed tries to balance its dual mandate to sustain stable prices and low unemployment. Powell also left the door open for further rate cuts this year if the Open Market Committee deems them necessary. And Amazon and the FTC finally went to court over a long-awaited trial over whether the company tricked millions of consumers into enrolling in its Prime membership program without their consent. The civil suit, which was filed by the Biden administration in 2023, also targets 3 Amazon executives, accuses the e-commerce giant of making it intentionally difficult for users to cancel Prime. Amazon has denied any wrongdoing, arguing that the terms of the Prime membership are clearly disclosed and there are several ways to cancel. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But Federal Reserve Chair Jerome Powell noted that asset prices are at elevated levels. During a speech, the central bank chair was asked how much emphasis the Fed places on market prices and whether they have higher tolerance for higher values. He said, and I quote, "We do not look at overall financial conditions and we ask ourselves whether our policies are affecting financial conditions in a way that we are trying to achieve. But you're right, many measures, for example, equity prices, are fairly highly valued." End of quote. Now, former Dallas Fed President Richard Fisher believes that the comments from Jerome Powell were not controversial at all. Listen in.
These are very strong valuations. And as we all know, Carl, a lot of it's concentrated in a very few number of companies. But I think he just made an objective statement. I can't find anybody that doesn't feel things are at least richly priced, if not overpriced. So I don't see any controversy in that statement whatsoever.
And meanwhile, James Bullard, among the next Fed chair candidate, believes that the rate cuts signaled for this year are already priced in. While Michael Wilson, Morgan Stanley's chief U.S. equity strategist, believes that market is at risk amid concerns of Fed being behind the curve. Listen in.
I think it was right there. You know, it wasn't just 25 basis points. They put October in play and December. So if they follow through with that through the end of the year, that'll be 75 basis points. Most of that's priced in already today, so it's sort of as if they moved already. But it also gives them some optionality to watch the inflation numbers and the jobs numbers as they come in through the rest of the year. And they could pull back if they had to, or delay a little bit if they had to. So, you know, in the way that the committee works, this is kind of a natural decision to make for this situation.
Well, we do need to cut because in order to get a full recovery, right, the rolling recovery now, we need rates lower. One of the reasons why we've had a tepid, kind of economy in the private sector is because rates are too high for most businesses, particularly small businesses and consumers. So they do need to cut rates. The question is, how much are they going to cut? And that's why we haven't seen the full rotation yet to the early cycle, small cap, low quality parts of the market. Okay, so I believe that last week was sort of a sell the news event because the Fed is sort of dragging its feet. They cut 25 and the market really wants or expects, or is priced for, more importantly, for something more aggressive. So we have this window now for probably the next 6 weeks or so where we think the market is at risk of this tension between the Fed being kind of behind its own curve and the bond market, and the equity markets really wanting or needing now a more aggressive Fed path.
Okay, on that note, we're going to slip into a very short break. After the break, we'll get you what's happening in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC TV18. Now it's time to get the update coming in the world of commodities. And we'll be putting the spotlight today on crude and gold, right, Manisha? Good morning.
Morning. Well, yes, I am. If you look at the crude oil prices, we've seen some gains come back. Crude is up 1.5% overnight. The support comes in from the fact that the U.S. crude inventories have declined 3.8 million barrels, which is the biggest drop in 7 weeks. Also, the talks to restart oil exports from Iraq seems to be stalling, and that has been supportive. And then you have NATO pledging robust response to the Russian airspace incursion. So there could be some disruption coming in from there. So you have various factors turning around overnight, which seem to be supporting the crude oil prices. I also want to talk about gold because we finally are looking at some profit taking, even if it's for a day, coming in for gold. When you look at the all-time highs, it's at 3791. We did not touch 3800 yesterday, but the markets do believe that that is a possibility happening in this month itself. But with the kind of run-up after that we have seen, gold and silver both have started slightly on a weaker note today, some profit taking, some consolidation coming in. What has run up, though, has been the platinum prices. They surged by 5% in the overnight markets.
Okay, Manisha, thank you so much for that. Some profit taking in gold is what we're seeing, as well as crude also opening on a bit of a muted note. But on that note, we're going to wrap up this edition of Power Breakfast. We're going to be leaving you with visuals of the French President Emmanuel Macron making a phone call to Donald Trump after his journey to the French embassy was blocked by the police officers preparing for the motorcade of the US president. Macron, outside his vehicle, was speaking with a New York police officer, asking to negotiate with him.
Guess what? I'm waiting in the street because everything is frozen for you.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning, hello and welcome. You're with us on Bazaar Morning Call. As always, we're coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me, Prashant and Nigel. And guys, before we talk markets today, there was so much drama. When has an address at the UN General Assembly been as long? And from I was a realtor, I could have renovated this building, to faulty teleprompters, to escalators not working. It was all happening yesterday in New York.
Absolutely. I mean, you said it right. I mean, what does this remind you of? Escalator suddenly stopping. Huh?
I don't know, Nigel. What have you been doing on escalators?
I was just thinking, when earlier, if you were playing really loud music on a terrace party and if the cops or someone was down, what do? You just leave the last floor lift open, so they have to walk up and they take longer to get you.
There you go. So.
But that's on a lighter note, but yeah.
That's amazing.
Well, I think iconic... iconic or you want to call it, but of course, I mean, very, very combative speech in terms of what he said at the UN as well.
And the relevance of the UN, right? He kept challenging the relevance of the UN, saying, you guys have not stopped any wars.
But that's the thing about it. I was thinking about this, right? At the memorial service for Charlie Kirk in the US, President Trump, when he made that speech, always in character.
Yeah.
I mean, doesn't, no matter what the occasion, always kind of sort of hammering on the points that he wants to make.
That's true.
It doesn't matter where he's speaking. So let's just sort of take it from the top in that sense, right? And so this is what you got. US equities, which ended lower. S&P was down 0.5%. The Nasdaq ending about 1% lower. So there's a little bit of a pullback which we've seen last night. Fed Chairman Jerome Powell essentially saying that policymakers face a challenging situation in balancing risks to inflation and the labor market. Remember, he spoke last week extensively, interacted with reporters, etc. There was a 25 basis point cut. There's been a fair bit of debate whether this is a one-off and this is the start of an easing cycle. There was only one voting member who voted for a 50 basis point cut. That was Stephen Miran, who's Trump's man, who's recently come on the FOMC. But otherwise, and we kind of sort of put out, a lot of people spoke yesterday as well, all of them cautious, and I think this kind of sort of adds to it. Powell warned two-sided risks mean that there is no risk-free path to cutting rates. Basically, you cut rates, economy can overheat, asset prices are at an all-time high across the board, and I think these are concerns which are well understood by the market, but of course, this is coming from the Fed chair. 10-year yield, I mean, it's actually gone up a little bit, down about 4 basis points last night, so 4.1. Trump, and at that UN speech, essentially calling for Western allies to limit their intake of Moscow's Russian oil prices on fears that maybe, there will be a hit to supplies as we go forward, about 2% higher, Brent oil at about $68 a barrel, where we ended. He, of course, also blasted European countries, the United Nations in general over immigration, climate, and of course, I mean, said the climate and the climate change is a hoax, as he said many times before. So a pretty combative speech overall. And I think no softening of stance. If you thought with, 2-3 quarters into this presidency, President Trump in a gathering like that perhaps will tone down in terms of his stance, his approach, absolutely none. Now, I just come to India here, right? I mean, yesterday there was the market, which didn't do very much, at least as far as equities are concerned. So it started with last Friday. The pause started last Friday. Monday was a pause again. So cumulatively, we pulled back about 250, 275 points. And yesterday was a pause. So that's the index. But the rupee, it basically blasted higher. Dollar rupee blasted higher. Rupee was lower. So, almost went to about 89 in a single session. So that's the close, 0.5%. I think we'll track this closely today as well. The issues are the same. I mean, it was, of course, the trade issues with the US, but over the weekend, there was, of course, also the H-1B issue. And it's not very clear that whether this is like just a negotiating tactic or this is the opening salvo and opening up an entire new area, which is services, in an issue which has so far been limited to be dealt with goods. So, and I think there are serious concerns in that sense. So we'll see. You want to take the positive side of it. I mean, you can say, well, the rupee is down, what, 5%, 6% this year? And for fresh and positioning is very low in India. So foreign investors who come in now, you basically are getting a 5% discount. You're getting a 5% advantage for fresh money, which starts to come in now. So that's the other way to look at things. But we'll see. It's chicken and egg. I mean, most other markets around the region in Asia are getting foreign portfolio flows into equities. India is not, and I think that's the other reason why you've got the rupee weakness, which has been more pronounced. We'll talk more about this as we kind of go forward. I'll just close out with the levels here. So the Nifty held the 38% retracement level on a closing basis at least. We need to close above the 20-hourly average. By the way, the 20-hourly is above the 40-hourly exponential average. And that level is 25,247. We need a closing above it to say that, well, this recent pause is over, and maybe we kind of sort of continue the near-term to slightly medium-term trend, which has been, of course, this pullback from the lows of 24,400. Support is yesterday's low, 25,084. Is that number. Nifty Bank closed in the positive region yesterday, positive territory yesterday. Resistance here, 55,835 and 56,156, very, very near-term levels. And of course, for the support for the Nifty Bank, that stands at 55,159, which is the low. So those are levels. GIFT Nifty will give you a quick sense of how we're likely to start. We'll pick it up from there. 60 points lower once again. What are the F&O stats looking like? Nigel has walked across with exactly that. Nigel, good morning.
Well, morning, Prashant. One of the factors that have been plaguing the markets in the last couple of trading sessions is institutions have turned net sellers. So if you look at the FI net sell number, that's overpowering what the DIs are putting in. So institutions, they mildly net sellers close on 8 to around 900 crores or thereabouts. Moving to what the FIs did in the future space, not too much. 1,000 contracts were added on the long side, 1,000 contracts were covered on the short side. They still continue to remain net short with 86% of their positions on the short side. And in absolute terms, it's around 1.4 lakh contracts on the short side. What about the FI action in stock futures? Well, the previous trading session, they added quite a few shorts. In yesterday's trading session, in fact, they added more longs than shorts. In fact, they added 2 longs for every 1 short position. Some part of that as well could be an arbitrage that's taking place out there. So that's about the FI action. Moving to the options data, remember yesterday you have the weekly expiry that played out as well. So that added an element of volatility, particularly in the second half of trade. We were down 100 points and then we recovered considerably as well and ended mildly in the red. So the two strikes, the bulls and the bears will feel that they have an equal say in the range for the market, because the 25,300 call, 17 lakh shares getting added there. 25,200 put as well, 17 lakh shares getting added out there. And the premiums in the vicinity of around 100 rupees or thereabouts. So it appears in the near term, we're in this range that we're looking at. So on the downside, yesterday's low, which is at around 25,085 and 25,050. That's the important mark you want to, don't want this to break on the downside. While resistance, the recent highs at around 25,331. And going by the options data, that's the mark that you're looking at in terms of a resistance mark. So for the time being, we're in a bit of a range as we speak. The Nifty Bank, that's been holding one end up. Even in yesterday's trading session, it did well. Good recovery is what we saw from the lows of the day, and it ended at around the 50 DMA. So that's the important mark you're looking at in terms of the Nifty Bank. It needs to continue its good form and lead the way from here on. Besides the index, we could see some bit of consolidation. What I would like to see is the breadth of the market improving, because the number of stocks advancing yesterday were way more than the number of stocks declining. So today, even if the index does see some sort of a consolidation, though I think that if it's a 70-80 point downtick, at some point of time, we could see a good recovery intraday on the Nifty. But the breadth of the market as well should improve. That's what makes portfolios feel quite good. And just one stock, yesterday, GMDC, the stock did see a big move in trade. The volumes are very, very massive. But in terms of delivery percentage, it was less than 10%. So just keep an eye out on this name. Sometimes you see these moves on the street starts factoring in opportunities they believe for the next 4 to 5 years. But in the near term, it'll be interesting to see what comes out of it. Delivery relatively lower in comparison to what we have seen. So keep an eye out on this one.
Okay, all right. So those are the top cues from the F&O space as well. Markets across Asia, by the way, they are a little mixed, because markets are, passing over the comments that the Fed chair made yesterday with respect to asset prices, where he was responding to a question and he went on to say that, yes, at least in the US, and I'm quoting exactly, he says that equity prices are fairly highly valued. And he was responding to a query whether the Fed is looking at the way stock prices have run up, and that was the context. So anyway, we've got a mixed picture across Asia. Japan is seeing some profit-taking. Markets like Taiwan, Hong Kong, they're still on the higher side. Taiwan's actually, slipped now, but the Hang Seng is still holding on to some gains. Let's just pull up the GIFT Nifty and the implied open. So after taking a bit of a pause over the last 2 days, we're bracing for another 60-70 point start on the downside. With that, let's get to quickly the equity call of the morning. Herald van der Lind of HSBC says that Asian markets are up an average of 20% in 2025 so far, despite strong selling by foreign funds. He says this is due to the support from domestic retail investors, especially those in mainland China, sitting on piles of cash. He says India now appears attractive on a regional basis, and they move to an overweight stance from neutral. So HSBC turning positive on India. Well, Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us. Mark, great to have you with us this morning. Thanks for joining in. So the US president seems to be feeling that, not the US president, beg your pardon, the Fed chair seems to be feeling that equity prices are a little overvalued in the US, but that's where the money has been going. And of course, some of the regional markets here as well, whether it's Taiwan or Korea. Do you see any signs of a shift in fund flows towards Asian equities?
Good morning. Yes, we've seen year to date an allocation of flows towards Asian equity markets, albeit driven by selective stories, whether it's Korea as a result of the clearing up of the political uncertainty, Taiwan as a result of its leverage to the semiconductor and AI themes, or as a result of Hong Kong, China at the start of the year as a result of discounted valuation. So it's more driven by bottom-up stories. But in aggregate, yes, there's been an increased allocation of flows into Asian equity markets over the last 6 to 9 months.
All right. Hi, Mark. Good to see you, Win. What about India? You heard the call that Surbhi just made with regard to HSBC. They have gone ahead and they believe that India is now all set to catch up, and that's why they've changed their stance. What about you? A market that's underperformed in the last 12 months or so is India. In the longer duration, well, we have compounded at a very, very good rate. But do you think it's time now for Indian markets to catch up, given the kind of measures you've seen both on the fiscal as well as on the monetary front?
Yeah, if you look at India, it's really kind of gone through a time correction over the last 6 to 12 months. It's effectively gone sideways, trading within a range. And by extension, it's underperformed other markets as well. This is really symptomatic of a situation where 12 months ago, Indian valuation multiples looked somewhat extended. The growth story was intact. And what we're seeing now is sort of a digestion of those strong gains over the previous years and a rotation of ownership in the market. So eventually, whilst the long-term growth story remains intact, that time correction will eventually give way towards a renewed pulse to the upside. But in the short term, I think we see an absence of immediate catalysts for the Indian equity market. And so we remain neutral at Manulife for the time being.
What about gold, Mark? We had briefly spoken about that. You said that you're continuing to remain positive the last time we chatted. That's just going from strength to strength. Now, there's two views out there. One is that there's a bit of a bubble forming in gold. There was a call even at around $3,000. Now it's around $3,800. And the other view is that, no, you rather allocate money to gold if you're looking at safe investments rather than putting in some of these bonds globally. Your view on gold from here on?
We remain structurally positive on gold. What you're seeing is a reappraisal of gold in terms of its place in portfolios, not just for retail investors, but critically also institutional investors and asset owners in the case of central banks. If you look at median weightings towards gold in portfolios, it still remains in the very low single digits percentage-wise for those types of investors. So we definitely see continued progression to the upside in terms of increased allocation. And then behaviorally, there's been a shift as well, as I mentioned, with central banks. They're increasingly looking to gold as a diversifying source and holding of US dollar denominated reserves away from nominal treasury bonds. And I think that's also a reaction not just to the geopolitical and the inflationary backdrop, it's also a reaction to this paradigm shift in government's attitudes towards running fiscal deficits. In the case of the US, it's now bipartisan assumption that you can run widening fiscal deficits on a pro-cyclical basis. And gold is seen as effectively a haven against excessive quantitative and fiscal stimulus into the economy, because it gives you a store of wealth in a situation where the monetary base becomes somewhat pressurized by this ongoing acceleration of money supply and fiscal deficits without consequence.
Absolutely, and that explains why there are a lot of calls for northwards of $4,000 on gold as well, perhaps exactly for the reasons that you mentioned. Mark, very quickly, before we wrap up, that neutral call on India that you just alluded to, Just tell us a few factors. I mean, why is it that you're not getting incrementally more positive in the market here? We've had the GST cuts, the income tax cuts, so on and so forth. But what makes you still keep a slightly more cautious or conservative stance in India?
Yeah, our tactical views at Manulife are predicated on an assessment of 4 different pillars. So macroeconomic, sentiment, fundamental, technical. Just very briefly, on the macroeconomic side, relatively mixed economic data in terms of the progression to the upside or to the downside. In terms of sentiment, you rightly pointed out on your show earlier that foreign institutional investors' sentiment towards India is somewhat dampened. And then from a fundamental perspective, earnings revisions and valuation multiples very much in the middle of the pack at the moment. And then finally, from a technical perspective, as I mentioned, we've kind of been going through a time correction here. The market's been range bound. What we'd want to see is upwards pressure breaking to the upside of that range with increased volume. And that's not there at the moment. So across those 4 pillars, our conclusion is for the time being, India remains neutral.
Middle of the pack, as you're calling it. Got it. Thank you very much. Good to have that context. Thanks for joining in this morning, Mark.
All right. That's an interesting chat. As always, let me just quickly now run you through what's lined up here over the next 2.5 hours or so. So lots of interactions coming up. 8:35, you'll hear from the management of the Lodha Group to discuss the company's FY26 outlook. So Sushil Modi, Director of Finance of the company, will be with us. 9 o'clock, Nikhil Negani of Bernstein for a discussion of the power sector stocks. 9:20, Gautam Shah, founder Goldilocks Global Research, with our market match of the day. We talk about levels. 9:35, exclusive chat with India's Steel Secretary, Sandeep Poundrik. Following that, we'll have a new IPO, Jain Resource Recycling, 1250-odd crore IPO. Opens for subscription today, and it's the economy with Lata discussing the impact of H-1B visa fee hike and the fallen rupee with Samiran Chakrabarti of Citi, Chandresh Jain of BNP Paribas.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment, but we're looking at Swiggy, Infosys, HCL Tech, SBI Cards, NDR Invit Trust, Dilip Bilcon, Bajaj Electricals, Minda Corp, and VIP Industries. So 9 stocks reacting to positive news flow, while AkzoNobel will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. We've got the markets in focus for you with, of course, our top 10 list of stocks. As always, our research team is standing by with what you need to know in terms of single stocks and prominent, significant news flow. Guys, good morning. Vinny, let's start with you. Swiggy in focus, something we've spoken about in the past, but I think the news on Rapido finally out.
Absolutely. The news of Rapido stake sale is finally out. Now, let me take you through the details first. Now, Swiggy will be divesting around 12% stake in Rapido. This is going to be in two parts. One is an approved sale of 10 equity shares as well as 1,63,990 Series D CCPSs, which is going to be sold to Porus's company, that is MIH Investments. That is going to be for 1,968 crore rupees. The other is also going to be a sale of around 36,000 Series D CCPSs, and this is going to be to Westbridge, one of the companies of Westbridge. So that is going to be for 430 crore rupees. So overall, this divestment, like we said before, is something that is already spoken about in Q1 FY26 that highlighted that they will be divesting the stake. Important is the cash on books. As on 30th of June, the cash on books was around 5,300 crores. Now, with this stake sale of 12%, that is going to be of around 2,400 crore rupees. So overall cash on books is going to be 7,750 crores at the end of Q2 for the company. Now, what will this mean? More cash on the books means the cash burn rate at which they were going in Q1 was around 1,300 crores. JP Morgan is saying with this cash on books, they can survive for more than 6 quarters, and obviously the cash burn will be reducing further. So obviously in terms of improvement, we could see coming in overall for the performance of Swiggy, and valuations are still very cheap versus Zomato. So that is something we'll watch out for, but green is what we are seeing today for this score.
Got it. Thanks a lot for that, Vinny. Well, let's hop across to Rima. Tech has got knocked back in the last couple of days, but Rima's going with green on Infosys and HCL Tech. Rima, tell us more.
Well, I'm not sure how the stocks will move, but let me first run you through the news on Infi and HCL Tech. So Infosys announced the expansion of a long-term collaboration with a Swiss telecom company, and HCL Tech too has renewed and expanded its transformation agreement with a Swedish commercial vehicle manufacturer. Size of both the deals is not known, but these are existing clients. The scope of their partnership has been expanded. But secondly, why I'm watching, IT with suspicion today is because the Trump administration has proposed changing the H-1B visa selection process. This is not a proclamation. It's a proposal that the Trump administration. So earlier H-1B visa selection was done by, it was random. It was lottery mechanism. Now what he's saying is that if the demand exceeds the cap of 85,000, which every year it does, then we need to move towards a weighted average system, basically give a higher weightage to higher cost employees. People coming on higher wages. So on the whole, what this will do is increase the cost of sending people on H-1B visas, because only if you're going to send them on a higher H-1B wage, only then will you get approved. So this is a proposal right now, but I think considering that, Trump was, trying to, plug the gap, and, this whole H-1B visa, increasing the visa cost to 100,000, I think this will be an additional blow that Indian IT may have to deal with. It's a proposal as of now, open for discussions, 30 days public comments. Let's see how it goes.
Okay, all right. So no good news on the H-1B visa front, at least, including from this proposal. Rima, thank you for that. Let's move on to Gaurav. He's looking at SBI Card today. SBI Card, I think the latest spending numbers are in. Gaurav, how do they look?
Well, yes, for the month of August, it actually looks good for SBI Card. So let me take you to the numbers. At system level, the spendings increased almost by 14%. But for SBI Cards, this system, the spendings that increased almost by 25%. So SBI Cards were ahead of the curve. As a result, the market share, they have gained 50 basis point market share. If we compare it with its peers, we have HDFC Bank, who gained around 43 basis point of market share, and IndusInd Bank, who gained around 30 basis point of market share. So definitely, SBI Cards is leading here. When it comes to new card addition, at a system level, around 7 lakh cards were added during the month of August, while for SBI Cards, around 70,000 cards were added. When we talk about total cards in force, at system level, we saw the growth was at around 6%, and here also we saw SBI Cards actually growing higher than the system at around 10%. So definitely the numbers look good. In fact, Morgan Stanley says that this could be because of the corporate spending. We saw in the last year that declined, but because of the regulatory changes, but in this month, they are expecting this to increase. So definitely in terms of number, we are looking at a good set of numbers for the month of August for SBI Cards.
Okay, all right. Thanks a lot for that, Gaurav. Going to Vivek then. He's tracking a large trade as well as some big action that we saw in yesterday's trade. Morning, Vivek.
Well, good morning. That's right. So first, let's have a look at the likely block deal that's expected to happen in today's trading session. We accessed the term sheet last evening, and this is on AkzoNobel India. Now, just ahead of the acquisition of AkzoNobel India by JSW Paints, one of the promoter entities, Imperial Chemical Industries, looking to sell up to 5% stake in the company. The total size of this particular offer is at a little over 740 crore, and this particular floor price is at a 4% discount to yesterday's close at 3,260 rupees per share. Now, there is a lockup of 30 days on the residual stake by seller. And remember, this particular entity, Imperial Chemical Industries, held a little over 50% stake at the end of Q1. Expect some pressure in AkzoNobel in trade today. The other stock that we mentioned is the NDR Invit Trust. It's an investment trust, so it's a unit that actually was purchased. Radhakishan Damani, as per the disclosure last evening, bought 87 lakh shares in this particular entity at rupees 115 rupees per unit, and along with that, Aryaman Junjunwala Discretionary Trust bought 58 lakh shares at 115 rupees per unit.
Okay, all right, got that, Vivek. Thanks very much. Let's quickly move on to Sudarshan. Sudarshan's watching out for, I think, Minda Corp and VIP Industries, where there seems to be a little bit of a management change. Go ahead, Sudarshan, tell us more.
So starting with Minda Corporation, it has released Vision 2030 documents in which it has given the targets on the important metrics of first talking about the revenue. It expects an increase of nearly 4 times to rupees 17,500 crore from the current level of rupees 5,100 crore. On margin front, it expects an increase of almost 100 basis points to 12.5% from 11.4%. Net debt to equity ratio, it believes that it's likely to decline to 0.3 times from 0.6 times. And on ROCE front, it's likely to exceed 25% from 20%. Now, talking about the sectoral, it will focus on passenger vehicle, in which it believes that its contribution is expected to rise to 25% from 14%. At the same time, it will reduce the contributions from two-wheelers, three-wheelers and commercial vehicle. Talking about the VIP industry, recently you know that multiples had acquired majority stake in the company, and because of that, company has announced of the changes. It has appointed new managing director, and the name is Atul Jain. He will replace Neetu Kashirmaka, and Atul Jain was previously associated with Samsung Electronics, where he was heading consumer electronics, and also he had held certain positions in Coca-Cola, Godfrey Phillips India, as well as Bharti Airtel. And also, as per agreement, Multiples Group have right to nominate majority of the directors, and it has appointed Renuka Ramnath as non-executive chairman, and Dilip Piramal has resigned as chairman.
All right, so thank you very much for that. So VIP, keep an eye out on that one. Dilip Bilkon, Bajaj Electrical. So the next we want to focus on. Upasana is here with details on these. So Upasana, morning.
Good morning. First up, let me start with Dilip Bitcoin. Now, the company through its JV, that is DBL PSP, has declared as L1 bidder for a project worth nearly about 1,115 crore in the state of Kerala. And the time period for this is nearly about 48 months is what the company has indicated. Next up is Bajaj Electrical. The company has approved acquisition with Morphy Richards, which is for the brand and intellectual property rights in India and neighboring region, from Glen Electric for a consideration of nearly about 146 crores. Hence, this stock will also remain on our radar today. Now, the company has been manufacturing and marketing Morphy Richards products in India since April 2002, and this strategic move is expected to strengthen its position in home appliances and even consumer electrical portfolio. So this certainly bodes well for the company.
Okay, all right. Thanks a lot for that, Upasana. Well, let's do a quick recap of all the top stocks we highlighted for you. Swiggy, Infosys, HCL Tech, SBI Card, NDR Invit Trust, Dilip Bilkon, Bajaj Electricals, Minda Corp and VIP Industries. Well, AkzoNobel is the stock that we will be tracking on the negative side. Well, that's about the top stocks we're looking at. But Sudarshan, well, he joins us for more. He has gone through a lot of brokerage reports this morning, joining in to give us a sneak peek. Sud, morning.
Morning, Nigel. So first one is Maruti Suzuki. Goldman Sachs has updated the stock to buy and increase the target price to rupees 18,900 per share. It is given the reasons because of which it has upgraded the stock. And first one is potential pickup in the entry-level segment. Second, company has resumed new launches after a gap of almost 3 years with Victoris SUV and e-Vitara, and also the favorable exposure to pay commission in upcoming auto demand cycle. And on the risk front, also it believes that against peers, it is less exposed to those risks. And because of all these factors, it expects 5%, 12%, 9% volume growth in FY26, 27, 28 respectively, versus industry's growth estimate of 4%, 8%, 9%. And also it has increased EPS estimate for FY26, 28 by up to 12%. Second is CESC. Nuvama has upgraded the stock to buy, and here target price is rupees 200 per share. It believes that renewable energy growth has solidified and company aims to double profit to rupees 2,800 crore over FY25-2030. Remember, company in the interview with CNBC TV18 also had talked about the same. And it looking to increase renewable energy addition by 1.2, 3.2 gigawatt by FY27-29 and has a target of 10 gigawatt by FY32. And new solar manufacturing initiative that company is looking to take by FY28. And considering all these factors, it also believes that valuations for this stock are looking very cheap at current levels.
Okay, all right, Sudarshan, got it. Thank you very much. So we're going to keep all of those stocks on our radar, as well as the brokerage comments that have come in today. Let's take a quick break on that note. We'll come back on the other side, discuss some of these interesting stocks and more fundamental stock ideas with Deven Choksi of DR Choksi FinServ. Also in a bit, we'll have the management of Lodha to join in to talk about the company's FY26 outlook. Welcome back. Before we get to some stock ideas for the day, let's quickly get to a corporate conversation. Now, we have Lodha developers in focus. There have been several news points. One of them, of course, was the recently signed MOU with the Maharashtra government. This was for setting up data centers. It was a massive MOU, actually, 30,000 crore rupees for integrated data centers that they're planning to set up in Palava, which is just outside of Mumbai. But the more recent news development is this news of quote unquote fraud, and that's what the company itself is also calling it. And I want to actually start with that. This is one of the company's directors, Rajendra Lodha, which is, I think, a distant cousin of the promoter family. He has now resigned, and apparently there's 100 crore rupee fraud that has been unearthed by the company, and investigations are underway. So let's just understand this in more detail. Sushil Modi, Director of Finance at the Lodha Group, is with us. Mr. Modi, thank you for joining in. Let's actually start with that clarification. How have you arrived at this 100 crore rupee figure? And how are you confident that the wrongdoing is limited to just 100 crores?
Morning, Survi. It's very unfortunate, the context that we are discussing. This is not something that we ever think of, getting into and talking about, because at the first place, we never even imagined that this is something that can happen in the company. So we are absolutely shocked and saddened and disheartened, to say the least, that this has happened, and that too it has happened at from the person at a seniority of an executive director, which is even the least that one can expect. So it's a issue that that has transpired in the course of normal corporate checks and balances, where a director typically gives all his interest in various entities from a regulatory standpoint, and which is what, when we examine in the normal course for all the directors to make sure that the governance is of the highest standard, we realize that some of the entities, perhaps the names are missing in the declaration that has been given, and which is what made us to kind of seek greater information that why some of the informations are missing. And we got further shocked when we then being told that, this is it that is there. I am not giving any more information.
Sure. So, Mr. Modi, so let's take it step by step, because shareholders will need clarity, right? Let's go step by step. So this individual, Mr. Rajendra Lodha, he was not identified as part of the promoter group in the shareholding. I mean, was he? But I think he was a KMP, a key management personnel.
He was the KMP.
Yeah.
Any director of the company is a KMP by default.
Yeah.
Under the law. So, and which is what makes it even perplexing, right, and shocking for us, that generally any transaction in the company, any business that you do, if somebody is supervising or executing and controlling at the helm as much as director, generally those transactions are being considered with all the internal controls being in place to be the rightful transactions.
So, sir, how has this happened? Now, let's talk about the numbers. They're really important. I think the company said that the extent of the fraud, and you are calling it a fraud, right? The extent of the fraud is 100 crores. How have you arrived at that figure? And are you confident that it's only 100 crores? Or will you have to go for a wider, maybe even a forensic audit of some sorts?
No, you are absolutely right. Obviously, our initial preliminary observation basis the preliminary inquiry and the checks and balances that we did indicated immediate certain amount of wrongdoings, and which is what has got quantified to this number of 85 odd crore, for which we have filed an FIR. So you are absolutely right. That's a fraud that we ourselves feel that has happened. But nonetheless, the regulator has to finally establish it, and which is what the proceedings are on. And henceforth, over the course of the period, everything will get established in quantum beat in terms of the severity and the modus operandi through which it was done.
All right. Mr. Modi, good morning. And unfortunate developments, but I think important to get that clarity. Let's just now talk about the other one, right? The government essentially signing a MOU with Lodha for a 30,000 crore rupee green integrated data center park. So is this, MOU and it's an understanding, how far out from an actual kind of scoping out and signing an agreement, sort of a binding agreement? between now and when are we likely to see that? And just tell us a little bit about this project if you can.
So, Prashant, before we get there, just to clarify on the previous issue of this fraud, I would like to kind of, assure all the stakeholders that Lodha as brand, as a company, stand for the integrity. We are effectively, taking the leadership position in establishing various governance standard in our industry, starting from the giving the margins numbers under the underlying pre-sales and whatnot. So it is saddening, but nonetheless, we will make sure that if the situation has arisen, we will not look for the personality, the position, the seniority of the person.
No, Mr. Modi, absolutely, and it's good that you're placing that on record. I'm sure your shareholders would want to see that. But if you could just complete the other point that I was asking was, is there going to be a wider audit, a forensic audit? Investors will want to know if the damage is limited to 8,500 crores, or could there be more?
No, so obviously we can't completely rule out that whether it can be more or no, but that is a function of the forensic audit. You are right. So perhaps it will undergo the forensic audit, and and the outcome will be there. So that's will come out reasonably soon.
Got that. I think, I think should we, you want to talk about the data center thing, Mr. Modi?
Yes.
Yeah.
So on the data center front, Prashant, you rightfully pointed out. So what we have signed is the MOU with the Maharashtra government, which is, as you know, in our Palava, which is the large land that we have, around 4,300 acre. We started, selling land for putting up the data center to the hyperscalers like Amazon, and recently we did the second transaction with STT. So we clearly see that all the right prerequisite that is required for the data center ecosystem development at Palava everything is in place, and which is what further got endorsed with this MOU, which means now anybody coming and putting up the data center gets further advantage and economics, including in terms of the electricity duty, the concession that the government gives under this MOU. So this is a perfect right location. Our aim, as you know, is businesses focus on residential. Data center is more from the standpoint of continuous monetization of the land that we have, the large land, and thereby creating a virtuous cycle for our residential ecosystem in and around Palava locations. We will continue to work on, but also it opens up another opportunity for us to potentially build the annuity stream of income that we are targeting. Our target there is not mammoth. It is more like 1,500 crore by the end of the end of the decade. So there lies a potential there. We may also think of doing some data center for ourselves, but otherwise it is more for selling the land to the various scalar data center ecosystem provider, whom we sell the land and and thereby continue to create good cash flow for the company on a yearly basis.
No, my only question is, you are basically just you were going to be providing land and kind of sort of development around it.
Yes.
You're not entering the data center business in that.
Not really, but it just creates an opening that to the extent of our annuity target threshold of 1,500 crore, if we wish to, at some point we may think of, but no, otherwise what you said is absolutely correct.
Okay. And just from business strategy perspective, Mr. Modi, I know it's 30 seconds is too short a time to answer, but say setting up a residential township, setting up a commercial building or a mall, vis-a-vis setting up a data center, how do the margins compare? And how lucrative is the data center business?
See, data center is more an infrastructure, right?
Yeah.
The digital infrastructure, and thereby the margins from that business can only be contemplated on a typical what any other infrastructure projects will give. It can be some bit superior as compared to any other infrastructure projects that one would think of, but not otherwise. So thereby there is no comparison. It will be dramatically different because we are not becoming a data center operator. We can construct and then put it to the Amazons of the world if they have to, and they can operate.
Yeah, so similar to the office business, more or less, similar to the commercial business.
Yeah, I would call in some way like that. Yes.
Okay.
But it'll be.
Got it. Thank you very much.
I'm assuming it'll be different, Mr. Modi, right? Because we're talking about a concrete box, concrete shell, and not. I mean, it's going to be limited to that for you. If you decide to go into that, and of course you then sell it to others to populate it with everything else which is required in that sense. But anyway, it's a different conversation. You're not thinking on those lines. You may think about it later, and we can maybe talk about it. Thank you very much for joining us. We're going to come back with the big movers on Dalal Street yesterday and how they stack up in terms of price and delivery statistics. Take a break. We're back.
Welcome back. Hope you're having a good morning. Well, a lot of stocks to talk upon. We have Deven Choksi, the MD at DR Choksi FinServ, who joins us on the show. Hi, Deven. Good morning and good to see you in. Let's talk about Swiggy. You know, they had that stake in Rapido. They're exiting, they're selling that stake for around 2,400 crores thereabouts. So they'll get some cash in their books. But I think the market had sniffed it earlier. But what's your view? You know, that valuation gap with Eternal does continue. So how would you approach this stock?
Hi, Nigel. Good morning. Well, I think they are doing everything possible to build the balance sheet, I suppose. And getting rid of, some of the investments, definitely, is part of that activity as it appears. Your observation is absolutely, to the point about the valuation gap between the Eternal and Swiggy. In my viewpoint, I think it a long back, I think, started correcting its balance sheet strengthening exercise. And Swiggy is possibly entering into that phase now. So it might continue for a while as we see it. I think, nonetheless, as a consumer, you enjoy both the technology platforms. I think that's not a challenge. But the fact is that I think the valuation-wise, it will stay at an elevated level. And that's where probably catch-up will have to happen through the balance sheet strengthening exercise, as I see it, I think, happening now, first week.
That's Swiggy. Devin, hi, morning. I don't know if you could hear our conversation with Mr. Modi of Lodha. Not really a question only on that stock or company, but in general, there are those who believe that the luxury end of the housing market is now looking a little tired. So, give us some sense, either the Mumbai-based players or Bangalore-based players, do you still have any preferences? Would you look at buying any real estate stock at this point?
Yes, Selvi, good morning. I find that I think the redevelopment part of the story is catching up very fast. So those companies which are basically picking up the business, I think, on the redevelopment side, for them, the business continues because on one side, I think they relocate the existing owners into the same newly constructed premises. And on the other side, I think they don't invest money in the land bank. Firstly, I think the requirement of money is basically used for the purpose of development only. So that's where this model is working well in my viewpoint, I think, in some of the cases. Of course, I think some of the larger companies do have the redevelopment kind of projects along with. But by and large, I think they are basically working with the land bank kind of a proposition, so that remains slightly expensive one. In my viewpoint, as long as I think you generate sufficiently high amount of margin on your construction activity, then probably I think you will be selling through smoothly, even if there is a tough situation on selling side as far as the premium housing is concerned. Fortunately, for the ultra luxury segment and the luxury segment, which is above the premium segment of housing, I think the business condition remains, fortunately, I think, more rewarding, at least in the select pockets like Mumbai. You are finding that some of the companies like Lotus, they're doing a relatively better job comparatively keeping that kind of a focus. So remain positive, but selectively on the real estate space.
Yeah, got that. Any thoughts on Swiggy? Devin, there are two bits of news. Okay, I think we did discuss Swiggy. What else? Where else are you finding action? I don't know if you have tracked a name like BF Utilities, Devin. You know, the story there is land. It's been for years. It was part of Nimesh's D Street chatter yesterday. Stock was up 10.5%. I don't know, any thoughts or... I'm sure over the years you've looked at it.
Yes, Prashant, I think I've always looked at the company and always found more disappointment looking at that company. Anyway, I think at this point of time, there is no particular viewpoint except, I think, what we keep on hearing about the land bank. But no viewpoint on a company per se, at least at this point of time.
Okay, let's put more stocks up, right? And this is what did very well yesterday, what moved basically, the big movers and the price action, volumes, deliveries, etc. behind it. Hormuz is here with exactly that. Hormuz, over to you.
Morning, Prashant. And we've been talking a lot about the auto names, but the ones that were actually making a mark in yesterday's trading session were the auto ancillary names. And take a look at these auto component makers, be it Subros, be it Automotive Stampings, Lumax Industries, Lumax Auto, all of them seeing gains of anywhere between 7% to as high as 15% in yesterday's session. And not just the gains, these gains have come on very strong volumes. Look at Automotive Stampings. It's a Tata Group company, and it's 12.5 lakh shares traded yesterday. The 20-day volume here is only 15,000 shares. Same is the case with Subros as well. Close to 45 lakh shares traded. The 20-day average volume is only 1.5 lakh. Well, Lumax Industries and Lumax Auto volumes are on the lower side, but of course they are still at least 2x of their 20-day average when you compare it to yesterday's trading session. Now, even on the delivery front as well, Automotive Stampings saw saw more than 1 lakh shares being marked for delivery. 12 lakh were traded, more than 1.5 lakh for delivery, and the 20-day average here is only 8,000 shares. The same is the case with Subros, almost 4 lakh shares marked for delivery, 20-day average being 55,000. Lumax and Lumax Auto as well, seeing at least 2x of their delivery volumes as well in yesterday's trading session. There's something brewing in all cargo terminals based on the price action and the volumes that you're seeing over the last couple of sessions. The stock has risen 17% in the last 2 sessions. Yesterday as well, stock saw a 10% up move. The volumes yesterday were the highest since March of 2024, with more than 35 lakh shares trading in yesterday's session. The 20-day average here is only 2.5 lakh, and 13 lakh shares out of that were marked for delivery. The 20-day average here is only 1 lakh shares. Now, the stock this month itself, a couple of days of strong price action, and the stock is up 30% this month, which has already become the best month of this calendar year so far. And GMDC, we spoke about this on closing bell yesterday as well. The stock ended at a record high. Not just that, yesterday's volumes was the highest on record for the stock, with more than 5.5 crore shares trading. 20-day average is only 1 crore, but this is of course after the fact that there has been a recent spurt in volumes. In the last 13 sessions, there have been 6 instances where there have been more than 1 crore plus shares being traded in a single trading day, and almost 50 lakh shares were marked for delivery as well. The 17.5 lakh shares being the 20-day average, and the stock is up almost 60% already in the month of September, which has made it the best month that the stock has had since May of 2009 for GMDC.
Okay, all right, Hormuz, thanks a lot for that. We'll keep an eye out on all those stocks today as well. For the time being, we slip into a short break. Come back. Pre-open rates, we'll also get chatting with Sudarshan as well as Mitesh. They'll give us their technical calls.
Welcome back. This is, of course, Open Exchange. What, 1 minute to go for the pre-open session and 16 minutes to go for the market open. Sudarshan Sukhani is with us, and so is Mitesh Thakur with what they'd want you to do in terms of trades today morning. Gentlemen, great to have both of you here. Mitesh, how are things looking? Yesterday was flat after a 2-day pause. How does one take up things? I mean, there's the other thing which is happening, right? The rupee, which the dollar rupee went up sharply, almost at about 89. So that also is looming. One's not sure. For the year, I was just checking, it's down about 3.5%. That's in line. I mean, typically we see 2-3% kind of depreciation. We're at the end of the year. So hopefully this is it, or there is more. As I said, not very clear, but people are wondering whether that at some point will have a spillover effect here into equities. But purely technicals, how are things looking?
Good morning, Prashant. We maintain a positive bias saying that this pullback should be bought into. My initial feeling was that 25,150 should be it, though yesterday we got an intraday low below that. The closing remains above that, and the direction of the indicators and the averages is rising. So I think it's still not a negative sign, but we have hovering around this support level of 25,150, 100. I think it's important that we give a rebound from here. I think that will confirm that this support level holds. And once that happens, I would look at a retest of 25,500.
Okay, all right. Let's go across to Sudarshan then. Good morning, gentlemen. Sudarshan, what about you? How would you approach the markets?
Yeah, good morning. And Nigel, we have had a 2-week rally. And then on Monday, we said, okay, 25,200 is our cutoff point. If it goes below that, we have to make a risk call on the risk, and we'll just exit long positions. That happened. Yesterday, my view was avoid the Nifty. There is no clarity on what it's going to do. I'm sorry, but today the same view continues, which really means I don't have a trade in the Nifty. And this is not unusual. Sometimes the market doesn't give any view, and that's okay. We just have to accept it. So I would advise focus on stocks, completely forget about the index today.
Okay, all right. So more about the stocks than the index. So in that case, gentlemen, let's get to the stocks. Sudarshan, what's on your list?
Well, Alchem is a buy with a stop under 5,500. Hind Petro is a buying opportunity with a stop under 418. NMDC is a buy with a stop under 77. And State Bank is a buying opportunity with a stop under 860. And so since these are buys, let me explain. The trend has not changed. It's just too choppy to trade the Nifty.
Okay, got it. Mitesh, morning. Let me come to your stock list as well. What are the names?
Morning, Subi. I also have more of buy calls. So a buy on IndusInd Bank, which after a good decline seems to be giving first signs of a reversal. For the timing, I would recommend a buy with a target of 775 to begin with and a stop at 745. Then a buy on Canara Bank, which made a fresh swing high. So keep a stop at 118, look for a target of 130 here. A buy on Aurobindo Pharma, which after 2-3 days of pullback is giving you a fresh entry point. So keep a stop below 1,090, look for targets of 1,150. And one sell call, that's Godrej Consumer. And the FMCG pack in the last few days has seen price correction. So Godrej Consumer has broken a support line. Sell here with a stop at 1210 for targets of around 1155.
By the way, thank you very much for that, gentlemen. We'll come back to you closer to the opening. The pre-open rates that have come in there are very similar to what the implied open was guiding us towards, which is a lower start. So we're down about 80 points in the pre-open. There's a lot of selling on both large banks and IT, at least in the pre-open session. Infosys, TCS are your culprits. HDFC Bank is also slightly lower. And some of the stocks in news, Swiggy, of course, was one. They've done business restructuring, sold off Instamart to a step-down subsidiary, and then they're getting in almost 2,000 crores from the sale of their stake in Rapido. Stocks up about 2%. More on stocks in a bit, but let's focus on the currency, which was making all kinds of headlines yesterday with the rupee slumping to a fresh all-time low. Now, what are the factors at play? What are dealers saying? Let's go across to Lata for some perspective. Morning, Lata.
Yes, the Tuesday fall was rather large. A 0.5% fall in a single day is not par for the course at all. It is an unusual outlier fall. The reasons are really that there has been a stepped-up selling by funds. We saw that 2,900 crores on Monday. We saw another 3,500 odd crores on Tuesday. So that selling normally translates next day into dollar buying. Now, if yesterday's was about 3,500 crores of equity selling, they would come in and buy dollars today. It usually works T+1, and therefore the pressure is expected to continue. Usually supplies come in. Exporters also bring in dollars at the end of the month to pay their salaries, to make their payments. But the converse also happens. You often see PSU banks going out and buying dollars to make probably month-end payments on behalf of oil companies. We don't know. Actually, the month-end activity is usually very strong. So at the moment, markets are still watching to learn from the market. 89 will be targeted by those who are worried that this equity sales capital outflow is just not stopping. And, people also lost somehow at 88.5 because it was once protected and the trade talks, all those had lifted the sentiment on the rupee. People were actually sitting dollar short at this 88.5 positions. All those people are now scampering and coming in and buying, and people who thought that they could book at imports at a lower price are now coming in and buying because it doesn't look like it will go below 88.5. The stream of bad news, visa or tariffs and lottery off on H1B, all these are only negative sentiment. Even if the remittances are going to be affected only next year, it is negative sentiment. So 89 will be targeted. The expectation in the market is that the Reserve Bank will come roaringly before that and not allow that number to be broken so easily. So expect something like, not as bad as yesterday, but definitely pressure on the currency.
Yeah, I mean, yesterday did seem a little disorderly in that sense, as you said, a 0.5% move, not usual in any given circumstance. Lata, thank you very much for that, and hope we can come back to you for more during the course of the day if we see some action here. Well, let's just shift focus to the power sector now. Sources tell CNBC TV18 that around 40 gigawatts of renewable energy capacity remains stranded due to lack of power purchase agreements. At the same time, solar output continues to decline amid weak demand. To discuss this and more, we are now joined by Nikhil Nigania, Director and Senior Analyst at Bernstein. Nikhil, good morning. Good to have you with us here. Thanks very much. I mean, I guess this is something which has been brewing for a while, and we've been sort of picking this up in conversations. I think we've spoken about this in our earlier chats briefly. So what does this mean for the for companies under your coverage, Nikhil? Let's just narrow down the focus immediately to that from an investor point of view.
Sure. So this event specifically, if you see renewable, about 40 gigawatts getting re-tendered, there was a challenge that power demand has been soft this year after 3-4 years of strong growth. This year, due to largely rainfall, power demand has been quite soft. August, September, slightly better, 3-4% growth we are seeing YOY. But due to soft power demand and a huge influx of renewable tendering in the last 2 years, there was a group of tenders where PPAs were not getting signed. So now, given the lack of DISCOM interest to sign PPAs due to low power demand and a big pipeline already signed up, these projects or these tenders were not fructifying into PPAs. Now they'll get re-tendered. In terms of the implications of this, there's no stranded asset due to this. No one put any hard capital just on the basis of a tender. Without a PPA, no investments happen. So no impact immediately on earnings of renewable developers, but does impact sort of growth that was expected of them in the next 1 or 2 years on the renewable developers. Just specifically renewable developers are the only ones impacted by this event.
Oh. For companies in the and this is a space you've covered and you have been skeptical, the solar module companies and those kinds, right? Cell, module, etc. There's more coming. By the way, our colleague Shireen interviewed Sanjeev Goenka, who's I'm sure you saw. They are setting up, they said, well, in the next 35 days, first capacities come on stream and they have targets of 3 gigawatts each in cell and module, which the group is targeting. So there's, but, specifically there, Nikhil, is there an impact?
So their near-term impact, no. So as you rightly said, we have been negative on renewables and more positive on consequences of renewables, which is transmission, thermal, battery, etc. So within renewables, as you said, solar manufacturing, near term, it's a phenomenal story for them. The earnings is very strong, largely due to government schemes, especially the PM Surya Ghar scheme, rooftop scheme, and also the PM Kusum scheme for solar pumps. So those are the ones which are aiding their earnings. So we think FY26 and even possibly decent part of FY27, those companies will see strong earnings. But beyond that, we are really concerned. We see a glut of supply coming. almost every, as you said, many people are lining up for IPOs. Every second company we are meeting is looking to set up a solar module and cell manufacturing plant. And that's when we are concerned from a long-term perspective, medium to long-term perspective, that there could be a supply glut and earnings, the ROEs could fall and earnings could compress. So these companies are at peak earnings right now, peak ROE, peak margins due to government schemes. So near-term strong, but medium-term we are quite concerned.
Nikhil, I can tell you this. When this news popped up yesterday over the last 24 hours, you're the first person I thought of. Because when you read that headline that, it's 40 gigawatts of capacity stranded and no one's signing PPAs, I was just thinking about, the thesis you've been building very consistently, and you have raised those issues over the past many, many months now. So going back to that first point, now this, do you think that this is a short-term issue because this year power demand was low and we had a plentiful monsoon, etc.? Or is this a bigger structural issue? And therefore, what would you expect on both wind and solar tariffs? As this huge amount of capacity, it's not like 1 gigawatts here or there, right? It's 40 gigawatts which needs to come up for rebidding now.
Yeah, see, it's a near-term issue, but medium to long-term, the heart of the sector is power demand, where we are positive. Because if you look at the new use cases of power emerging in EVs, the cooling need, data centers, power demand growth will accelerate. This year was an aberration in power demand. It should come back to 1x of real GDP. And once power demand comes back, we need to add renewables. There is no doubt about that. The only difference in our view is instead of government aspiration to add about 40, 50 gigawatts of renewable a year, we feel 30 to 35 gigawatt is what is more realistic in terms of renewable capacity addition. So we should hit that number in the medium term. But yeah, near term, some of the headwinds are there in contract signing due to low demand and massive.
Okay, and this is happening at a time when there is a lot of talk around nuclear as well, right? Scale up of nuclear. We've seen NTPC starting to make some overtures on that side as well. So again, in the near term, this PPA situation, could it get worse before it gets better? And from a stock perspective, then, which are the stocks which we should watch out for? I mean, you've already mentioned that I think a lot of the renewables you're not very bullish on. But could this be an overhang overall on power stocks in the near term?
So on the first point, you mentioned nuclear, an excellent long-term story we feel to complement renewables. Renewables are not dispatchable. With batteries to some extent they are. But you need either thermal or nuclear to complement renewables. I did visit a nuclear plant in India recently, and it's probably the most efficient way man has made power, is what I feel. Very low land footprint, very low emissions. So nuclear will be a long-term story. But it won't impact the near-term PPA per se. To make a nuclear plant, it takes 10 years. So even if we start work today, it's probably going to come in 2032, 35 is when the nuclear assets will start coming. And lastly, in terms of stocks, as you said, within our coverage, we continue to like L&T from a power construction perspective. We like NTPC, which is complementary. So it's a thermal plus nuclear plus renewable play. Where we are negative on some renewable developers, where we find the valuations rich. We are negative on solar manufacturing companies, such as Premier and Wari, due to the supply glut that we envisage.
Okay, yeah, and those calls have been fairly consistent, I guess, over the past many months now. Thank you for that, Nikhil. Good conversation and good to get that perspective. So, yeah, let's see. We need to figure out what happens to these PPAs which are not getting signed in the renewable space. Perhaps it will get resolved in the rebids. The pre-open is settled. It's not looking actually that bad. I mean, it's 60 points lower, slightly better off. Let's quickly get to our technical experts for some final calls. Sudarshan, what stock will you go with?
I'll go with Hind Petro, buy with a stop under 480.
Okay, so buy on Hind Petro. And Mitesh, your stock?
Yeah. I'll go with the buy on... Sorry, excuse me. I'll go with the buy on Canara Bank for targets of 1.
Okay. All right, got that, gentlemen. Thanks very much. Let's quickly hop across back to Sud. Maruti has been a stock in sharp focus. The company has been sounding very, very optimistic after, I don't know, quarters, maybe years. So let's revisit some of the broker calls on the stock.
So after yesterday's outperformance, today also Maruti can be in the focus today. Goldman Sachs has come out with a note and has upgraded the stock to buy and has the highest target price on the street, and target price is rupees 18,900 per share. And it has mentioned some of the factors. First, potential pickup in the entry-level segment. Remember, Maruti had announced price cut, and the biggest cut was announced for the entry-level segment, where price cut was up to rupees 1.30 lakh. Second factor, it has mentioned that company has resumed new launches after a gap of nearly 3 years, and recently it has launched Victoris SUV and also e-Vitara. And third, as far as emission risks are concerned, compared to peers, it's like it will be a less risk for Maruti. And now it expects 5%, 12%, 9% volume growth for Maruti in FY 26, 27, 28. And it's likely to be higher than what industry might see a growth. And because of all these factors, it has raised EPS estimate for FY 26, 28 by up to 12%.
All right. So thank you very much for that. Just about a minute to go for the market open. And we can then sort of start to look at prices as they start to come up on your screens. What do we have? A couple of seconds, actually. The Nifty will come up, Nifty Bank, mid and small cap indices. Then we'll get down to individual stocks. The opening is, the indicative is about a 60-odd point lower start. What do we have? So 25,150, 25,140, it's about 0.12% lower. Nifty Bank is down about 0.09, so nothing very much at start. The Midcap index is flattish. The small cap index is up about 0.14% or so as well. So, yeah. So stocks are still opening. So you just had about 900, 800 stocks on advances and declines. And I think we should be able to look at it in about a minute, 2 minutes to get a better sense. More down than up, but nothing overwhelming in that sense. Bharati, Tech M, Adani on one side, Trent, SBI, Adani Ports on the other side is what you have. Remember, the Adani Group stocks all had a massive run from last Friday. Friday, Monday, big move. Yesterday, of course, they all pulled back between 3 and 4%. So keep an eye out on that as well. But this is the open, about a 50 or 55 point lower start. And we're, within the first 1 minute of market open. Survey.
Okay, so 57 down. Let's see what all is down. Hero Moto, Bajaj Auto, Aisha, Tata Motors. So basically, auto is cooling off. Let's see where Maruti is. Maruti is actually bucking the trend. There's a little bit of a green on Maruti, about 30 to 35 rupees up on Maruti right now, thanks to the broker calls. Some of the bigger banks are weak. ICICI Bank, Axis, both on the lower side, losing about 0.5% to about 0.7%. HDFC Bank also slightly lower. So banks on the lower side as well. Then what else is correcting? Bharti, Airtel, L&T, Tata Steel is on the lower side. There's some profit taking on Eternal as well this morning. Titan is lower. So it's actually, a clutch of different sectors. The outliers on the upside would be Trent. Trent is seeing some traction, 1.3% up on Trent right now. There's Asian Paints, which is managing 0.5% of an up move. And SBI is bucking the overall banking weakness. Most of your private sector banks are lower today. SBI up about 0.7%. But yeah, the Nifty is still nursing a cut of around 70 points, Nigel.
Well, that's right. A few stocks that are actually calling for special attention in today's trading session. You have Minda Corp. They've released their vision for 2030. They're looking at scaling the revenues by around 3.5 times. They're talking about margin improvement. They're talking about the net debt to equity number to decline to 0.3 from around 0.6. And ROCE to move up from 20% to 25%. Street likes their vision. Execution is going to be important. Motilal Oswal, they have come out with a note on Lotus developers. They have a target price of around 250 rupees. The street likes that. They're finding that note, of good consequence. In fact, they see good rationale, it seems. For the time being, the stock on large volumes is up. Lotus developers is the stock that we're talking about. So that comes up for you on the screen. A couple of other names. Wheels India, we saw a large trade out there. So the stock is up 7.5% higher. One of my colleagues had pointed that out. Dilip Bilkon, good news coming in there. That stock is up close to around 3%. And Borosil Limited, that one as well is up and about in today's trading session, up close to around 5%. Bajaj Consumer, I'm not sure what's gone on there, whether there is some kind of a corporate action or it's gone X something. We'll have to keep an eye on that. Stock is down close to around 6% as we speak. So that's one notable loser in today's trade. And Ashok Leyland as well, after seeing good buying yesterday, falling on decent volumes, down 3%.
All right. I think that's basically what we have as far as market open is concerned. We'll have more coming up as we go along. So Nifty at about 25,100. We're down about, 66 odd points. And just sort of settling down. More action in just a bit. Gautam Shah is founder of Goldilocks Global Research. He's with us now. Gautam, good morning. Great to have you with us here. Thank you very much for joining us. I'm not sure, were we stock when we were in the midst of this 1,000-point move, Gautam? Or I think we spoke before, right? So how do you assess prospects now? Still in a range, at the cusp of a bigger move, or back down once again from the upper end? What's your sense?
Good morning, Prashant. Well, I think we spoke at the starting of this 1,000-point move, and it was a time wherein we were going through the perfect storm with just about everything against the Indian market rally. But the way markets have reacted to the Trump tariffs and all other negatives that we have been dealing with, I think is quite commendable. And it is fair to say that domestic liquidity has won over once again. People still question valuations. People still question, whether our markets are good enough to actually scale back to previous highs, because most other markets in the world are actually trading at lifetime highs and beyond. But I think I'm quite encouraged with what has happened in the last 2 weeks. I think the screen has looked good. It's been very vibrant. There is widespread participation. A lot of stocks which were underperforming for a long period of time have come back really well. And I think what's happened in the last few days is just a cool off after that 1,000-point rally. So 25,070 and then 24,900 in my book would be the first supports. I think this market is now a buy on dip. And from around these support levels, we should possibly see a turn, taking the Nifty back to 25,500, which I think is now the key level. And once we are past 25,500, I think we should be preparing ourselves for lifetime highs. So I think the setup looks pretty good. Stay in the right pockets, stay in the right stocks. Don't look at the Nifty too much, and I think we should be sorted.
Don't look at the Nifty too much. Actually, yeah, I mean, the Nifty did manage to climb above 25,000. So maybe higher levels ahead. Got that point, Gautam. So if not the Nifty, then where else should we look? Do you see any emerging trends? I mean, let's start with the market's favorite trend over the last 1.5 to 2 months, which is consumer and auto. Do they look good for more?
Well, firstly, Surabhi, I think over the last 5 years, we've seen a lot of market cap rotation. So when the Nifty does not do well, people are a little discouraged that, markets are not running up the way they used to, but then they can't keep running up given our levels and given our valuations. So I think the large caps have taken a bit of a backseat. I mean, just a case in point, what Bajaj Finance has done versus Asian Paints. I think that's just the writing on the wall that if you are in the right pocket, there is clearly outperformance. So I think given that, there are some new leaders which have really emerged in the recent past, auto being one of them. In fact, I spoke about it in our last interaction. The auto index, as we speak, is near lifetime highs. And I think the news flow around GST has clearly been the trigger for the same, which I'm not surprised at all. It's a big one. And I think it's going to see much bigger upside. So I think 27,700 was our working target. We got close to it. But I think over the medium term, you could even see a 30,000 on the auto index because standalone stock setups continue to look positive. On the other hand, people thought that FMCG will start doing well because of the GST trigger and all of that. That's not worked. FMCG has been one of the biggest underperformers of the last 3 weeks. And in my book, it is still an avoid. So stick to auto, stick to metal, stick to banking. Those three are our top picks.
Okay, all right. Hi, Gautam. Good to see you. Let's take a break from the equity markets. What about gold? Where is that one headed? $3,800. Wow, what a move out there. Where is that headed?
Well, it's left everyone behind and every asset class behind, isn't it? In the last 18 months, I remember I was at a CMT summit a year and a half back, and it was at 1,800, and all global strategists were discussing whether S&P or gold. Clearly, gold has won, and I think it's going to keep winning. I think 3,850 is an important near-term resistance. I don't think these are levels to buy, but this is a structural mega trend which is going to continue over the next 3 to 6 months. So if somebody is long from lower levels, please stay invested. But more than gold, as I've said in all my recent interactions, I think the bigger opportunity is silver. As we speak, we are at $44 international prices, and I think there is another 20% upside very easily towards $50 and beyond. So stay invested. I don't think there is a case to book profits in precious metals and move to equities.
Gautam, that's an important point. Those who are already invested, it's like one of those stocks which has gone from 100 to 1,000. And it's still looking good, but then how do you buy it? $1,000 now, right? Even though the structure, etc., looks good. I have a friend who keeps talking about gold, right? Has been talking about gold for a while. But yeah, it's one of those things, Gautam. I mean, I think we've spoken about. We've been talking for at least 15 years now. Global financial crisis, currency debasement, and how gold is this new thing. But nothing happened. $1,000 in 2008, but then it suddenly moves, right? 1,000 to 2,000. It took 12 years, and from 2020, it's almost doubled in 5 years. It's like any other asset class. You can never time it, although the drivers were there even back then. Sorry, go on.
Well, you don't tell a technical analyst you can't time it. all the time. And I think what happened over 7 years, I think is the hard work that gold put in, in that period, where everything was in place in terms of fundamentals for it to do well. And the kind of geopolitical environment that we live in now, it's very easy to actually build a case for gold. And the industrial use argument for silver, I think, is really big. So while gold has done very well over the last 18 months, I think the next 12 to 18 months will still belong to silver.
Yeah, that's an interesting one. वो नहीं लिया तो silver में chance है, right? I mean, I think that's the, but point taken, Gautam.
But I was looking at some sobering stats, and everybody does this, right? India versus the rest of the world. So if you look at India versus the MSCI All World Index, and I'm just checking my numbers again. Year to date, we're down 16%, which is fine. I mean, you can't be outperforming every year, but the bigger worry is that in dollar terms, we have underperformed that index by 37 percentage points. So, there is that question of, what next? And I think a lot of investors here are very savvy now, Gautam. So, therefore, they're wondering silver or gold, and they're wondering whether buy this dip on the NASDAQ or, go and buy, China stocks because you have a bigger tech play over there. So let's broaden the conversation. The US market itself, do you see it continuing its winning ways? The Fed chief thinks it's overvalued, but what are the charts saying?
There was so much debate in the US markets about debt and inflation and Trump's policies, valuations, and whether AI has been discounted to a greater extent. And a lot of people stayed out thinking that this is a bubble, this cannot sustain. But the US markets have done fabulously well. And we've been tracking it very closely over the last 6 to 8 months since we now have a product. And I'm amazed to see the kind of moves that US markets are seeing. There are still no signs of topping out. My working target on the S&P 500 is 6960. I think the NASDAQ can do another 10-12%. And many of the top stocks are still very well placed. So if the mother market is still in a strong bull market, and many other markets in Asia and Europe are still trading at lifetime highs and doing well, I mean, the case which I made last time, India will have to join the party. The world will not join India's underperformance. India will have to join the world equity market, bull market, which is playing out. But the key point is, India versus the world. Yes, we've underperformed, but from a Nifty perspective. But if you are in the right stocks, in the mid caps, in the small caps, I mean, look at an Eternal, just a case in point. It's at 335 today. I mean, what an incredible run that stock has seen. There are many such big winners which are in the making right now. So I don't think the top 100 is going to do anything in the next 6 to 12 months. So the Nifty might not give great returns, but the mid cap, small cap, because the domestic money is actually now going seriously there, I think is where the real opportunity is.
No, absolutely. I couldn't, agree with you more and take your point. And why mid cap, small cap? You gave the example of one large cap, Eternal. Look at a stock like Maruti. Like, who doesn't know Maruti, right? And that stock is up 50%. So if you're in the right stock, then it's a very different market for you. So give us some more clues, some names. I don't know, you don't usually talk stocks, but some idea where the structures are looking, really promising at this point in time. Maybe some individual names or some hints around sectors, if not stocks.
See, I think last time I spoke about auto, that's already played out. I think the top stocks have done very well. I don't think they're a buy at current prices, but I still feel that metals is the next big opportunity. I do know a lot of my fundamental friends who are not able to join the dots and build a fundamental case for metals. But look at what top metal stocks have done. JSW Steel, Hindalco, Tata Steel, SAIL, Nalco. Not recommendation, but I think some of these stocks are trading near lifetime highs and still very strong on the charts. So from somewhere around 10,000, which is where the NSE Metals Index is, I wouldn't be surprised if you get a 25% move on that index. So I think metals is really the next big opportunity, which I've maintained for a while, and I think that's going to continue. Banking, I think, is going to do well and possibly start moving towards levels of 57,500, led by the PSU banks. I think I love the setup of some of the top PSU banks, and I think they are likely to be big winners. And the dark horse sector, which not many people are talking about right now, is the comeback of PSU stocks. They were in a mega trend, went into a consolidation for a year. Everybody gave up on it. Valuations are comfortable, nothing to do with foreign policy. And I think they are under-owned in some sense. So I think PSU could also be the next big opportunity over the next 1 year.
PSU as in only the PSU banks, or overall you expect the CPSE universe to start firing up?
I think PSU banks will outperform for sure within the entire PSC basket, but the entire PSC basket is also likely to do well. So if somebody wants to just look at an ETF and just participate on the index, it might be a good idea.
Yeah, no, it's taken a nice break, right? Last couple of years, the PSU Bank Index. By the way, you mentioned steel, Gautam, right? And you're talking charts and price action. We have the fundamental view coming in on steel in just a bit from now. So we have the Steel Secretary, Government of India, joining us shortly, Mr. Poundrick will be able to sort of explain to us where the government sees, because it's an industry with a lot of government focus. It's a fundamental building blocks industry, and I think it's a conversation you don't want to miss. Coming up in just a bit from now. Anything else, Gautam, before we wrap up? Any other single stock ideas?
No, I think the point is stay concentrated. I mean, don't do too much. I think that's really the key takeaway, because we've seen what's happened with IT, we've seen what's happened with FMCG and pharma, capital goods, all underperforming. Don't commit where there is no relative strength. I think that's the key takeaway. Stay where there is a quality strength and reasonable valuations, and I think we should be good.
All right, we'll leave it there. Gautam, thank you very much for joining us. Really appreciate your time here on CNBC TV18. And look forward to the next one. We're done about what? I think the Nifty should come up on your screen. And we'll just take a quick look at it and sort of move on from there. 100 points clean. 25,067 is where we are starting this morning as far as prices are concerned. And the Bank Nifty, Midcap, small cap indices that have come up. And maybe we just sort of run through the auto, financials, and the metals indices as well. Metals perked up second half. Autos did quite well. There are, of course, a couple of brokerage calls as well for auto. Financials on your screen. Metals and auto next. Metal index is down about a quarter, so not moving too much. And steel there in particular is the one that I'm talking about. And, of course, the auto stocks, which have had a bit of a move, down about 0.75% at this point. Just the rupee as well, the dollar rupee, and where we are at. Sharp move yesterday. Lata, of course, in the morning was with us, 88.71. So it's absolutely kind of sort of on an even keel this morning. Not very much by way of a change. Minda Corp is what we want to put the spotlight on once again. Sud is here with us to do exactly that. Sud, over to you.
So in the opening hour of trade, stock has risen as much as 10%. Currently, it's trading with a gain of nearly 8%. And this has come after companies released Vision 2030 document in which it has set some ambitious target on revenue front. It expects an increase of almost 4 times to ₹17,500 crore from the current level of 5,100 crore. On the margin front also, it believes that it will increase to 12.5% from the current level of 11.4%. And on net debt to equity ratio, it might decline to 0.3 times from current level of 0.6 times, and on ROCE, it might exceed to 25% from 20%. And on the revenue mix, it believes that the contribution of passenger vehicle will increase to 25% from current level of 14%. But at the same time, for two-wheelers, commercial vehicles and three-wheelers, contribution is going to increase over the next 5 years. What are some of the few growth drivers? First one, the company will focus on premiumization. Second, to increase the kit value. And for both two-wheelers and passenger vehicles, it believes that over the next 3 years, that is by FY28, kit value is likely to double. And third is on export front, it's targeting 37% CAGR over next 5 years versus 18% that company has seen from FY21 to 25. And lastly, in the recent past, it has signed some of the few JVs from Japanese companies and Chinese companies, and it believes that those also will aid the growth going forward.
Okay, all right. So that's in the last few years, I think the management has spoken only to our channel. Recall, the stock was a third of what it is today, but now they've come out with their big vision. So hopefully they rejoin on the channel and give us what's the trajectory from here on. At that point of time, the stock was around 200 rupees when they spoke to us last. Moving across to Upasana, she's here to tell us about Bajaj Electricals. Upasana?
Good morning. So the board has given a consent to acquire Morphy Richards brand and intellectual property rights in India and across neighbouring region from Glen Electric Limited for a consideration of nearly about 146 crores. Now, mind you that the company has been manufacturing and marketing Morphy Richards products since April 2002 in India, positioning it in the premium home appliances category. So this strategic move is expected to strengthen its position in the home appliances and consumer electronics portfolio. So overall, it certainly bodes well for the company as company gets the brand rights in the South Asia markets such as Nepal, Bangladesh, Maldives, etc. So we can certainly see the stock surging higher in trade today.
Okay, all right. Thanks a lot for that, Upasna. But as promised, let's focus on the fairest pack. We have Mr. Sandeep Podrik, the Secretary of Ministry of Steel, who joins us on the show. Hi, sir. Good morning. Good to see you win. And kudos to you as well as the team. You know, has protected the domestic steel industry from all that's going out in the globe and, in fact, the uncertainties that we're seeing on the trade front as well. That said, I wanted your opinion on a couple of factors. One is, will GST 2.0 spur further demand for the steel sector? If you could give us your quick comment on that. And demand could be relatively impacted because of relatively lower spends coming in from the government, maybe lower demand from the government. But do you see green shoots coming up post-Diwali?
So, thank you and good morning. Let us start with the impact of GST on the steel sector. We see that the consumption is likely to grow with the change in GST, the GST reforms. And primarily, 4 sectors, in our opinion, will impact the consumption of steel and increase the consumption of steel. First is the construction sector, because as you know, the cement GST has been reduced. So that will incentivize or encourage more construction, and steel is one of the important factors or inputs in construction. So that should increase consumption. Second is automobile. Again, most of the automobiles or autos have been brought into lower GST band. So that should incentivize more steel consumption there. Household consumer durables like refrigerators, ACs, again, lower GST, more production, more consumption of steel. One more thing which should, so that's on the consumption side. There are more sectors which will incentivize more consumption. So we are expecting that in coming months, the steel consumption will grow. We should also take into account the fact that we are the only major economy in the world where steel consumption is growing in double digits.
Yeah.
For last 3 years, we are growing at 12%. And in the first almost half, April to August of this financial year, we have grown more than 8% in terms of consumption. So I see an optimistic scenario for steel consumption because of GST reforms. And I also see that as the rainy season ends, we should see more consumption in steel and more demand coming from all sectors.
Okay.
So I will presume that the steel sector will continue to show robust growth on the consumption side.
Got it. And for the year, sir, we should be working with what, high single-digit growth?
So as I said, till now it's 8% for April to August, but I would dare say that because of GST reforms and because of the coming construction season coming, we should be somewhere around 9 to 10% at least in the consumption growth.
Mr. Podrik, so thank you so much for being with us this morning. Surabhi here. I just had a question around how you're observing moves in China and their implications for the Indian steel sector. Now, there's already, a safeguard duty that has been announced. But a lot is going on in China, and there's a lot of talk of this so-called anti-involution policy. They're trying to set their house in order, reduce disruptive price wars. What is your reading of the situation? Are you anticipating more Chinese steel in global markets, including India? Or do you think the safeguard duty is adequate? And right now, the Indian steel sector is well protected?
So you're right. A lot of steel is coming into the international market. And there's an article you must have seen today which talks about a lot of exports from China to other countries. But as far as steel is concerned, if you see the present year data, the imports from China have reduced significantly as compared to last year. That may be due to safeguard duty, provisional safeguard duty, which has been imposed by the government. And as DGTR has recommended to continue the safeguard duty, I would presume that domestic steel sector should get reasonable price and should not be affected because of the cheap or substandard imports.
Okay.
Also, there are some anti-dumping investigations going on, and DGTR has already recommended imposition of anti-dumping duties on two categories of products, one from China, one from Vietnam. So, all inclusive, that's safeguard duty, anti-dumping duties on after DGTR recommendations and after the process. I would say that domestic steel sector should not be adversely impacted because of cheap or substandard steel imports. I don't see that as a possibility, at least in the near term.
Right, absolutely. Mr. Pandrik, hi, good morning. Prashant here, and good to see you, sir, always. Provides a really high-level guidance on the industry going forward. Just a quick word, Mr. Pandrik, on on exactly that point. The expectation is, and this is of course from a financial market standpoint, that everything from refined products to steel to chemicals out of China, which is the largest maker of all this stuff, is going to reduce because this anti-involution, which my colleague pointed out, basically race to the bottom. So they want to prevent a race to the bottom in terms of pricing. So they are shutting off old capacities and many such measures, basically. Of course, it will take time for all of this to show up. So basically lesser Chinese exports into the world for everything, including steel. So that is one. So could that, in your opinion, if you've looked at this issue, provide a slightly more structural uplift to prices everywhere? And second, sir, the rupee here against the dollar has, sharply depreciated. It's down 3.5% year to date. So I just wanted to get a sense if you've got an eye on that as well. And any thoughts there? Yeah.
Yeah. So let me talk about the overall import-export scenario and the impact of measures taken by the government. So if you see our exports in this financial year from April to August have in fact increased about 16% as compared to same period for the last year. And our imports have reduced 32%. So while our imports and exports both are not a big chunk of our total domestic consumption or domestic production, they have an impact on the pricing scenario because cheaper imports or whatever imports are happening, they have an impact on domestic pricing, what we may call a benchmarking of the domestic pricing. And if cheap imports come, then the domestic prices go down significantly. If we see the pricing scenario for domestic steel for last maybe 3 years or so, the domestic steel prices have gone down significantly as compared to say 22, 23. But after the safeguard measures by government this year, they have stabilized to some extent, but they are still at a lower level as compared to what they were earlier. On your question about
the currency,
the policy changes in China and the impact on India, I would say that should help the overall steel industry because right now the steel industry in terms of pricing is not very high, means the pricing is at very low level as compared to what they were getting earlier. So any such policy changes should help the industry, and that's also important because we have to invest in the steel sector to cater to the domestic consumption growth. We are targeting at 300 million ton by 2030. On the dollar rupee, yes, that will obviously have an impact, and but Impact in both in terms of raw material imports, because we import substantial part of coking coal. So a change there will help, depreciation will help. As we don't have much exports, that impact I don't see, because our overall exports were only 4.5 million tons last year as compared to total production of 152 million tons. But on the raw material side, that may have more impact on the steel sector.
Mr. Pondrik, just a point. Now, taking what you said, all of it put together, you're saying, first of all, there's no reason to worry about any major China import surging. The safeguard duties will take care of it, and the anti-dumping duties. That coupled with what you just told Nigel, that the demand is looking good, GST is looking very, very good. So the stock market seems to be expecting a price increase. I mean, if you go by some of the brokerage reports, etc. So are those hopes well placed? Would you also expect some price increases in the coming months?
I would not like to comment on the stock market trends. I can say that the steel sector,
steel prices,
per se, as far as we are concerned, yeah, so that's what I'm saying. So that is looking good. I am optimistic that steel prices should, because of the increasing consumption and reducing imports, the prices of steel should balance now in coming months, and the industry should show more returns in terms of revenue and everything. But that's the steel sector per se I'm talking about. So I am optimistic about the steel sector in the country.
Right, Mr. Pondrik. In fact, we had put out a piece yesterday that the domestic makers, they have a good argument to go ahead and increase pricing because consumption will increase. We're at a big discount in comparison to Chinese prices as well as FTA countries' prices. And we're getting into the seasonally stronger period post the monsoon. So let's keep that aside. Just a quick word on the final decision with regard to the safeguard duty from the Finance Ministry. When is that expected, if you could tell us, on steel? And is there a possibility of some anti-dumping duty on stainless steel imports as well?
So the safeguard duty, the provisional duty is applicable till I think first week of November, 6th or 8th of November. So a final decision should be taken before that for continuing the safeguard duty. Means that issue should be finalized before that, I would presume. And on the anti-dumping duty on stainless steel, there is a investigation going on by DGTR. So as soon as the DGTR reports comes in, government will take a decision based on that report. That investigation is still under process.
So we should expect that in the next couple of months?
Normally they take a few months, 3 to 4 months.
Okay, so on stainless steel, there's an investigation. We'll wait to hear from you all. Let's talk about RINL. The last time you joined us, you were telling us that the pending dues are gradually coming down. They've fired up a couple of their furnaces. And the dues actually were to a listed company, which is NMDC. So the street would like to understand what is the pending dues from RINL? How much was it? How much has it come down to?
So RINL... as you know, last year they were in pretty bad shape. Yes. They had total dues of about 35,000 crores, both means roughly half to the banks and roughly half to the private creditors, including NMDC. Now, after the government's package, they have improved substantially. They are running now all their 3 blast furnaces. Roughly, I would say 75 to 80% capacity, which they have never done in the past on a sustainable basis. So operationally, they are doing pretty good. On the finance side, they have reduced significantly their banking loans, banking liabilities, which in turn means that their interest rates have come down for borrowings from the banks.
Okay.
They have started paying back the private creditors too, including NMDC. And I would presume it will take some time. We should understand that their financial position was so precarious that it will take some time for them to totally balance out. But I would say they are in much better position as compared to last year overall financially.
Yeah, if they're paying their dues, then it's good news for NMDC as well, because otherwise there was outstanding in terms of a receivable. Final question, sir. If you have any kind of sneak peek, things are looking up for the steel sector. NMDC Steel, will it get divested in the remainder of this year? They've turned around things quite a bit. Utilization levels have moved up. So quick comment on that. And what about SAIL? If things are going to improve, could we see an OFS coming in?
So NSL, yes, you're right. They have significantly improved their performance. In fact, in last 1 year, they have almost reached now almost 100% capacity utilization on the hot metal side and roughly 80 to 90% capacity utilization on the mill side. So they have improved significantly. On the divestment issue, the decision of the government still stands. As you know, there is a cabinet decision that NSL will be divested. So that decision still stands. How fast it will move, I would not like to it's not Ministry of Steel which undertakes the process. So that's for the DPUM, they can comment on that. On SAIL, yes, they are doing good. One thing which about SAIL that now they are focusing on mining too. They are in fact the second biggest miner of the country of iron ore, and now this year they have been given a target to also sell iron ore in the market and increase their iron ore production significantly. So both on the iron ore side, mining side and steel side, I would think that SAIL will improve and show significantly better results. They are also planning a lot of expansion. So I would say that in this year, they should finalize decisions on those capacity expansions.
Okay, interesting to see if things are looking up, whether there is some OFS that will be due. But we appreciate you joining in, sir. You're sounding optimistic on the prospects. Maybe the domestic steel consumption could grow by around 9 to around 10%. The ingredients are in place, and the government of India has put in some good protection measures, which saves us from what's going on the global uncertainty front. Thanks a lot for joining in. Well, on that note, we'll slip into a short break. On the other side, we have Kamlesh Jain, the CMD of Jain Resource Recycling, who will be joining in to talk about their 1,250 crore rupee IPO that opens up. Stay with us.
Welcome back. Well, as promised, let's get to the conversation around a new IPO, another company coming to the street. Jain Resource Recycling is coming out with an issue, which is about 1,250 crore rupees. The IPO is opening out for subscriptions today. Kamlesh Jain, Chairman and Managing Director at Jain Resource Recycling, is with us. Mr. Jain, thanks for joining in. So we want to, of course, understand the company a little better, and we have 3 key talking points. Let me lay them out for our viewers. Of course, we want to understand the purpose behind the fundraising capacity, the fundraising activity, your current capacity utilization and the scalability of the business, and of course, what you see ahead for your margins. So let me start by telling our viewers that this IPO is a mix of an OFS as well as a fresh issue. The offer for sale component is slightly larger at 750 crores. Fresh issue is 500 crores. That's the money going towards the company. So tell us, sir, this 500 crores, what's the utilization? Why did you feel the need to come to the market?
So good morning. So we, out of this 500 crores utilization, we are going around 375 crores will be paying to clear our debts, and around 125 crores will be general purpose in the company.
Okay. So, all right, got that. So you will be paring down some debt. Let's also focus on what the company does. And Nigel has been explaining this to us. So basically, you are into the recycling segment in the non-ferrous space. So tell us what your further expansion plans are. I know you can't give very specific numbers, but what is your current capacity utilization? How are you planning to scale up the business? Do you have some clear capex plans ahead?
Yeah, so we have current capacity around 3 lakh tons of non-ferrous metals recycling, out of which I feel we'll be utilizing around 70 to 75% capacity utilization. And we have expansion plan for copper product, mainly for copper cathodes, copper wire rods, and bus bar, and other value chain. So the expansion will be the money come from expansion will be internal accruals only, and the balance 500 crores which I already explained for going for in the company. Company is going to
Okay, got that, sir. Good to have you on the show, Mr. Jain. This is Nigel on this side. Quick couple of questions then. You said 375 crores will be the debt reduction. So assuming that interest cost will get saved will be roughly around 40 crores, 35 to 40 crores. That would be a fair assumption, right?
Yeah, approximately you're right, around that percent for the bank CCLP, they're going to reduce it. So we'll save the 40 crores.
And post this repayment, what will the debt number come down to?
What was the question?
Post the repayment of 375 crores, what does the net debt come down to?
The net debt compound to will be around 500 crores.
It'll come down to 500 crores. So currently you're saying it's around 875 crores. Post this repayment, it comes down to 500 crores. You got that, right? Yes. Okay. All right. Tell us how the revenue mix will look. As you're saying, the focus is going to be on copper for further expansion from here on. Currently, it's broken up into lead, copper, as well as aluminium. So what is the ideal revenue mix you're looking at? And also in terms of capacity from 3 lakh tons, if I got that number correct, where is that number headed, say in the next 2 years?
So out of the revenue mix, you're saying we are majorly doing copper, which is around 45 to 50% around copper. And the balance is around 40% lead, and the rest is aluminum and plastic. And our focus, of course, on expansion of the copper. And in the future, we'll be expanding more in copper, which I have explained to you. And the revenue will be going up more for copper. And I think it will reach to 60% of total revenue will be copper.
Brilliant. All right. So we got that in place as well. Could you tell us what is your target in terms of market share? We have some brief numbers for every segment, but you must be having some target in mind. So if you could help us out with that number. And since we're talking about your revenue mix, exports have been gradually going up. What is the targeted domestic export mix you're looking at?
So we are looking around 60% exports. What is the last year performance we have? So we are planning to go more for export side, of course. And domestic market is growing as India is growing very fast. So we also have a lot of requirement of copper and other metals in domestic market also. And my focus more will be on to grow the export, because we are sitting in a port which is in Southeast Asia, and the freight is very negligible to all those countries. We export to Japan, Korea, Singapore, China, and many other countries in Southeast Asia. And the freight to these countries are very marginal from Chennai port. That gives a cost advantage to us for exporting more material than selling domestically.
Mr. Jain, good to have you with us here, and good luck with the IPO. Just a quick word, you know, F5 25 over 24, there seems to be dramatic improvement in numbers. You know, revenues are up 60%.
Yes, you're right. So what happened in our business of recycling, we have to source more and more. Sourcing is the key point in our business of recycling. We can sell as much as possible. There's a thing called order book here. It's only purchase book. So our sourcing gone up in last 2 years because of the global sourcing, and we have increased the team network in many parts of the Western countries, mainly US and other part of the South America. And because of this, the lot of the cultural shift and the technological changes and the technological disturbance, a lot of products become dismantled, and that's why our sourcing is going more and more up. And we already have enough capacity. We always keep 20% capacity spare to get more raw material. That is why the revenue is going up, because of this more sourcing of raw material.
So just a quick question. Capacity is around 140,000 right now?
No, it is around 3 lakh ton total for including lead, copper, aluminium, including everything. And we are utilizing around 75%.
Okay, all right. Okay, got that out of the way then. Are margins better in exports compared to the domestic business? And also, we have got a listed peer, which is Gravita. They are doing relatively better margins, though I think in size you are a little bit bigger. So do you have levers in place to improve your margins from here on?
Yeah, so in the business of recycling, it is about scale. So when you more and higher the scale, lower the cost of production and better EBITDA margin. That is the simple funda of this business. So we have to do more and more sales and increase our production. Now, of course, the peers, the Gravita is not exactly like us. We are 60% in copper and around 30-40% lead. So we are alike to a certain portion, but not 100%. And export margins are better because of the low freight, and it depends on the prices of the LME. So wherever the demand, we sell our product wherever the net landed price to us. When we compare that, based on that, we sell our finished goods to the domestic market or export market.
Okay, all right. So part of this is also an OFS. Do the promoters have any kind of plans to infuse some more money back into the company since business prospects are looking so good?
If company requires, we definitely pump the money more. But I don't think company require the cash because they got enough cash to grow. Okay. And right now the internal accruals are very high. So I don't think company will be requiring extra cash in the business.
Okay, all right. Just a thought, sir. Since there is some money that's going back to the promoter entity and some part of it is going into the company as well. We appreciate you joining in, sir. Debt is going to be coming down drastically. You're sounding optimistic about business. And as you said, the focus is going to be on the copper part of the business from here on. As volumes and value picks up in terms of sales, the margins will improve. We look forward to speaking to you, sir, on listing as well.
Thank you, sir. Thank you very much.
Okay, all right. Well, let's go back to the markets. Then we have Vinay Rajani, the Senior Technical and Derivative Analyst of HDFC Securities, who joins us. Hi, Vinay. Thanks a lot for joining in. Markets down 100 points. Buy the dip or not?
Yes, so we have seen 400 points correction from the recent swing high of 25,448. So if I were to see the retracement levels, the Fibonacci retracement levels of the entire 1,000-point rally, which we saw from the level of 24,400 to 25,400 odd level, 38.2% retracement comes in at 25,050, and 20 days exponential moving average for the Nifty is also coinciding around that level, which is placed around 25,045. So a couple of evidences which is suggesting a strong support in this range. So yes, I think the way some sectors are still performing well, PSU banks, metals, and some power stocks have started participating in this market. So I think this is an opportunity. I think from this level, considering the strong support from a couple of evidences, it looks like that one can go long from here. I would suggest a stop loss at 100 points lower from this level. So around we can say 24,980 to 25,000 should be the stop loss in trading long position, and overall we can expect some recovery from this level. So yes, there are many opportunities in the in this particular market. Even in the correction, we can see some stocks performing well. So yes, one can take long bet with a stop loss of 100 points in the Nifty.
Vinay, in terms of specific trades, what would you have?
Yeah, so some stocks are performing very well, like the power stocks have started performing. So NTPC has given a fresh breakout from the consolidation. It looks good on the chart, on the short-term charts. So NTPC can be traded long around 344. I would suggest a stop loss at 338. On the upside, I'm expecting a target of 354. Second pick I would take from the PSU bank, which is continuously doing well. The Bank of Maharashtra is looking quite good. There has been a downward sloping trend line breakout on the weekly charts, and I think this stock can do well from the mid-cap PSU bank segment. So around 57.41 can go long. I would suggest a stop loss at 56. On the upside, I'm expecting a target of 59.50 in next couple of sessions. Thank you.
Got that. Let's... Vinay, thank you very much for joining us. Good speaking with you, and good to have you with us. Well, markets down about 80 odd points. 1,400 stocks are lower on the NSE. About 1,280, 1,290 stocks are higher. So that's where we're looking at as far as market breadth goes. We take a break. We are back. Commodities in focus. Manisha is going to be joining us to help us with that. So stay tuned. Coming up.
Welcome back. Equity markets still dealing with a cut of about 0.25%. Let's find out what's happening in the world of commodities. And we have Manisha joining in with the latest. Manisha, what do you have your eye on this morning?
Well, I'm looking at precious metals, not gold, not silver, but it is platinum, which really seems to be surging in the overnight markets. So even as gold and silver have taken slight pause at those all-time highs, look at what platinum has done. 5% of gains in the overnight market. You have 8% up on a week-on-week basis. It is 12% up on month. It is 67% up in this year. So it has clearly outperformed most of the other commodities. And we're looking at 50% of gains coming in for platinum in the last 12 months as well. So very, very strong gains coming in for platinum there. Well, if you look at the overall markets, as I was telling you, platinum clearly outperforming with 67% of gains. You have silver, which is 53% higher, all-time highs in India and 14-year highs in the international markets. Gold is trading at an all-time high in various countries, but is up 43% for this year. And then you have palladium as well, up 40%. So it clearly belongs to precious metals when you look at 2025 as a year. But I want to focus on platinum right now because if you look at the global supplies, they are the lowest in last 5 years. We have seen constant deficits continuing into the market, and the weak US dollar has been supportive. And when you look at platinum, the buying also has increased because it's relatively affordable than gold. It's trading at around $1,495 an ounce right now, and gold is at around $3,800. So as you can see, it's nearly half of what gold has been. So clearly the affordability comes in from there. The platinum prices are trading at an 11-year highs, but very far from its all-time highs of $2,166 an ounce. And we are currently trading at around $1,500. So really far away from those all-time highs in case of platinum. But the way the fundamentals really seem to be working clearly are supportive. There is a statement from World Platinum Investment Council which says that after last year's big deficit that we saw into the markets at around 992,000, this year as well could look at 850,000 ounces of a deficit. That clearly has been supportive there. When you look at the platinum uses, while of course it is more of an industrial metal and 45% of usage comes in from automotive, but jewelry as a demand continues to increase as well. So 27% is a hefty number when you look at platinum in sense of jewelry demand. And then you have industrial, 20% comes in from there. Investment seems to be surging as well. 7% of platinum now goes in investment, and hydrogen economy consumes nearly 3%, which also is expected to go higher. With deficit and then demand increasing, platinum perhaps should be on your radar as well.
Why should gold and silver have all the fun, right? Why should platinum be left behind?
Well, that's the state of play. Precious metals, precious commodities getting even more precious by the day. Well, we'll take a quick commercial break here. On the other side, our special segment is the economy. Latha in conversation on the impact of H-1B visa fee hike and the fall in the rupee sharp fall yesterday. Samir and Chakrabarti of Citi and Chandresh Jain at BNP Paribas on the other side, joining her in just a bit.
Welcome to It's the Economy. The rupee took a sharp knock on Tuesday, hitting a new low of almost 88.80 and losing over 0.5% in one day. That's an outlier kind of fall. Trading today has begun on a steadier note, with dealers telling us that Reserve Bank is supplying dollars. But the market's fears are what may be the future cause of remittance inflows, current account and capital account deficits. That remains the big fear. Citibank has put out a comprehensive note on remittance flows from the US alone, though, as they say in the report, some of it is based on educated guesses, since we don't have exact data on how many are H-1B visa holders and what is their annual remittance. I have with me today the author of that report, Samiran Chakrabarti, the chief economist at Citi India. I also have Chandresh Jain, the head of FX trading for BNP Paribas, to understand both the current account deficit issues and, of course, the cost of the rupee. I'll come to the arithmetic in just a minute. Samiran and Chandresh, thank you very much for your time. Chandresh, if you can just tell me what is the, sentiment you're getting on the trading desk. Do you think people are going to come and buy out more dollars?
No, I think the sentiment is not very good. We had a lot of negative news regarding INR. It started with equity outflow, which was there in the last 3 months. Then on top of that, we got 50% tariff from US. And now the big news of H-1B visa hike. It's certainly bad for remittances, but it's also bad for INR as well as an overall concern. And lastly, I would say even, the gold prices, which have been going higher, I think that's also playing a part, because India is a net importer of gold. So as gold prices go higher,
Chandresh, I'm just asking you, at the moment, since the fall has happened,
yes,
we are, so much has been priced. Are you looking at 89 as a likelihood? Are you looking at more depreciation from here?
I think the more depreciation will come. So like I said in our last communication, 87 to 89 is our range target. Okay. I think we're very close to that. I think the trend will continue. The velocity of the depreciation might slow down in October.
Okay.
That's
okay. Samiran, now for the big math. I know some of it is guesses, but some of it is hard data that you have in terms of number of amount of remittances from the US. Just take us through the math. Because of incremental H-1B visas not being given, let us assume it is zero, what may be the impact in terms of inflows?
So thanks, Lata. And let's start from the beginning, that there are 3 different channels through which it will play out. Okay. One is the remittances channel, the second is the software service export channel, and the third is the professional management and consultancy services channel, which is roughly known as the GCC channel. So first on the remittance channel, right now, about 28% of India's remittances come from US, which would tantamount to about $35 billion a year of remittances. Now, our educated guess is that H-1B visa holders are not the majority of remitters. Okay. So our sense is that even if the subset that will get impacted by on the remittance front will actually be much smaller than what the market is fearing right now. And then comes the 2 other components of software service exports and GCC. Here, it could be a bit of one losing, the other benefiting. So if some of these revenues on software service exports are lost, there could be a nearshoring and onshoring of those activities in the GCCs. And then the GCC exports might go up to that extent. But this is the one which will play out more quickly. The remittance one anyway will take some time to play out, because the existing H-1B visa holders will continue to remit. And so that's where, although if you look at it from a top-down perspective, the total exposure of these 3 segments to US is 4.5% of GDP, a very large number. But actually, in the short term, the impact might be more limited, is what our sense is. Over the long term, from this limited current account perspective, our worry is that earlier what was happening was that remittances were very correlated to oil prices because most of our remittances come from GCC. Now that correlation had broken down because the North America, Europe kind of remittances went up quite substantially. Now, if that channel of remittances come down, then maybe we go back to that oil price correlation again on remittances, which could make that the fantastic growth that we had seen on remittances that might come down. My last point is that the importance of these three components on the current account is well understood. If you just see that today, these three components are about 10% of GDP in the current account inflow. And this was about 2.5% lower pre-COVID. So the entire improvement that we have seen in the current account post-COVID is largely due to this component. So we might go back to the pre-COVID type of 1.5–2% of GDP current account if this delta on this gets impacted by the H1B, but that's a more structural discussion.
Okay, yeah, I agree with you. Up until recently, we were all talking about 2–2.5% as current account deficit as a percentage of GDP. And it was a pleasant surprise that the last 2 years, we are talking about even less than 1%. That happy period perhaps will go away. But Chandresh, as Samiran points out very elaborately in his math, the remittance inflow itself is 35 billion from the US, from the various visa holders. Of this, the incremental growth only is going to be disturbed. Remittance itself doesn't look like big. What is the sentiment telling you? Why are FPIs selling? Is there a feeling that the rupee will get weaker tomorrow even more? So let me sell and buy back. Is that kind of a sentiment playing out?
See, the thing is, it's not just the H1B visa issue. I don't think that's a big mover for the market. I think it's the overall sentiment, which is bad for INR right now. Like I mentioned about tariff situation or the equity outflow. People are just worried about how inflow will come back when you have all the negative news coming back. So that's why I think the trend will continue. It's the velocity might come down because you also think about October month, which we are very soon going towards that. In October month, generally, the dividend repatriation is also quite low. So that means the outflow might also come down from that perspective as well. So we think there is a slowdown which will happen on the depreciation path now.
Okay, that's good to hear. Sabiran, there's another angle which none of us look at much. The rupee depreciation also helps exporters and discourages imports. It has its own market way of reducing the current account deficit. But more importantly, with China versus the renminbi, the rupee is at its lowest. It's almost 12 rupees 50 paise for a renminbi. And until recently, we used to look at 10–11 as the average. Now we are sharply lower. Plus, China has opened something called the K visa to everybody, where it is ready to give anyone a visa. Will all these also ameliorate and improve our CAD, our current account deficit, both the market and the fact that China is acting as a counter attraction?
So in fact, very recently, we have done a detailed report on trying to find how much rupee is undervalued against different currencies. And one of the findings of that report was that the undervaluation with respect to dollar is actually not that big. Rupee is much more undervalued compared to the non-dollar currencies, where our estimate is that that undervaluation could be at a historical high now. Now, that obviously makes Indian exports much more competitive into those markets, especially when, because of the tariffs, there is likely to be a rotation of exports out of US into those markets. It is possible to imagine a situation where Indian exporters will benefit out of this relative depreciation. Now, so in that sense, this exchange rate depreciation is an offset against the tariff. However, the critical balance is that this expectation of depreciation often begets more depreciation. And in that context, from an investment flow perspective, the investment flows might get deterred if, at least on the fixed income side, investors start fearing that there is a a certain amount of depreciation around the corner, which will eat into the returns. So that delicate balance is to be struck between how much relative undervaluation we can keep on INR versus how much we should bring it back. In general, I think the second half seasonality is better on the flows and trade deficit numbers. So that could itself be some sort of a buffer.
Okay. Yeah, I guess that explains why today the Reserve Bank apparently, the dealer talk is that they're heavily in the market. They are offering dollars both in NDF and in the local market. Chandresh, you want to add anything on that? You heard this too?
Yeah, we heard as well. I think RBI is trying to, sell dollars on that level. But I want to go back to your point on, versus CNH. I think there's another way to look at it. That way is probably if you look at INR on a REAR metrics, which is real effective exchange rate, and try to plot it versus CNH REAR, you will see India and INR is actually still quite expensive.
Oh, okay.
And it can depreciate even more from here on that basis itself.
Okay. Yeah, actually the CNY, I don't know about the CNH, I didn't do the calculation. CNY has appreciated a lot versus the dollar. So perhaps that gives India more room to depreciate. A very quick final question, Samiran, the other offsets that you mentioned in your note are very interesting. Can you just take us through? Fewer people will go to educate themselves in the US, fewer outflows.
So, I mean, part of it is related to the external sector, part of it is related to the domestic economy. On external sector, one of the offset is obviously that the education-related outflow, which was about $6.6 billion last year by our estimate, that number could come down if people think that there are not enough good jobs available after that education. And on the domestic demand side, one offset could be that if the software companies are paying a higher proportion of their wage cost in India now rather than paying it abroad, then that could spur more of urban consumption in India, which right now is slightly a soft spot. Obviously, these things take many quarters to fully play out. But yes, over the longer term, this could become important issues to track.
Okay, but anyway, it's good that you have put all this on the table. Chandresh, thank you as well for putting out even that CNH equation. And to just point out that things are not bleak. The market corrects a lot. And we could see the market correction itself bringing down the current account deficit because of the depreciation of the currency. It's an ongoing conversation, and I will take a rain check from both of you to invite you all oftener, given the season we are in. Thank you very much for joining us. Wrap up on Bazaar. Short past is coming.
IT stocks trade with cuts after the U.S. Department of Homeland Security proposes to change the H-1B visa selection process. Tech Mahindra, Coforge, Persistent, they're all under pressure.
Shares of Swiggy trade under pressure after the company said its board of directors approved divesting an entire 11.8% stake in cab aggregator Rapido for nearly 2,500 crores.
Shares of Minda Corp surged as much as 8% after the company unveiled its Vision 2030 roadmap, projecting its revenue to more than triple by 2030.
Bajaj Electrical zooms in trade after the company clears proposal to acquire the brand rights and intellectual property for Murphy Richards for a sum of 146 crores.
Sri Lotus Developers gains in trade as Motilal Oswal initiates coverage with a buy rating with a target price of 250 rupees per share. Brokerage says the company has established itself as a key player in the society redevelopment space. Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, and with me today is Ekta Batra. Well, Ekta, market is a little bit under pressure. We're off the lows as well. Par for the course, one would say.
Hi, Nigel. Yes, another day you'd have to say of, mild profit booking because there has been a recovery from the day's low for the Nifty. So currently just about around 25,100. So we seem to be holding those levels at this point in time. For the Bank Nifty, showing a little more pressure. So down around 0.4% for the Bank Nifty at this point in time. But we do have a lot to get through in the next 30 odd minutes. So let's kick off the show with Chandan Taparia from Motilal Oswal Financial Services. He joins in for a technical check on the markets. Chandan, hi, welcome to the show. Well, it's turning out to be a day where the Nifty is just about trying to hold 25,100. What's your sense in terms of a technical call today?
Yeah, good morning, Ekta and Nigel. Thanks for having me. So Nifty continues losing a streak for fourth consecutive trading session and corrected by around 400 points from its recent swing high of 25,448. The good part is that major trend of the market is positive to range bound, but intraday is likely to see some sort of profit booking at higher levels. The good part is that 25,000 could act as a major support. So I believe the ongoing decline might arrest or may attract the buying interest near 25,000. In that scenario, it can see a bounce towards 25,250 to 25,350 levels. Talking about selective stock specific, positive on the Nifty PSU banks, or in fact, the entire CPSE index looks good. PSU index has rallied well by more than 12% in this month. And most of the stocks are showing sign of this trend. So first trade will be buy on Canara Bank. This stock has been making high top, high bottom on the daily chart, really well, given a major consolidation breakout on the weekly, monthly, and the quarterly chart. So we are recommending to buy on Canara Bank with a stop loss of 121, and it can head towards 130 level. Second trading area, there is buy on NTPC. After a long time, this stock has given a consolidation breakout, and this breakout is happening after the consolidation of last almost 17 weeks. It managed to surpass the multiple hurdle of 344, and now the long build-up is being built with the put writing activity. So stock has potential to see the next leg of rally. One can buy with support of 340, and this power counter has potential to rally towards 362 kind of level. Last trading idea, there is buy on AB Capital, one of the strongest counter, which is holding near its recent lifetime high. Major trend is positive, and every small decline is being bought. It is also holding well above its rising support trend line. So expecting next leg or rally in the counter. One can buy with support of 290, and this stock can head towards 310 kind of levels.
Okay, all right. Got that. Thanks a lot for that, Chandan. Well, let's go to our special segment. We get a few ideas for profit from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock that he's tracking closely. Sachin?
Container Corporation of India, or CONCOR, which is the largest container freight operator in the country, delivered a muted financial performance in the first quarter of FY26 with a revenue growth of just 3% year-on-year. Well, the stock of the company has also underperformed in recent months, primarily due to announcement of tariffs by the US government on Indian exports. Well, given that CONCOR has a significant exposure to the export-import overall trade basket, the company is likely to have a potential impact in the next 1 to 2 quarters. However, we expect these trade issues to get resolved in a few months, which should pave the way for volume recovery in the next fiscal year. On the domestic front, the company continues to remain on a very strong footing and is looking forward to initiate the transportation of bulk cement through containers. The company is also looking forward to add new last mile services as well as has entered into shipping arrangements with new partners to be able to grow the business volumes. Well, the trade issues have had a negative impact on the company, and the stock price has also taken cognizance of those factors. Nonetheless, the company has an aggressive expansion plan, is aspiring to reach around 70,000 containers by FY28, along with 100 terminals. Overall, company continues to remain on a very solid footing and is trading at around close to 28 times 1 year forward earnings, which we believe is reasonable for accumulation from a long-term standpoint.
Okay, all right. On that note, we're going to take a short break. But up next, stay tuned because we have the team of EPAC Prefab Tech. They are heading to the primary markets. We'll be discussing their IPO on the other side. Stay tuned.
Well, the IPO market has been very, very vibrant, and we have a new IPO on the block. That's EPAC Prefab Tech IPO that's opening up for subscription today. To help us out with details on the company and the vision ahead, we have Mr. Sanjay Singhania, the MD and CEO of the company. Mr. Singhania, thanks a lot for joining in. Well, before we come to you, just wanted to highlight the broad points we're going to be focusing on. Point number one, utilization of IPO proceeds. Point number two, the capital expenditure in manufacturing facilities. Point number three, business. How will it shape up on the whole? So those are the top talking points. Well, Mr. Singhania, thanks a lot for joining in, sir. I'm looking at the money that you're raising for the company that will be used for two purposes. One is debt repayment, I think to the tune of close to around 70 crores. So could you tell us what does the net debt come down to post the 70 crore repayment? And also you're going to be using part of the proceeds to expand capacity. So what is the asset turnover that you see on this investment of 150, 200 crores?
Yeah, great. So thank you so much for having me on the call. Good morning. And the proceeds of the IPO will be used in three buckets. So as you rightly said, 70 crores is going towards debt repayment. The net debt position of the company as of now is 53 crores only. And post IPO, post repayment, the debt equity will be rather negative for the company. So that is in a very good situation for us. As far as the other bucket is concerned, the company is putting around 160 crores in capex. That is on two plants. First of all, we are doing a capex of 60 crores in brownfield expansion in our Mumbaku, Andhra Pradesh plant. There we are ramping up our structural steel fabrication facility by 36,000 tons, and post IPO proceeds utilization, and the structural steel fabrication facility will have around 170,000 tons of capacity. And the other manufacturing unit that is coming up is a greenfield project coming up in Gilor, Rajasthan. There we are investing around 100 crores, and that is for insulated sandwich panels. So these sandwich panels are the new age building material. These are the insulated sandwich panels, drywall sandwich panels, which are used for various applications like the clean rooms and cold chain and building facade. So with a lot of new age, like construction and building and factories coming up in renewable, semiconductor, so they will all utilize this kind of insulated sandwich panels.
Okay, just one question, sir. Just to confirm what you said, post this debt repayment of 70 crores, you'll become debt-free. Is that correct?
Net debt-free.
Got it. You'll become net debt-free. And point number two, the 160 crores that you're going to be putting up on the two plants, what is the revenue you can get? Asset turnover, what could it be?
So our asset turn as on date is around 4.5 for the prefab business, and which has a potential to go up to 6.5 to 7. So we believe that to post this investment of 160 crores, we should be able to do somewhere in the range of 800 to 1,000 crores revenue.
All right, Mr. Singhania, I just wanted to get one particular issue out of the way. There are certain issues which have been brought up in your RHP with regards to non-compliance of regulations raised by the UP Pollution Board. Where does that particular issue stand right now? And is it impacting business at all?
Yeah, it was an issue about 2 years back. So thereafter, we have changed the technology of our boiler that was related to the packaging vertical which we have in this company. So now it has been sorted out. We use biofuel in our boilers now. Yeah.
Okay. The other thing is that if you could just highlight what your pending order book is. We understand that it was around 900 odd crores. If you could break it up for us in terms of, where exactly the order book stands at this point in time, the execution timeline, and what the pipeline of orders might be looking like for you all, to the best of your ability.
Yeah. So the order book as on 1st of April 25 for us was around 910 crores, and order book to revenue ratio for us has been 1.5. So it means, if we have a opening order book of 900 crores or 910 crores, then we can typically do a business of say 1350 to 1370 crores. And this year, in particular, the last 6 months has been very good for us. We have been getting some great orders, especially from renewable energy and FMCG. So the future also looks equally promising. And the best part about prefab has been that we have grown 5 to 6 times on the industry in the last 4 years. So while the industry grew by 8 to 10%, we have been able to grow the prefab business by almost 55%. So I think with the current order book and the way we are booking the orders right now, the momentum is going to continue for the next few quarters as well.
Okay, exports are very small. You know, they're actually zilch as a percentage of your revenues, 0.2%. But you're saying there's a potential over there. Target out here, where does the export number head to?
Yes, you're right. The exports for us is minuscule at this moment. For this, overall the exports from India for the prefab is growing little slowly. And as at this time, the markets mainly are in the GCC and the South nations. We have put up a facility in Andhra Pradesh last year. Just it's around 45 kilometers from the ports. So that gives us an advantage in terms of logistics and the ability to export. Prior to that, both the plants were in North India, so there was a logistics issue. We are working on exports, but at this time for us, thankfully the domestic tailwinds are so strong that even if we are able to focus on domestic market, then still we can grow at a very considerable pace.
You did mention very strong growth in your prefab business. Just wanted to understand these kind of growth rates, even for example, what you've seen since FY23, an EBITDA of around 51% CAGR. Is this sustainable? What can you guide on in terms of, say, a sustainable growth rate on a longer term perspective for the company?
See, there are huge tailwinds at this moment in our industry because of various, government schemes, the PLI on the factory side, the national logistics policy on the warehousing side, and acceptance of high-rise buildings, which are replacing the traditional conventional building construction. So, because of all these factors, there are huge tailwinds. Yeah, as per our understanding, our industry is growing at this time by about 15%, and we will definitely build this, growth of the industry will do much better than the industry in the coming period as well.
Just one factor, sir. There have been various issues in the past with the UP Pollution Board and various other factors. Any risk to the business? All these, is the company dealing with any sort of issues that you'll have had in the past with regard to this, or any regulatory issues so your investors don't need to be worried about?
See, this pollution issue which you're talking about is related to the packaging division. The packaging division contributes less than 15% of the revenue for the company last year, and it will be further less because of the rapid growth in the prefab division which we have. And this issue is the past. It is no longer there. We have got all the clearances and we have changed the fuel, so it is no longer a concern for us here.
Okay. All right, Mr. Singhania, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's EPAC. They've raised around 150 crores from anchor investors, in fact. And let's see, it's in the prefab segment. Not much in terms of exports at this point in time. 70 crores of the funds which are going to be raised will be used for debt repayment. The total size of that is around 504 crores in terms of the IPO. We'll take a short break, but we'll be back with a lot more stocks in focus. Stay tuned. Welcome back. Well, definitely a weak day for the markets. We have the Midcap index, which is trending a bit lower now, so down around almost 0.5% as we speak, and an advanced decline ratio, which is on the weaker side. We just want to point out one particular stock within the Nifty space, which is Sun Pharma, which is managing to hold its head above the water. Now, Motilal Oswal has come out with a note on Sun Pharma with a buy and a target price of 1960 odd rupees. And a couple of takeaways from the management meet include that their specialty growth will be a key, will be a key growth driver for Sun Pharma going forward. And the US FDA regulatory issues at Halol are currently being addressed. They maintain their FY26 revenue growth guidance of mid to high single digits. Earnings are expected, according to Motilal, to grow at around 14% CAGR. So that's on Sun Pharma, just about holding at around 1633 odd rupees. We do have Sudarshan now with us. He's joining in to talk about Minda Corp, which is in focus. That stock is buzzing on the upside today. Sudarshan, tell us more.
So Minda Corp has yesterday released vision document for 2030, setting some of the ambitious target. And on revenue front, it sees revenue increasing by almost 4 times by 2030 to rupees 17,500 crore from current level of rupees 5,100 crore. It believes that margin too may increase to 12.4%. That would be an increase of almost 100 basis points. On net debt to equity ratio, it believes that it might decline to 0.3 times from the current level of 0.6 times. And on ROCE front, it might increase to 25% from current level of 20%. Apart from these targets, company has talked about the contribution, and it says that contribution from passenger vehicles will increase significantly to 25% from current level of 14%. And in contrary, contribution from passenger vehicles, commercial vehicles, two-wheelers and three-wheelers will be coming down going forward. Some of the growth drivers also it has talked about. First one is that company will focus on premiumization. Kit value is going to increase and it might double in next 3 years, that is by FY28. On an exports front, it's targeting CAGR of 37% from the current level of 18%, or say 18% that company achieved between FY21 to 25. So these are some of the growth drivers apart from the targets that company has mentioned. On the back of these, stock is higher, currently 8%.
Okay, all right, sir. Thanks a lot for giving us that input. Well, let's focus then on the India-US trade ties. And speaking at the US-India Strategic Partnership Forum, Commerce Minister Piyush Goyal spoke on increasing energy imports to the US and unlocking limitless possibilities with the US on various fronts beyond energy. Let's listen in.
The world recognizes that this is one area where we all have to put together. India is a very clearly energy trade, as Patricia just mentioned. We are big importers of energy from across the world, including from the US. We expect to increase our trade with the US on the energy products in the years to come. And be close friends, natural partners. Our energy security goals will have a very high element of US involvement, which will ensure price stability, which will ensure diversified sources of energy for India, and help us unlock limitless possibilities with the US on various fronts, energy and beyond.
All right, that's the Commerce Minister. But on that note, we need to wrap up on Chartbusters. Stay tuned. Trading Hour will be up next.
Good morning. It's time for Trading Hour. We are just getting done with the first 2 hours of this midweek trading session, and it is yet another down day for the index. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I am Hormus Fatakia. With me is Reema Tendulkar. Reema, good morning. Another 100-point downtick on the Nifty today. But still, we're trying to hold on to 25,000. So latching on to some bit of positives if you can, but not so great for the market so far.
Indeed. And now we're down for the fourth day in a row. And this week, the Nifty is down 1%. The Midcap index is down 1.5%. And the problem is all the sectors are pretty much weak. The Nifty Auto Index is down about 0.7%. IT is under pressure. In fact, third day of losses. And this week, the IT index is down 4.5%. First came the blow of the hike in H-1B visa. And now there is a proposal to change the lottery system to a weighted average system, which in a way will effectively increase the wages of H-1B workers. So that is the additional, that's where the additional pressure is coming in on Nifty IT. And banks too are weak in trade. 350 points gone on the Nifty Bank, and that is at 55,178. So it's a bit of a struggle this Wednesday morning. Let's see how the day pans out. But for now, we've got a management waiting by. Now, Zaggle recently partnered with AU Small Finance Bank and MasterCard to launch retail credit cards. Avinash Godkhindi, MD and CEO of Zaggle Prepaid Services, is now with us on the show. And the discussion points will be if the company will increase retail card penetration, will the company exceed the 35 to 40% top line growth guidance that they shared with us last time, and the update on any acquisitions. But Avinash, morning, this is Reema here. Let's get to the first point, right? Is this the first retail credit card that the company is launching in partnership with a bank? And what are you hoping to achieve? What are the numbers looking like? And what's the future on retail credit card? Because up until now, you were known for your corporate credit cards.
Yeah, good morning, Reema, and thank you for having me on the show. Look, retail cards, yes, AU Small Finance Bank now, which has got an in-principle license to be a universal bank, is our first partner in the retail card space. We've also signed a prepaid card, co-brand prepaid card agreement with them, and also a partnership on the commercial card. So it's a very holistic partnership where all three aspects are covered: retail credit cards, commercial credit cards, and prepaid cards. The idea is to be able to leverage our extensive user base on a B2B2C model. Zaggle has been acquiring users consistently. We have more than 3 million users today, and we keep adding high-quality customer users who are employees of blue-chip companies. And that's a great base to go after to be able to offer a retail offering where the focus is to be able to leverage UPI and with our in-principle TPAP approval. All these pieces come together. As you're also aware, we recently acquired Rio Money, which allows us for a co-brand with Yes Bank as well. So those are all the pieces that are coming together for us.
Okay, just to get some more details. Now, suppose if any person spends about 100 cards on this retail credit card, how much will you make?
Well, it's the retail card business. Apart from investment banking, Reema, credit cards and retail credit cards are the most profitable business for banks if run properly. And I used to run Premier Miles, launched and ran Premier Miles with Citibank. So many of us in Zaggle know how to run a retail card portfolio. Many of them know it much better than me. So
what would you make on 100 rupees worth of spends on the card?
So end of the day, we get obviously the lion's share in terms of interchange. We also get a acquisition cost, and as we go along, we'll dip into other revenue pools as well from partner banks, right?
So you can't share the numbers as of now.
Of course.
All right. Sorry, one more question on this particular. Are you looking at launching more retail credit cards in partnership with other banks?
Right now, we have had a whole host of conversations with multiple banks. EU is a very strong partner for us. But it is a non-exclusive agreement, and there are other conversations that have happened in the past and are ongoing. So yeah.
Avinash, thank you for joining in. Since Rima mentioned about, you mentioned it's a non-exclusive agreement. So are there any more exclusive ones in the pipeline, not just for retail credit cards, but for other businesses as well? You had mentioned that you continue to remain on the lookout for more acquisitions in the pipeline. So is there something more that we hear from you soon enough?
Oh, you will, but we don't do exclusive or we don't offer exclusivity to any of the networks or partner banks. We believe in a very democratic approach where we like to partner with multiple partners. It allows the partner banks and networks also flexibility, and it allows us flexibility to be able to run various programs with them. With regards to acquisitions, yes, you will hear more from us in the coming quarters. And with regards to growth, we've already upped our guidance during our AGM to 40 to 45% from 35 to 40%. So that's a guidance that we've given during our annual general meeting. And happy to share with your viewers that we have upped our guidance as well on growth. This is organic growth.
What would that guidance be now that you have upped it?
It's 40 to 45%. It's 40 to 45%.
40 to 45%.
Yeah.
And what about margins?
Margins, we have committed 10 to 11% for this year, and we should be in that range for this year. Yeah.
Got that. Just getting back, earlier we had seen some co-branding efforts were being paused by the regulators on account of data sharing concerns. Is that a regulatory risk?
See, I think the regulatory landscape is very clear, Rima. And I think as long as banks and partners like us adhere to that framework, the framework is very simple. The product issuance is by the bank, the KYC, the underwriting. These are all elements that are taken by the bank. The construct itself is co-created. The sales and marketing and first level support are something that a partner can do. And that is what our focus would be, to co-create a great product and take it to our base of users. And as long as you're sticking to those guardrails that have been put by the regulator, I think everybody is happy.
But just coming back to that retail-focused cards a bit, Avinash, since you want to make it more attractive for your users, would that result in an impact on your gross margins going forward?
Yes, it would positively impact. It would positively impact our margins. As I mentioned, retail cards are highly profitable if run well, and you don't get too greedy. So I think that's the key there, to build a high-quality portfolio of users who are, and that's where the segment that we tap into is extremely powerful. Employees of, enterprise and mid-market customers. COVID taught all of us in the lending industry that's the segment that repays no matter what, right? So that's the safest segment, and we have that captive audience, and we keep adding those users. And we believe this is the best time for us to go after that base, to be able to offer, a unique value proposition.
So how much of your idle funds now do you have left for your acquisitions, Avinash? The last time we spoke, you mentioned somewhere around close to 500 crores. So how much do you have left now?
Yes, that money is still in the bank in our fixed deposits. That's a little over that's sitting there. But the current business doesn't require cash. The QIP was largely for acquisitions.
Right. Avinash, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year, and for looking forward to having you more often on the platform. But that's Zaggle for you. The key takeaway is the fact that they have upped their guidance now to 40 to 45% from 35 to 40% earlier, and they are anticipating margins to be in the 10 to 12% range. By the way, the markets have taken a bit of a dive now. At the start of the show, we were down close to 70 to 80 points. We are now down 140 on the index. So we are closing in on that 25,000 mark. mark, and that was the one that the index was still holding on to. The fourth straight day of losses now for the Nifty. Trying to hold on to that 25,000 mark, 140 points lower on the index. And of course, what's dragging the index lower? It's been IT, of course, as Rima was mentioning, right? It continues to be that pain point for the markets. The IT stocks, or the Nifty IT index, is now down 1%. That too is at the lowest point of the day. And among the top losers, of course, the two major private financials, HDFC Bank and ICICI Bank. They are the top two contributors to the downside on the Nifty as of now. HDFC Bank at the lowest point of the day, 1.5% lower. ICICI Bank too down to the lowest point of the day, 1.25% lower as well. Also dragging the index lower is Infosys, Bharti Airtel and Axis Bank. So index heavyweights are the ones, Rima, that are contributing to this downfall. But holding on to some of the gains include the likes of Maruti and HUL.
Okay, those are the few green spots in today's market. We will slip into a break on that note. On the other side, crypto markets with Manisha Gupta. Stay tuned.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
In Crypto Corner today, we are going to talk about various types of crypto really. So first on my list clearly is CBDCs, or it is called the central bank backed currencies. This actually is a digital version of a country's digital currency. It is launched by the country itself, the nation's central bank, that is. And this is something that a lot of countries really seem to have been talking about. India, for one, also has done a lot of work when it comes to central bank digital currencies, or CBDCs as it is called. Well, it works alongside the physical cash is the whole idea to do this. And then if you look at the various examples for this, we have seen many countries like Bahamas, Jamaica, Nigeria launch CBDCs very, very successfully. We have seen China do a lot of work onto this one as well. But the understanding at this point in time is that nearly 134 countries are currently working on CBDCs in various ways, whether it is to the work of pilots, projects or research as well. The second on my radar is the payment cryptocurrencies. In this, the coins run on their own blockchain. This is as good as digital money. And the top examples for payment cryptos are Bitcoin, which of course is the first one and the largest one, has a 57% dominance as well within cryptos. And then it is about Litecoin. The third thing on my radar is tokens. Now, these are built on existing blockchains. They do not have blockchains of their own, and they can be, they represent basically assets, or they do grant access to services. So they are mode of payment, but within a very, very native area there. The best examples onto this one are ERC20 tokens on Ethereum is the best example, as I said. Take a look at the third one, and these are stable coins. A lot is being done when it comes to stable coins, especially in US. The whole Genius Act in US revolves around the stable coins. Now, these are less volatile. They are pegged to fiat or tangible commodities behind that. Most of these stable coins are pegged to gold, silver, dollar, euro, treasuries, etc. And the best example onto this one is Tether and USDC with huge market capital at this point in time. And finally, take it altcoins now. Everything apart from Bitcoin within crypto as a scenario is called altcoins. Within this, there are unique features and innovations that many of these altcoins do over the other, whether it is about scalability, efficiency, money, or transparency for that matter, or speed that also comes in with it. Within this space, you have Solana, Cardano, Ripple, Avalanche, Polygon. They have done great work when it comes to altcoins. And with that, it's time for a short break. When we come back, we'll talk about more markets and stocks on the other side.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Still 115 points lower on the index and the Nifty now at 25,050. The PSU banks though, which were trading significantly higher at the start of the trading session, have come off the highs of the day. The PSU bank index at around about 10:30, these stocks were trading at 52-week highs. All of these names, be it State Bank of India at a 52-week high, PNB slightly close to its 52-week high, Canara Bank was at a 52-week high earlier in the day, so is Bank of Baroda. All of these stocks have made a peak and then they have come off the highs of the day. You can see that mountain-like pattern on the intraday chart. Same is the case for Union Bank as well. But good time to take a look at what the FNO trends are indicating. Sudarshan is now here from the FNO desk with that latest update. Sudarshan.
So market remains weak and sentiment has turned negative, and that's the reason that because of IT stocks continue to see a fall. Today also Nifty IT, if you see, down somewhere around the range of 2 to 3%, and all its constituents are down somewhere in the range of 2 to 4%. And till yesterday, financials were supporting the market, but today even financials have fallen because of big fall that we are seeing in private banks. PSU banks at one point looked like that they might provide a minor support, but in the last few minutes when PSU banks have come off highs, now put-call ratio is back around one level. So it tells you that like major activities we are seeing at all the put option, and on the call side we are seeing a huge writing. So two call options, if you take a look, 25,100. Premium has fallen to 114 from the level of almost 225. 25,200. Premium has fallen to 75 from the level of 155. Now come to put options. 25,100. Premium has increased to 111 versus 65, and 24,900 also is very active, where premium has increased to 44 versus 28. So at this point, it's looking very difficult for Nifty to even hold the level of 25,000. So for now, immediate support I have taken is 25,000, but the next support comes around 24,900. Resistance remains around 25,330. As far as Nifty Bank is concerned, support would be around 20-day moving average, that is 54,600, and resistance has now become 50-day moving average, that is 55,434. Three stocks I have taken amongst all the PSU banks. One stock is strong because it has been giving even a strong quarterly results. That is the Indian Bank. It's the top PSU bank in the, like, if you take a look at the stocks which are moving higher, currently also it's up almost 2%. Maruti continues to see fresh longs, and today also we have seen a positive brokerage note coming from GS, which has increased the target price to almost rupees 18,900, highest target price on the street that we have. And after the IT, because the weakness in IT is now being extended to realty stocks, and that's the reason most of the realty stocks are seeing fresh shorts. So I have selected one stock, that is DLF, down currently almost 2%.
Thank you very much for that. And now let's get to the big story on Trading Hour, and that's got to be the stake sale of Rapido via Swiggy. Gaurav Malhotra, Executive Director, Axis Capital, is now with us on the show. Gaurav, morning. This is Rima here. So, we've been talking about the news since morning. They've sold the entire 12% stake. They've got about 2,400 crore rupees. So if you could just tell us now, what will Swiggy's balance sheet look like? The cash on the books vis-a-vis the projected cash burn going ahead, and will Swiggy require more of a fundraise?
Yeah, hi, good morning, everyone. So, see, the company had around 5,300 crores of cash end of June quarter, and they have raised 2,400. So that's around 7,700 crores, almost close to $1 billion. In terms of the projected cash losses, see, the cash losses in Instamart should start coming down. They sort of peaked in the first quarter. Food delivery continues to be profitable. And even from a capex perspective, the company has slowed its dark store expansion. So we expect the cash burn to come down, and this fundraise to meaningfully expand the runway, which the company has had, say, before this fundraise. So on the whole, we think it's a positive thing. This is something which the company actually had quite candidly disclosed also in the first quarter results.
Do we have cash burn numbers? Because just comparing, Swiggy's near $1 billion, 7,700 crore versus Eternal's 18,000 crore plus, nearly 19,000 crore rupees. There's clearly a big difference.
Yeah, see, the thing is, the Instamart was burned around 870 crores of cash last quarter. That number will definitely come down this quarter. Plus, like I said, food generates around, say, 200, 300 crores of cash. Plus, capex has come off quite meaningfully. So on a quarterly basis, the cash burn is not as much. See, versus Eternal, obviously, that there the cash situation is much better. Food is significantly more profitable. The loss in Blinkit is much lower. In fact, Blinkit is likely to turn EBITDA break even in the next couple of quarters based on our projections. So from that perspective, yes, Eternal is much ahead, but this obviously does help, Swiggy from a near to medium term perspective. We do feel that maybe it would not harm if they do some additional fundraise in the foreseeable future. But this in itself should be good for them from a meaningful runway and a growth perspective.
Gaurav, good morning. Thank you for joining in. So, by the looks of it, do you believe that Swiggy is currently falling behind the quick commerce expansion race in comparison to Eternal? Because Eternal has laid out its targets very clearly for Blinkit, that they want an X amount of stores in this period of time, regardless of the fact that whether they turn profitable or not in this business. So, would an additional fundraise further propel Swiggy? But because how much of this fundraise would also help in expanding more dark stores for Instamart?
See, so the company had essentially mentioned that once post reaching around, say, 1,000, 1,100 stores end of 4Q, they will slow down their store expansion. And Blinkit, like you rightly said, has sort of gone ahead. It initially was targeting for 2,000 stores by end of December of this year, and now they're sort of talking about a 3,000 number, not end of this year, but more from a medium term perspective. So from that, yes, Swiggy definitely is on, the expansion plans are much slower. I think so. What this fundraise could potentially do is that, maybe they sort of change their plans and sort of little bit accelerate the expansion, but I don't think so they'll go back to what they were doing, say, in December or even the March quarter. But maybe they increase a little bit. And do also note that, in terms of from a cash situation perspective, Rapido is also sort of getting into food delivery. So it's always good to have some dry powder. Whether you need it or not, it's a separate matter, but it's always good to have some dry powder when there is these imponderables of, Rapido, Flipkart Minutes, Amazon Now, those guys are still sort of, ramping up as we speak.
Got that. Can you explain the rationale of transferring Instamart to a wholly owned subsidiary? They're planning to hive it off. What is the rationale behind it and the implications for Swiggy?
See, the thing is, to be honest, it just cleans up the structure, right? It's almost, think of it like a Blinkit, Blinkit Eternal structure, that now Instamart will be a separate subsidiary. Now, it increases the flexibility. Now, what that flexibility could mean can be a variety of things, but which many of them may or may not happen. So I think so. This is just like cleaning up cleaning up the structure more than anything else. I don't think so this really changes how they do business. It really doesn't mean anything from how to think from a financial estimates perspective.
So you don't think that they will now move to an inventory-led working model, or they're looking at strategic partnerships or an eventual listing of Instamart? I mean, should shareholders start thinking about that, or it's too far down the line? And does it alter your estimates of Swiggy?
See, right now they are thinking of the first step is to hive off. Then we'll see how it sort of comes through. But like I said, it opens up avenues for you to do things in terms of corporate action, if you want to do some specific fundraise or any of such things. But from a earnings perspective, nothing really changes from our side.
So you believe that despite this slowdown in their dark store expansions, that would not accelerate their path towards profitability, at least firstly on an EBITDA level and then on a PAT level? What are the kind of timelines that you have projected for Swiggy to turn positive, both on the EBITDA and on the PAT front?
See, at an aggregate level, it'll take some time for the company to break even. But food is anyway, like I said, is profitable. Instamart, in terms of contribution margin, we expect it to turn break even sometime in the middle of next fiscal. EBITDA break even for Instamart will take a little bit longer. See, but the way to think about it is that because of his dark store expansion very rapid, his throughput per store went down to below 1,000 in the March quarter, in the June quarter, which is roughly 1,400 for Blinkit. So even if he does not do as much of a dark store expansion, at least in the near term, it does not constrain his ability to grow at a very rapid pace.
Great conversation, Gaurav. Thank you very much for joining in. Had some more, but we're out of time. We need to slip into a very short break. But here's a quick reminder. Catch the exclusive CNBC TV18 CEO Centimeter from the CII National Council meeting in a short while from now. 80 CEOs on one platform discussing rupee, rates, trade relations, the GST cuts, and so much more. You don't want to miss this.
Welcome back. Still 100 points lower on the index, still trying to find some support at that 25,000 mark for the Nifty. And this is despite some positive news that came in earlier in the morning, and that came in from HSBC, because HSBC upgraded the Indian markets earlier in the day. They upgraded it to an overweight compared to their earlier stance of neutral. And this comes just 8 months after they had downgraded the Indian markets in January of this year, citing growth and slow growth and higher valuations. Now, for the Sensex, they are projecting a target of 93,000 by the end of 2026, which means around about a 13% upside from the current levels for the Sensex. Now, what HSBC is mentioning that India is Asia's quiet corner in comparison to the crowded trades that you're seeing in Korea and Taiwan. And that justifies this premise as well, because if you take a look at the returns that the markets of these indices have delivered on a year-to-date basis, the KOSPI on a year-to-date basis is up 45%. This is before going into today's trading session. The Taiwanese index, which is the TAIEX, is up almost 15%. The Chinese, the benchmark, the CSI 300, that index is up close to 19 to 20%. And in comparison to that, the Sensex is up only 4.5% on a year-to-date basis. And this is the underperformance that the Indian markets have had compared to Korea and Taiwan and China, all this on a year-to-date basis so far. And what HSBC goes on to say is that despite this underperformance, the local investors are the ones that have remained resilient despite this continued FII outflows that you have seen. They also go on to say that earnings expectations, they can still fall a little further, although one of the key reasons why they downgraded India the last time around, which is the valuations, they are no longer a concern. And the fact that the government policy, the multiple reforms that have been announced, the income tax cuts, the GST reforms, they are now turning into a positive factor for the Indian equity markets. They also go on to say that most foreign funds remain lightly positioned, something that you heard from Mahesh Nandurkar as well last week when he spoke to us, and he mentioned that around 67% of the foreign funds currently remain underweight on India. So that is another factor that HSBC has highlighted. Among their top sectoral allocations, financials, industrials and consumer discretionary remain the top three, and among their largest holdings, of course, the largest heavyweights, be it HDFC Bank, Reliance Industries and ICICI Bank. So a positive trigger coming in, but the market's not reacting to that, but HSBC has upgraded India, saying that valuations are no longer a concern.
Okay, thank you very much for that. We have with us Shri Vatsa, Executive Vice President and Fund Manager Equity at UTI AMC, now joining into the discussion. Thank you very much for joining in. Indian markets haven't done too much in the last 12 months. Do you think it's time now for a up move? Are we ready and primed for a recovery? Is it time to allocate cash for a quick, 10% kind of a return?
Yeah, hi. Good morning. Yeah, it's right that the Indian markets have underperformed most of the regional and the global peer markets by a decent margin in the last one year as well as year to date. I think the reasons were a couple of them. I think the most important one was that there has been a fair amount of earnings cut which has happened, and also a slowdown in the earnings which has happened over the last 9 to 12 months, coupled with a higher base valuation last year. Both of them have led to a muted performance in the last 1 year and a huge underperformance from a global context. However, we feel that the slew of measures by the government, which started off with income tax cut, as well as a GST cut and the liquidity boost, will give rise to some decent level of earnings growth. So if you look at the Nifty growth, earnings growth for next year, it's closer to 13 to 14%. We don't expect a big cuts now. So I think all stars are kind of slowly aligning in terms of strong domestic liquidity as well as decent level of earnings growth. And probably the foreigners will also may start look at India favorably in the coming months if they see these kind of positive triggers, because they are also a little bit underowned. The only caution that I would say at this point of time is that the market is still assuming that the US tariff issues will be resolved. I think they are not taking the impact of this 50% tariff. If that were to continue for, say, 6 months, 1 year, that can have some impact on the economy, which is not factored in by the market. So I would closely watch out for that event. If that event is favorable, I would see the markets being very, very favorably poised.
Srivatsa, good morning. Thank you for joining in. On the cusp of yet another earnings season, Do you expect this quarter to be better than what the June quarter was, or do you anticipate a couple of more quarters before the actual reform impact starts to show up in the numbers?
Yeah, I think generally these reforms don't show up in a couple of quarters. There's a lot of supply chain issues. So you would have to wait for at least a couple of quarters before you start seeing the impact. But whatever trends that we are seeing in terms of channel checks, for example, in automobile companies or even in other FMCG companies are favorably poised. But the final results, say, for the September quarter or December quarter could be slightly different. But as I said, the trend is favorably poised if I look into next year, because if you look at the drags in the last 1 year, it's been the consumption stocks, automobile, FMCG, which have, not grown as expected. If the growth were to return, I think that would set the tone for a very favorable base next year. And more importantly, the quality of growth will improve next year, because this year growth has been led by, say, metals and oil companies, which are more commodity linked. But we need to watch out for at least a couple of quarters before we start seeing the full impact of the GST and the income tax reforms.
I was just seeing your UTI large and mid-cap fund. And that doesn't have any platform companies, which is where we are seeing maximum growth. It's heavily concentrated in financials and IT. So can you tell us why you've excluded some of these platform companies?
Yeah, so in the UTI large and mid-cap fund, we clearly follow a very value-oriented approach. I would say more of a relative value-oriented approach. And the valuation of these platform companies, it doesn't fit into our strategy. So which is why we are more focused on, say, domestic financials, where there is still reasonable value, as well as automobiles. And of course, IT and pharma are kind of contra plays, because I think the valuations have bottomed out for both the sectors. But yes, there is a risk of any further escalation of tariffs. But we do believe that the risk reward is quite favorable in these two sectors. So it's a combination of wherever there is growth at a reasonable valuation, as well as where there is an absolute very good valuation for companies which have created good long-term wealth creation.
Does this fit into the criteria? Do PSUs fit into the criteria that you just highlighted, Srivatsa? Of course, it's a very large basket, be it defense, be it railways, be it the oil and gas names, or even PSU banks for that matter. Do your preferences lie anywhere among these PSU names?
Yes, so we are slightly turning more favorable towards PSUs, but they are not a big part of the portfolio. So PSU banks is something that, I'm favorably looking at, because I do believe that they will have a decent earnings growth next year. And the valuations have also corrected meaningfully in the last couple of years. So they are a pure value stocks. We are also favorably looking at some of these PSUs, oil majors, whether it is OMCs or upstream. I think even there, the valuations are quite favorably poised. But defense PSUs is something we don't have in the portfolio. I think we do believe that valuations are a deterrent. But as a PSU, I don't have a high exposure. But yes, tactically, I think it is looking good from a value perspective.
Thank you very much for joining in, Srivatsa. Get into a break. We'll come back with more on the market. Stay tuned. Welcome back. Let's put the spotlight on the Indian technology names because the US Department of Homeland Security, that's DHS, is looking to once again shake up the H-1B visa process. First, you remember, came the higher H-1B visa fees of $100,000. Now, they're saying instead of using the random lottery mechanism, which they were using so far to select the H-1B visas, what they're proposing is a weighted system. Basically, give preference to higher skilled and higher paid workers. Now, to give you some context, over the last few years, data shows that around 83% of the H-1B visas went to level 1 and level 2 employees. That's basically entry-level or qualified workers, where the median salary is a lot lower, $85,000 for level 1. For level 2, the qualified workers, it was about $100,000. On the other hand, the more experienced or fully qualified workers, level 3 and level 4, which command higher median wages, historically got a much smaller share of the visas. So now what the Trump administration is proposing, it's not a proclamation now, they're proposing, they're saying give a higher preference to higher skilled and higher paid workers. They're saying basically we want to attract the elite talent, tech talent. Now, DHS has also done some calculation. They're saying, and they've analyzed data over the last 5 years, they're saying the estimated economic benefit in the first 1 year alone could be $500 million. Now, right now, comments on this proposal are open for the next 30 days after it's published in the Federal Register, and it's supposed to be published today. So you've got 30 days to weigh in, but that's another shake-up, and Indian tech companies will need to watch out and brace for impact, if at all.
Yeah, that's the major point, right? The fact that it is a proposal and it's not a rule yet. So this 30-day public consultation window opens up later today. So keep an eye out on that. By the way, some flashes on your screen. Ola Electric is mentioned that on the first day of Navratri, all units were on offer were sold out within 5 minutes of the window opening. So yet another positive commentary coming in from yet another auto major. From the auto sales, we heard from Maruti, we heard from Hyundai, and we also heard from Tata Motors about how their first day of Navratri turned out to be. And Ola Electric also coming in, although they haven't mentioned how many units were on offer, but first day they were sold out within just 5 minutes. Take a short break, more on the markets on the other side. Welcome back. Still a 90 points lower on the index. So 25,050, 25,000 continues to be that support for the index as of now. But there are a lot of broader market movers. Of course, you can't take a rise of Tata investment. Just pull that stock up because it was up 10% yesterday. It's up another 10% today. And this is after the company had fixed the 14th of October as the record date for their stock split. So another almost 20% in the last two sessions, nearing the mark of 9,000 now is Tata Investments. Minda Corp, of course, as Sudarshan highlighted earlier in the morning, 9% higher there as well. But with that, we call time on this edition of Trading Hour. From Rima and me, thank you for watching. We leave you with the index still in the red and the Nifty Bank at the day's lows. Halftime report on the other side.
Stocks drift lower after weak overnight cues following Fed Chair Jerome Powell's stocks are fairly highly valued comment that came in. Realty as well as IT are big drags even as metals eke out gains.
Swiggy will sell its stake in Rapido to raise a little under 2,000 crores, a move to sell Instamart on a slump sale basis to its subsidiary for cash will also add to its resource pool as it opens up fresh fundraise possibilities.
PhonePe files with SEBI for an IPO, sources tell CNBC TV18. This will be via a rupees 12,000 crore offer for sale by Walmart, Tiger Global as well as Microsoft. The offer is likely to hit D-Suite only in 2026.
India's Steel Secretary sees industry growing at 9 to 10% in FY26, up from 8% so far following GST 2.0. He also sees steel prices balancing from low levels on higher consumption. On the safeguard duty, he expects a decision before the 1st of November. A very good afternoon. Welcome to Halftime Report live from the CNBC TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a day where we are definitely seeing a lot of pressure in the broader markets, you'd have to say. So the mid-cap index is down around 0.6%, but not that much for the small-cap index, interestingly, which is down around 0.3%. The advanced decline ratio now firmly on the declining side. So what took place today is that around 11 a.m. odd, we did see a little bit of a crisscross take place, and after that we've just seen a widening gap between the two. So the advances have really overtaken in terms of, the declines have really overtaken as compared to the advancing stocks at this point. The frontliners also under pressure. So we have the Nifty, which is down around 95 odd points, the Sensex, which is down around 367 odd points. The other big pain point in today's trading session is definitely the banks, the financials, the bank Nifty itself, which is down around 0.7%. So that seems to be where the pressure is. As the day's gone along, we've seen the pressure build up for the markets despite that recovery that we saw intraday after the start of trade. Hi, Vinny.
Hi, Ekta. Yes, absolutely. We're seeing some bit of the muted performance that's coming, at least for a Nifty Bank as of now, as well as the mid and small cap. But sectors which are not doing well today, let's look at that. Nifty Realty, that's among the top sectoral losers today. So keep an eye on that one. Other than that, Nifty IT, that's also under pressure. PSU banks, that's managing to hold on to gains. And Ekta had also highlighted a bit of few names that are moving in trade. But Premier Energies, Vari Energies, that's seeing a run up in today's trading session. Both are holding on to gains of almost 4% as of now. Keep an eye on that one. Himadri Specialty Chemicals, that's another one that's been buzzing in trade as well as Deepak Fertilizers. So these are some of the names that we're seeing moving around in trade. But which are these other stocks that are also moving and buzzing in trade today? We have Vivek joining in with us to take us through those buzzing stocks. Afternoon, Vivek.
Well, good afternoon. Like you mentioned, action-packed, but especially in the last half hour or so, we've seen quite a bit of selling pressure emerge as far as the broader end of the markets are concerned, ensuring that the advanced decline ratio is now firmly in the grip of the bears. Quite a few stocks in focus. Muthoot Finance, has cooled off a little bit from the day's highest point, but gold prices continue to surge high, and this particular stock has been an outperformer in the last couple of trading weeks. The other stock on our radar, one from the broader end of the markets, is Tata Investment Corporation. Very strong volumes today, higher by almost 11%. On the other hand, have a look at Minda Corporation as well. We've been highlighting post the analyst meet, very strong, ambitious commentary coming in from the management, higher by 8%. Indian Bank has cooled off a little bit, but continues to be among the top gainer as far as the NSE 500 index is concerned. And Godavari Power and Ispat today manages to hit a fresh 52-week high. On the other hand, a few sectors that we are focusing on that is contributing to the kind of selling pressure that we've seen in the market. The entire realty pack, especially names or companies that are exposed to the Mumbai market, all of them down anywhere between 2.5% to 4%. Look at DLF, Oberoi, Godrej, all of these stocks under significant selling pressure today. And IT, remember, some fresh woes or fresh worries as far as H1B is concerned have emerged overnight. On the back of that, the whole host of especially mid-cap IT names continue to witness selling pressure. So no bounce seen as far as the IT pack is concerned.
Okay, thank you so much for that, Vivek. But let's move on. And I actually managed to interact with JP Morgan's pharma analyst, and this was on the sidelines of the 10th JP Morgan Annual India Conference. And we started by talking about, Trump, the threats that have come in terms of pharma pack, what is going to be the tariff situation there. And Bansi Desai, Vice President at JP Morgan for India Healthcare as well as pharma research, spoke to us about these implications as well as a lot more on the pharma and healthcare space. Listen in to a slice of that conversation.
If you first look about the pharma space, most of the pharma companies have diversified businesses in India, right? About 1/3 of their revenues come from domestic market, which is the India branded generic market. That's something which is insulated. That's the market where you have structural and stable growth. About another 1/3 is where these companies generate revenue from the US market. Now, US is the market where, potential tariffs could have implications. Very difficult to predict policies, to be honest, but our sense is that most of these companies are going to adapt and manage the implications through combination of strategic and operational responses. Companies with higher exposure to US obviously will be a lot more vulnerable than the ones who have lesser exposure. In our view, larger companies also probably will be better off in managing any potential disruption compared to smaller companies, A, because of the scale that they would have, and also B, because a lot of these leading pharma companies have manufacturing presence in the US. So maybe that can also help offset any of the potential tariff impact. But difficult to predict policy. If you look at US-EU deal, the pharma deal, generics are largely exempted. If you look at US-Japan deal, generics are largely exempted. So it remains to be seen whether Indian generics, will see tariff or not, and if yes, what would be the magnitude. But fundamentally, Indian companies do play an important role. We account for almost 45 to 50% of US generic drugs prescribed in the US. So we are a very important part of their supply chain. So yes, it remains to be seen.
Remains to be seen, but any concern also comes in for CDMO players. Will it mean that maybe CDMO players may not get that much of a business? Counting the downside risk, right? I'm just talking about the worst case scenario right now.
No, in fact, on the CDMO businesses, we believe they are a lot more insulated. The reason being the burden of tariffs actually lie on their clients and not on them directly. That's number one. The second is that if you look at the supplies of CDMO in terms of value terms, it hardly accounts for few percentage points of the large innovators' P&L. So even if tariffs were to be imposed, it's something that can be get absorbed by the innovators. So CDMO, in fact, I believe, in overall scheme of things, are relatively lot more resilient.
Pansi, let's talk about CDMO only, because I have heard CDMO since a year and a half. This is a space that's coming up a lot more, growing well. So in the CDMO space, every, I think, pharma company has some segment now that is CDMO, right? Where and what will we see the benefits coming in for CDMO players? Which players will see those benefits? Is everyone going to be benefiting? Is it the top line players who will benefit? Where?
So if you look at the CDMO industry versus a decade, we had only handful of companies present in the space. Today we have a lot of companies present with bunch of capabilities within the CRDMO segment itself. If you look at the global CRDMO market, this is over $200 billion in size. And India accounts for only 4% share today. So we are very small, in terms of our size and scale, but we are gradually inching up in terms of our capabilities. We are also fast emerging as one of the preferred players or partners, by large innovators. And there are multiple reasons for that. Number A, if you see, we see structural macro tailwinds in this space, which is rising outsourcing penetration. The second is diversification strategy by large innovators, EU +1, China +1. On top of that, you have US-China tensions, all of which is driving higher business for Indian companies. The second is Indian companies also offer cost advantages. We have cost-efficient manufacturing, our compliance and regulatory track record is strong. We have large pool of scientific capabilities as well. In fact, on labor cost, we are comparable or even better, to Chinese counterparts. So we do offer, these inherent advantages. Last but not the least, if you hear the commentaries of these CDMO companies, all of these guys are talking about expanding aggressively. So they are incurring huge capex. Capex for this particular year is going to be almost 30% of their existing gross blocks. So that's huge, and that drives revenue visibility, right? The second is they are moving up on the value chain as well. Traditionally, we've been known for strong small molecules. Our capabilities have been proven on that side. But gradually, we see companies doing a lot more complex work like ADCs, which is advanced drug conjugates, oligonucleotide, peptides. Our capabilities are nascent here. We are not very big, But slowly and gradually, all of this is opening the target addressable market for Indian players. And we see this momentum reflected in companies' RFQ, which is request for quotation.
Yeah.
We see them announcing increased capex guidance.
Okay, so definitely a lot more interest coming into Indian CDMOs. That's the word coming in from JP Morgan there. We need to take a short break on that note, but we'll get you a lot more in terms of markets and stocks on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. TV18. As of now, Nifty slight bit of an inch up from the day's lows, or at least the flat line where we're seeing slight bit of an uptick in the last few minutes we've seen coming in. Which are those gainers that we're seeing overall? Himadri Speciality is what I'd highlighted. Premier Energies also is managing to see some bit of a gain in the broader end of the market. But for the Nifty, HUL, LNT, that have seen a slight bit of a spike up as well in the last few minutes. So that is what we'll be keeping an eye out on. Now, in terms of top losers today that are coming for the Nifty 50, specifically we're seeing a fall coming in Tata Motors, Wipro, BEL as well as Bajaj Auto. So Auto Pack today is clearly seeing some bit of a pressure because Hero MotoCorp was also something that is down almost 1.3% in today's trading session. Apart from that, let's look at what the Nifty Midcap is also doing. Nifty Midcap is also trading with cuts of almost 0.7% as of now. Slight bit of an uptick for the Nifty Midcap from the day's lowest point. But what's happening in the world of FNO? What are the latest updates that we should be keeping an eye out on here? Nigel is joining in with us from the FNO desk. Afternoon, Nigel.
Well, afternoon, Vinny. You know, the FNO market is looking extremely exciting right now. And let's get straight to the point with regard to what can lead the recovery from here on. The Nifty Bank, that's been the one that's been holding one end up. And it's at a very, very crucial juncture today. As we speak, there are no fresh shots getting to the system. In fact, there is some unwinding of positions post that big run that we saw on the Nifty Bank. But now the level that we have made today in terms of a low on the Nifty Bank is coinciding with the low that we made yesterday. So this is the extremely important mark, that 55,100 mark, that needs to get protected. If the Nifty Bank needs to bounce, it needs to bounce from around these levels. So, you know, that's going to be the big mover for the remainder of the trading session as well. Moving to the options data, well, the call writers, they are feeling very, very confident. Just take a look at the kind of call writing we have seen. The 25,100 call, the premium has crashed out there. At the start of today, it was around 180 rupees. It's come down to around 130 rupees. As is the case with the 25,200 call as well. Take a look at the premium. At the start of today's trading session, it was at around 120 rupees. That's come down drastically. So keep an eye out on that. Call writers, they feel they're back in the game. On low levels of 25,000 put, it's seeing a mix of activity out there. Some writing, some buying as well for those that believe that the markets are actually going to go and correct from here on. So there is some action out there. Putting in the options data, putting in the technical levels, well, the 25,350 mark becomes extremely important of the upside. A couple of sessions ago, we entered on 25,331 and we did a U-turn from there. So this band is important in terms of a resistance mark. If the bulls can get past that level, then they'll feel a little bit confident. However, on the downside, you don't want this 25,000 mark to break because that's the crucial support, the technical support that you're looking at. Moving to stocks that are in focus today, you have DLF, there's fresh shorting seen out there, big open interest built up, stock lower. But there is some buying on select counters as well. Indian Bank, after a while, the stock has come onto our list. You have the stock that's holding steady in a market that's actually a little bit jittery, in particularly the Nifty Bank. But there's some fresh long addition out there. And the other one is AB Capital as well. There's a mix actually out here of buying as well as short covering because that stock is holding in the green. And there is some kind of build up in terms of open interest. So key to track today, the Nifty Bank needs to bounce from around these levels. That's what will help the Nifty protect that 25,050 odd mark. Back to you guys.
Okay, Nigel, thanks very much for that. Slip below 25,000 as we speak. So 25,095 is where currently the Nifty is at, down around 0.3%. The mid-cap index is trending lower, so just watch out for the mid-caps. It's currently down around 0.6%. It's been a tad bit of a recovery that we've seen from the day's low, but nothing really to write home about. We're seeing a little bit of buying coming in at those dips, but let's see whether that sort of trend sustains or not. As of now, the Bank Nifty also showing a cut of over 300 odd points. But let's get some perspective in. Speaking at the US-India Strategic Partnership Forum, Commerce Minister Piyush Goyal spoke on increasing energy imports with the US and unlocking limitless possibilities with the US on various fronts beyond energy. Listen in to a couple of those bites.
The world recognizes that this is one area where we all have to put together. India is a big player in the energy field, as Patricia just mentioned. We are big importers of energy from across the world, including from the US. We expect to increase our trade with the US on the energy products in the years to come. And be close friends, natural partners. Our energy security goals will have a very high element of US involvement, which will ensure which will ensure diversified sources of energy for India and help us unlock limitless possibilities that the US on various fronts, energy and beyond.
Okay, interesting comments coming in there. But on that note, we're actually going to sip into a very short break. Don't go anywhere. We'll come back with more updates on the other side.
Welcome back, and joining us on the show now is Thomas Printer. He's MD and CEO at IGI. Mr. Printer, hi, thank you so much for joining in. Festival season and diamonds are doing well. And just as the consumers were getting some awareness into diamond certification, we have a slight confusion about the 4 Cs right now. Would love to take you through us. Thank you,
Manisha, for having me around. The 4 Cs have been the standard grading procedure for diamond grading. Okay, and we are not deviating from the 4 Cs. What has happened is, in recent times, lab-grown diamonds have gained momentum, especially in the US, where, almost 50% of the bridals have shifted to lab-grown diamonds. We believe that as an independent laboratory, we will continue to be transparent and ethical towards the consumer, which means that we will define both our diamonds, chemically, physically, crystallography, everything is identical, is the same. So we say we grade diamonds, we grade natural diamonds, and we also grade lab-grown diamonds. We adopt the 4 Cs, which has been a century-old nomenclature for the diamond grading procedures. What is more important is the origin. As a laboratory, we have to identify the origin correctly without any deviation. So we say that we are able to identify the natural diamond. We have all the equipment and the expertise and the scalability to identify the natural diamonds as well as the lab-grown diamonds and give the consumer the option. Because natural diamonds is extremely rare, beautiful, gift of nature, and it's also very expensive. On the lab-grown front, lab-grown diamond is a more affordable luxury. So what is happening is the millennials and the Gen Zs who are starting off in life, they prefer to opt for an affordable luxury like the lab-grown diamonds. And they go in. So the consumers, the new consumers which are being brought into the fold is tremendous. So we are in the,
So, Mr. Printer, you are saying that you're not moving away from 4 Cs, whether it is natural or lab-grown. It's the same certificate that goes across. It's on consumers to choose.
Yes, it is for the consumer to choose. We are an independent laboratory. So we want to give transparency and full identification of the diamond and let the consumer take the choice.
Mr. Printer, there's a lot of lab-grown diamond. There are the natural diamond companies also now venturing into lab-growns as well. And we're looking at single stores actually expanding, exploding, if I can use that word as well. For the Indian market, we do understand on what US is doing. Europe seems to be doing well as well. Dubai, we've seen numbers increase too. When you look at the Indian markets, what is the kind of growth that you're looking at in lab-growns for the India?
Okay. For instance, I would say 80% of all lab-growns are grown, polished, cut, and certified by IGI in India. Okay. While the main market is in the US, there are other geographies which are also gaining ground, including India. India is fast gaining on the lab-grown front. What is happening is lab-grown jewelry is becoming more and more affordable. It is going into the 2nd and the 3rd tier cities, more and more consumers. So our purpose today is to not only identify the origin, give it the 4 Cs, and also educate the consumers that both are diamonds. Currently, there is quite a bit of negative chatter on the lab-growns, but we are away from that. We say we grade diamonds. We will give you the grading on the natural front. We will give you the grading on the lab-grown front. And we are an independent body. You need third-party certification. Anybody can say my diamond is the best, but as an independent body, you need an independent body, accreditation. And we are also accredited by ISO 17025, which is an extremely stringent lab accreditation following all the technical and the process compliances, so that we keep our standards intact. And that is very important in today's date.
Mr. Printer, there have been, I can resonate with that a lot of time you take these certificates home and those cards home and they get lost. But what you also have done is with digital diamond certification, I think the need of the hour and quite a technical move, I would say.
Yes, absolutely. See, blockchain has been a buzzword. Now we have created that blockchain into a reality. See, everyone wants the provenance of a diamond in the entire supply chain. And that is what we have offered to the world first time, so that, and digitization is a must. We have to harness the technical technology rather, and let it proliferate, because everything is going digital. We are into the AI mode. We are doing heavy research into AI. AI is just not a word that we use loosely. We have implemented the AI in various processes so that our process becomes more and more efficient. See, today, efficiency is king. Reducing the time is value, money value.
Absolutely.
So we are in the process of doing both these things so that we give an affordable, viable solution to the consumer for our various channels.
Mr. Printer, while there's a lot of chatter around as well on how India, because of the higher gold prices, seems to be moving towards 18 and 14 and 9 carats as well. But I was recently talking to BIS, which is the hallmarking agency, and they said 80 to 85% of jewelry that has come to them is still 22 carats. So that perhaps tells you on where the narrative lies. And that's exactly with you as well. So would love to know on what kind of festival feedback or on-ground sense are you getting this time around? Is it higher caratages, lower, natural, lab-grown? What is it that you see processed through?
Manisha, you have to understand that India is a conservative society, okay? And we are in for natural. We are in for pure gold. So our gold jewelry will remain at 22 for some time. The new consumers might get into 14 carat or 9 carat even, I don't know. However, the bulk of the Indian society will remain with 21, 22 carats. And maybe in jewelry, it is 18 carat. Okay. And we do the BIS for each and every jewelry piece that we do. Certified. You understand? What is happening rather is lightweight gold jewelry. So there are special machines which create a lightweight model of the same. So, when the jewelry piece looks the same, it can actually weigh 40% less. And that way, you can have the same jewelry, you can have the same gold standards, and at the same time be more affordable.
Mr. Printer, so as I asked you, what caratages are you doing more right now? So we get a sense on where this festival is looking at like.
At this festival, nothing has changed.
Okay.
Thing is in the same order, only we are inundated with jewelry pieces.
Okay.
The market in India is very vibrant, is very bullish, and consumers want their jewelry during Diwali and Dussehra and Navratri and all these things.
Mr. Printer, while of course certification is not just, it's not, a choice anymore, it's mandatory. Would you say it's a compulsion as well right now? Because there still are pieces that are sold with or without certification. What would you tell consumers about that?
As long as the consumer wants peace of mind, get it IGI certified. As simple as that.
Mr. Printer, thank you so much for joining in. Well, that's about the jewelry business really. We'll be looking at higher demand. There's more diamonds being bought this time around, especially with gold prices so high. So diamond perhaps becomes a choice at this point. And as he said, there's more affordability right now, especially with lab growns as well, and so much choice when it comes to natural diamonds as well. Thank you, Mr. Printer, for joining in. And with that, it's all the time that we have on this segment. Stay tuned for more news and updates on the other side.
Thanks, Manisha, for that. So yes, absolutely, lab-grown diamonds is where probably the market is moving at this point in time, considering what is taking place with gold. But nonetheless, thanks for joining in and giving us sort of that perspective. Well, back to the equity markets. It's not glittering like gold is at this point in time. So the Midcap index is currently down around 0.5%. It's recovered from the day's low nonetheless. We do have Upasana with us. She's tracking a particular stock which is in focus, Bajaj Electricals. Upasana, tell us more about it. Why is it up and about today?
While the board of the company has given its consent to acquire Murphy Richards' brine rights in India and neighbouring regions from Glen Electric Limited for a consideration of nearly about 146 crores. Now, mind you that the company is associated with the brand Murphy Richards since April 2002 through a licensing agreement for an exclusive marketing and distribution rights in India. Now, company also positions this British brand Murphy Richards in the premium category with products in various sectors such as kitchen, home appliances and even personal grooming, which the company believes has a wider appeal and sales growth as compared to the other categories. Now, this strategic move is expected to strengthen the company's position in home appliances and consumer electronics portfolio. Hence, we can certainly see the stock surging in trade today because with this acquisition, company will secure outright brand rights in India, Nepal, Bhutan, Bangladesh, Maldives and Sri Lanka, that is overall the South Asia market.
Okay, Upasana, thank you so much for that. Bajaj Electricals as of now is managing to hold on to 70% of gains coming in. But some of these other names also that we should be keeping an eye on and that are trading almost at the 52-week high, Tata Investment Corp. That's the one that's buzzing in trade. 9-10% of gains that we're seeing coming in today. So keep an eye out on that one. We have Indian Bank. That is also trading at a 52-week high, as well as Canara Bank managing to hold on to gains of 1-2% in today's trading session and trading at a 52-week high. A lot of moves that we're seeing coming in, especially from these Adani Group names on the flip side, but keep an eye out on that. But let's go across now to Shireen Bhan at the CII National Council meeting for CNBC TV18's Mega CEO poll. Over to you, Shireen.
Gentlemen, welcome to the CNBC TV18 Mega CEO Centimeter. I'm Shireen Bhan and we're coming to you live from the CII National Conference here in Chennai. And of course, this is an engine of growth for India. And we are going to be talking about what next now to drive reforms and to drive growth for India. Before I get my audience and the CEOs present here, this is one of the largest platforms that you will see. Almost 80 CEOs present here under one platform live right on CNBC TV18. Before we get the Q&A started, I decided that this was a good opportunity, since we have everybody here in the room, to actually do a dipstick survey and sense and gauge the mood of the nation, to gauge the mood of India Inc. So without further ado, let's get started. My first question, and this will of course result in a show of hands from each one of you, so I would request you to raise your hands depending on which way you decide to vote. With the GST boost coming in, the Chief Economic Advisor suggests that growth will be higher, perhaps closer to the upper end of the band that was presented in the economic survey, which was 6.8%. What is your growth expectation for FY26? Ladies and gentlemen, option 1, 6.5%, option 2, 6.8 to 7%, and option 3, more than 7%. Those of you who think that growth is going to be 6.5%, please raise your hands. Okay, no hands here on 6.5%, between 6.8 and 7%. Okay, quite a few. And those who believe that it is likely to be higher than 7%? Okay, so that's the mood of the House. Just what the Chief Economic Advisor told us, 6.8 to 7%, a little better than the economic survey's estimates. That's the mood as far as industry is concerned. The second question, and again, I'd appreciate a vote, a show of hands here. Do you see inflation easing further, and do you expect the RBI to cut interest rates again? Yes or no? Very, very simple. Those who believe the RBI will cut rates, a show of hands, please. So most people in this room do believe that the Reserve Bank is going to cut rates. And the third question to kick things off here, we've seen what's happening as far as the currency volatility is concerned. Do you expect the rupee to end Option number 1, in the current band, which is between 88 and 89, to be stronger, which is below 88, or weaker above 89. Those who believe that the rupee is likely to trend in the current band, if you could raise your hands, please. Okay, and those who believe that it's expected to be stronger, that is above 88, just about 2 hands in the room, and those who expect it to be weaker, that's below 89. So majority expect the rupee to be in the band between 88 and 89. So let's get straight off. Rajiv Mani, I'll come to you to start with. What was your vote? 6.5 to 6.8 or 6.8 to 7%?
No, 6.8 to 7%.
Okay, and you believe the GST is going to help drive that number?
Yeah, I think GST will definitely help. I think firstly, the first quarter GDP growth was also was a very positive surprise, and from what we are seeing with the monsoons and the uptake because of GST on the consumption, just some of the early sentiment that we are seeing. We haven't seen the numbers as yet. I think 6.8 to 7% should be achievable. We are also seeing, if you look at steel, if you look at cement, the broader trend on the construction sector, which contributes a lot, that's very positive. We just saw yesterday mining sector is starting to show very positive growth. So I would say overall 6.8 to 7% is probably a safe number to go with right now. I think India's bigger challenge is not the real GDP growth. I think it's the nominal GDP growth. Yeah. Because from a tax revenue collection, from a fiscal deficit number, I think that becomes more relevant. I think that's where we'll have to see if inflation continues to stay as benign as it is, and with GST it may come down a little bit, currency stabilizes, then the likelihood is that the nominal GDP growth will be a challenge. So we're hoping that if RBI was to reduce the interest rates, in some ways, push for greater growth, and then if that has a mild impact on inflation and it comes to closer to 2 to 3% in that range, if it ends in that range, then hopefully the nominal GDP growth number should catch up.
Mr. Mukundan, what did you vote when I asked whether interest rates are likely to be cut or not? Do you expect the Reserve Bank and the MPC to deliver on another rate cut?
I took a safe one. I actually voted with the president.
Which way did the president vote on that? You were looking at him. So yes or no on a rate cut?
Yeah, we do believe, I think there'll be I think we are in an era of, I think, a continuous rate being eased, because I think the inflation trends are down, and the long-term trends on inflation are also pointing towards going to be, and with hopefully we are seeing the peak of the tensions, trade tensions. We are the peak in the sense that it may last 90 days or 100 days, but I think post that again, I think the trend will be easing it down. So all directions are in the same direction. Clearly, I think we are in a very good spot in many ways. If interest rates are going to be benign or coming down, and our many things which government has done, including if you look at what they've done in power sector, what they've done in the roads, the logistics, all every aspect is now in place. So our own expectation is this is a time when we need to be positive. I think industry is a bit cautious because of all the tension around, but I think once that eases, you're going to see a massive push going forward. That's really the way I see it.
The question is, what is the timeline for that massive push going to be? But I'll come back to you in just a second on that issue. So industry expects rates to be cut, or at least hopes that the RBI will deliver with another rate cut. And the consensus in this room of a large number of India CEOs is that growth is likely to be between 6.8 to 7%. I should have polled a question on gold as well, Mr. Muthoot. Let me come to you. Gold prices at record highs. I mean, you're talking about peaking as far as trade tensions are concerned. Any signs of peaking on gold prices?
Gold has been always lucky with Trump, and Trumpism is driving gold. And the uncertainty in the global economy is driving gold prices. I think now the new gold is silver, with silver going to be the next driver of investment for the common man, because gold now has become unaffordable.
Gold has become unaffordable. Yes, I would imagine consumers will agree with that. But do you expect the rally to continue?
I could say that 40% of the Indians have become wealthier now, with the gold prices moving up 40%.
That certainly is the case. But do you expect prices to continue to edge higher from here? And what's the expectation on silver?
Silver would be around 45 is what market outlook, and gold would be somewhere at 3,800 per ounce.
3,800 per ounce. So the rally is likely to continue. Mr. Trump has been good for gold prices. Roshni Nadar certainly not been good as far as the IT sector is concerned. So let me come to you now, because the issue that has captured headlines has been what's happened as far as the H-1B visa issue is concerned. While we have seen some sort of a pullback, there have been clarifications issued by the White House that it comes into effect only from the next lottery year, that is 2026. It doesn't apply to renewals. But now they're changing the lottery system. It in itself is what the expectation is and what the proposal is. Roshni, to start with, the impact on Indian IT on account of H-1B, not just in the near term, but in the medium to long term.
So, Shireen, I actually think that, I'd mentioned this before as well, that we can't let this, never miss a good crisis. And if at all, if you've seen the trend of H-1B visa applications over, let's say, even the last decade, India's the largest proportion, but the number has been coming down.
Yeah.
And a lot of conversations today that you have with your clients, and we're all pretty heavily indexed on the US, is around AI adoption and AI-led deals. And there is a certain non-linearity in a lot of deal constructs in the way the entire sector is having to reimagine itself and restructure itself and reorganize itself. So, I mean, I think the pain is much more short-term and medium-term, but this is not just a problem for the industry. It is also a problem for customers, clients, and actually some of the most biggest companies which are hit by this are actually American companies.
Yes.
So one will have to navigate this. I think that it would probably drive those many more actual decisions on AI-led conversations and AI-led deals. And those are non-linear in nature anyways.
Yeah, so. Roshni, you're right in pointing out that this is going to impact US big tech far more than it will impact Indian IT, because the proportion of H-1B visas has been higher on the US big tech side, and India has been seeing a decline over the last few years, in fact down over 30% in the last few years. But in the near term, as you said, in the near term there will be pain. Do you expect a repricing of contracts? Do you expect that between clients as well as IT companies there will be an absorption of the higher costs?
I'm not sure, Shireen. I think it's only been 2 days, and that was Saturday and Sunday.
Yes.
And I think, and today is, of course, yesterday has already showed that there will be some difference in changes in, the way they're going to actually structure the new plan for H-1B and looking at highly skilled. Perhaps there will be, again, in the short term, but it could also drive more outsourcing, which then again goes back to a very different sort of pricing model.
But do you worry about the fact that now that the first salvo in a way has been signaled on services, because so far the battle has really been on the goods front, now with services getting into the fray on the outsourcing front as well, while there's a long way to go for the higher bill to become an act, to become legislation, that this really opens up a new front between India and the US as far as our trade relations are concerned?
Maybe, but I also think that it's impacting different companies very differently, and I think business mix makes a huge difference. At least for us, in the last 6 years, we've invested more than $3 billion in IP, and that itself is non-linear in nature, and we have a huge investment and business line in software. So I think that business models are changing, and we just have to adapt.
Well, speaking of business models adapting, let me take the H1B conversation forward, because Shashwat Goenka, as part of the group, you also have First Source, and I know that you've been hiring locally in the US, so perhaps less vulnerable to the changes. But as a company and as an industry, how prepared is India to move to product and platform, and whether this is in fact going to be the opportunity that this crisis presents?
I think definitely. And earlier today we heard that an opportunity is only worth its weight in gold if you take that opportunity. And I think it's for us as Indians to take that opportunity. And I think for us as First Source specifically, we're not very impacted with H1B, as you mentioned. But I think with this, there will be a rethink on the industry, and the push towards AI, which is what all of us have already been building towards, will probably translate to it much faster.
Move towards AI much faster. I'll come to Vivek Raghavan, the AI man on the table, in just a second. Of Sarvam AI, Vivek, I'll come to you in a second. But Satish Reddy, let's come to you. H1B, this was the sword that was hanging, and now it's out there in the open. On pharma, we still don't know. President Trump keeps threatening that something's coming, but we still don't know when, and we still don't know what. How ready is the Indian pharma sector for the possibility of higher tariffs?
I mean, like you said, we don't know, right? So we still hope it won't be anything which is punishing, because, again, if you see the outcomes, Indian exports to the US in pharmaceuticals is largely generics, and that goes to the people. So when it comes to the payers, finally, it's mainly the government, and also it's the common people who will be hurt the most. Right, so we certainly hope it won't happen, but even if it were to happen, I think it has to be an issue of, who will be able to absorb the additional tariffs, which we assume will be low, right? So between the distribution chain...
When you say low, what is the expectation or the assumption that you're working with?
There's no assumption, but we just expect it to be low because of the reason that I said. It's going to have a deep impact in terms of, the cost to the governments as well as to people. So we hope it won't be high. But at that point of time, then the question comes, how much of will it be absorbed by the distribution chain and also by the company? That's something we have to watch out for. But all of us hope the best case prevails, which is no tariffs.
But yes, of course, that would be the best case. What's the expectation? And that's another question that I'm polling here. What is the expectation on the India-US BTA being done? Those of you who believe that we are going to see the India-US BTA conclude, the expectation, the hope, the assumption was that by fall this year. Those of you who believe that it will be done by fall this year, by November, which was the timeline estimated, do raise your hands. And those who believe that it will perhaps spill over into next year, raise your hands. So those who believe it will be done by this year, the India-US bilateral trade agreement, if you can raise your hands, please. Okay, a fair number. Those who believe that it's likely to slip into the next year, next financial year or next calendar year, well, there's more who believe that it'll probably get done this year, so that's certainly good news. Janmejay Sinha, you just did a presentation on why you believe that American exceptionalism is over, and you believe that this is going to be an opportunity for India. What's the best case? What do you believe India needs to deliver on to ensure that we leverage on this?
See, the basis of American exceptionalism was limitless risk-free capital, talent, and R&D. All of those become available. So India needs to, of the $27 trillion of risk-free capital floating around in the US, even if we target 100 billion, which is nothing, but 100 billion, even if we create 9 centers of advanced learning or whatever, with 1,000 crores each, then we can attract and get these H1Bs and students to land. And if we, instead of having R&D at 0.56, move it to even 1% of GDP, then we are already on that way, in the sense that it is tragic that an opportunity of this magnitude, of this size, if we don't capture it, then we can sit here and in 10 years from now say, India misses opportunities. And to blame, it will not be the government.
Yeah.
It will be everyone sitting in this room. So everyone should look inside and say, I am a loser. fine, then India will be a loser.
So to borrow from John F. Kennedy, ask not what your government or your country can do for you, ask what you can do for your country. Let's throw this open. What is the number one thing that India Inc. needs to do to leverage on the opportunity?
Get talent. Everyone in this room should be trying to hire 50 people from the US. And I don't think they've got the plan.
Does anybody here have the plan to bring back those who are dealing with the uncertainty of H1B to India? Anyone here who wants to take up Janmejay Sinha's challenge? Shobna, go ahead.
I want to be proven wrong, Shobna. I want to be proven wrong.
No, I go with Roshni that says it's just been the weekend and this thing is still evolving. But I think it has been part of today's conversation that we look at it as an opportunity and we understand that there's enough talent. And many of these companies are looking for such talent as we transition into AI. We know that there'll be the best of healthcare. So for us, it's an opportunity. But the second opportunity I see for us is when it becomes tougher for the rest of the world to go to the US, India becomes a really good place. Like the Proton we have here in Tamil Nadu is the only one in Asia, and people can come from all over. So I think every one of us should introspect at this time to see how we can make this crisis work for us.
Roshni?
So, I mean, Shireen, just from our experience over the last 25 years of, at least investing in educational institutions for the country. But, I think it's time to also retrospect and question that why did that talent leave in the first place? And was it that they were just looking for better opportunities and jobs, but it was also the ecosystem? And if you have to create the ecosystem in the country, and, at the risk of sounding repetitive, because I've said this before as well, innovation and R&D plays a huge, huge role, and also the patent ecosystem. And it's absolutely critical that for a lot of this talent, which is unable to go now to the US or is considering coming back for, all these reasons, and could be other reasons as well, to continue to invest in building institutions, continue to invest in building R&D and research, and across various fields, right? I mean, I was mentioning to the Foreign Secretary earlier that sovereign technology. Each country is looking at building its own sovereign technology, whether it's in semiconductor, whether it's going to be in AI, whether it's going to be in quantum. They're actually going to be extremely exciting areas for people to come back and work in and do research in. And then, of course, Tamil Nadu wants to take even leadership in space tech. So there are very interesting opportunities, but people want to harness also the investment.
Yeah.
And that's going to be absolutely critical.
So
Stocks drift lower after weak overnight cues following Fed Chair Jerome Powell's stocks are fairly highly valued comment. Realty and IT are big drags even as metals eke out gains. Swiggy will sell its stake in Rapido to raise a little under 2,000 crore rupees. A move to sell Instamart on a slump sale basis to its subsidiary for cash will also add to its resource pool as it opens up fresh fundraise possibilities. PhonePe files with SEBI for an IPO, sources tell CNBC TV18. This will be via a 12,000 crore rupees offer for sale by Walmart, Tiger Global and Microsoft. The offer is likely to hit D Street only in 2026. India's Steel Secretary sees industry growing at 9 to 10% in FY26, up from 8% so far following GST 2.0. He also sees steel prices balancing from low levels on higher consumption. On the safeguard duty, he expects a decision before November 1st. Hello and welcome to Business Lunch live from the CNBC TV18 Motilal Oswal studio. I'm Vamakshi Doria, and so far today the markets have seen a fair bit of recovery from the day's lowest points. We're off the day's low by almost around 100 points, but nevertheless we still continued that trend of making lower lows each day as we've seen in the last couple of sessions. The mid-cap end of the market is also not doing too well. It continues to underperform the benchmark indices. Apart from that, the small cap index also not doing great. FMCG is the one of the few sectors that is trading in the green. Support coming in from Hindustan Unilever as well as Britannia. What's not doing too well is the realty pack. That index is down almost 2%. IT continues to be under pressure, and Nifty Auto, after the last couple of days wherein we've seen good gains for the auto companies, that index is also seeing a fair bit of correction. But moving on then, the Indian rupee opened strong after yesterday's record low close. But lost a bit of its early gains on strong dollar buying. Dealers say the RBI was supplying dollars. Lata is here with the market wrap. Lata?
The rupee opened exactly where it closed yesterday. That was about 88.75. Remember, on Tuesday it had gone to an all-time low of nearly 88.90, 88.80. Almost 88.79, if you please. After the steady start, it actually moved a little stronger. The dollar cost as cheap as 88.65 up to a point. And what dealers told us is that there was a goodish bit of supply from public sector banks, and that's usually a proxy for the Reserve Bank. It sells through public sector banks. There were dealers telling us that even in the NDF market, the offshore market for the rupee, also the Reserve Bank was supplying dollars. However, the demand for dollars was so incessant from FPIs. The foreign funds normally, if they have sold equities yesterday, they would come in and buy dollars today to remit it back home. So that dollar buying demand was pretty high. And so despite the offer from the Reserve Bank, the rupee stayed around that 88.70, 88.75 mark. The other factor impinging was the dollar index has moved a tad higher. Early morning, it was, say, 97.23. It went up to 97.45. So that has put pressure on many other Asian currencies also. All of them are down 0.33%, and that was impinging on the rupee as well. However, the expectation is that, there will be month-end flows as well. The Reserve Bank has shown a very firm hand, and perhaps, therefore, that trying to cross 89 will not be attempted by the rupee shorts. There is a general educated view among economists that at 89 the bad news is in the price. In fact, even at 88.75. So there isn't any need for further depreciation, but we have to wait and see.
Absolutely. Thank you so much, Lata, for bringing us that comprehensive roundup as far as the rupee is concerned. But let's put the focus on Swiggy then. The company is set to raise cash via a stake sale in Rapido and the sale of Instamart to a subsidiary. How will this affect its financials? Vinny is here with all the details. Vinny, over to you.
Hi, Vamakshi. Good afternoon. So firstly, let me take you through the news flow that's coming for Swiggy. Swiggy has divested around 12% stake in Rapido. This is one. The board has approved a sale of 10 equity shares as well as 1,64,000 approximately Series D CCPSs, which will be sold to Porus, one of the companies of Porus, MIH Investments. Now, other than that, obviously, the company is also going to be selling around 36,000 Series D CCPSs to Setu AIF, that is Westbridge's company. That will be around around 430 crores that they'll get from this. And from porous sale, they'll get around 1,968 crore rupees. So total that they will get from this stake sale is going to be around 2,400 crore rupees. Now, this divestment is something that the company had already spoken about in Q1 FY26 as well. Apart from that, there is a restructuring that the company has announced as well. The company said that now the board has approved a transfer of Instamart business for the company, including all the asset and liabilities of Instamart, to Swiggy Instamart Private Limited. That is a new wholly owned subsidiary of the company that will come in. This move will help them further smoothen the process that comes in for Instamart being treated as an India-owned and controlled company. So that is a main move coming in here, and plus Instamart is growing at a faster pace. So, obviously that also comes in as a separate sort of a business. Now, in terms of cash on books that are there for the company, cash on books as on 30th of June for Swiggy was at around 5,300 crores approximately. From Rapido, they'll get 2,400 crores, the stake sale over there, right? So overall cash balance by the end of Q2 we could watch out for will be somewhere around 7,750 crore rupees. Now, there are certain risks that come into play because the cash burn for Swiggy is at around 1,300 crores. This is the last I'm checking was in Q1 FY26, which is much higher than Zomato, because Zomato had an inflow that came in terms of cash of 33 crores. So there was not a cash burn that time. Now, obviously, because of this, what are the risks that actually play out for Swiggy? One, expansion plan risk that comes in. There's increased competition that comes in as well. And because of that, Blinkit also, when you look at it in terms of cash that Eternal has versus the cash that Zomato has, Eternal has much higher cash on their books as well. So they are giving a very strong guidance in terms of store count expansion that they have versus what Swiggy has been adding or even has going forward right now. Loss in terms of quick commerce business, that's widening for Swiggy. So that's a big concern coming in. And valuations for Swiggy is still cheaper than Zomato, but that's what we'll be keeping an eye out on. Right now, a bit of a concern and risk that are highlighted, that are the factors we'll keep an eye out.
Absolutely, Vinny. Thanks for highlighting all of that on Swiggy as well as Eternal. But moving on then, digital payment and financial services provider PhonePe is gearing up for its IPO. Ritu is here with more details. Ritu?
Well, Walmart-backed PhonePe, like you said, has filed draft papers with SEBI for a mega IPO, and this has been done through a confidential pre-filing route, a move that the company confirmed to us in a statement. Now, the IPO, of course, has been in the works ever since PhonePe shifted its base from Singapore to India back in December of 2022. It had then announced IPO plans earlier this year, and now sources are telling us that the company is looking to raise nearly 12,000 crore rupees, that is $1.35 billion, through an offer for sale in this IPO. Walmart, which is the majority shareholder with a near 84% stake, Tiger Global and Microsoft are the three shareholders that will participate in the OFS. That will involve a combined dilution of around 10% stake. PhonePe, remember, launched its digital payment app in 2016, and since then it has expanded into various financial services, including insurance, lending, wealth management, and even ventured into consumer tech with PIN code and the Indus App Store. It also recently received RBI's final nod to operate as an online payment aggregator, and it does remain a clear market leader when it comes to UPI payments with a near 46% market share. But there is a catch there. The NPCI has set a December 2026 deadline to cap any single app share at 30%, which gives PhonePe some breathing room, but only for now. Now, on the numbers front, very quickly, while losses are narrowing, PhonePe is not profitable yet for FY25. Its revenues increased more than 40% to about 7,100 crore rupees, the bulk of it from the payment services. But the net losses also remain. They came down 13% year on year, though, to about 1,727 crore rupees.
Thank you so much for that, Ritu. Indeed, the primary market continues to be abuzz. Lots of IPOs. In fact, I think we have 7 which have issues open right now. Thank you so much, and probably there could be one in the future. But on that note, let's slip into a very short break. Then we'll get you more news and updates on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, the Federal Reserve Chair Jerome Powell noted that asset prices are at elevated levels. Now, during a speech, the central bank chair was asked how much emphasis the Fed places on market prices and whether they have a higher tolerance for higher values. He said, and I quote, "We do look at overall financial conditions and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right, by many measures, for example, equity prices are fairly highly valued." End of quote. Well, Powell also said that the near-term risk to inflation is tilted to the upside. During a speech, he also spoke about the easing cycle. Let's listen in.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate.
Take a short break, then we'll get you more news and updates on the other side, so don't go anywhere. Thanks for staying tuned into Business Lunch. Now, at the United Nations General Assembly, US President Donald Trump accused China and India of funding Russia's ongoing war in Ukraine. He even called out the NATO countries purchasing Russian energy. Listen in.
China and India are the primary funders of the ongoing war by continuing to purchase Russian oil. But inexcusably, even NATO countries have not cut off much Russian energy and Russian energy products, which, as you know, I found out about 2 weeks ago, and I wasn't happy. Think of it. They're funding the war against themselves. Who the hell ever heard of that one?
Meanwhile, French President Emmanuel Macron makes a phone call to Donald Trump after his journey to the French embassy was blocked by police officers preparing for the motorcade of the US president. Macron, outside his vehicle, was speaking with New York police officers, asking to negotiate with them.
Guess what? I'm waiting the street because everything is frozen for you.
Well, interesting development out there, just goes to show that even presidents like us, aren't immune to roadblocks. So, yeah, that's what played out, but that's on a lighter note. But with that, that's all the action that we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar will take all of the action forward.
The markets are staging a bit of a recovery from the lows of the day as we go into the final 2 hours of the trading session. You're watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Vivek Iyer. Vivek, good afternoon. An impressive recovery that the Nifty has seen from the lows. Still in the red though, but comparatively lower. And FMCG stocks are the ones to thank.
Absolutely right. Yesterday, you did see quite a bit of profit booking come about in that particular space. So that's aided a bit of the recovery. But despite that, all of the 4 indices, even as we speak, trading in the negative territory. We have a lot lined up on the show. Some interesting insights coming from our research team as well. So let's start off with the top headlines. Stocks drift lower after weak overnight cues following Fed Chair Jerome Powell's comments that stocks are fairly highly valued. Realty, IT and private banks are the big drags, even if FMCG and PSU banks eke out gains. Midcaps lag.
Bajaj Electricals has zoomed on Morphy Richards' acquisition plans. It will acquire the brand rights and intellectual property for a 146 crore rupee outgo. The stock is up over 8%.
Sri Lotus Developers gains in trade as Motilal Oswal initiates coverage on this particular name. They have a buy rating on the stock and they believe that this particular company has established itself as a key player in the society redevelopment space.
Newly listed stock doing well, but IT stocks though continue to trade lower, and that is after the US Department of Homeland Security has proposed changes to the H-1B visa selection process. Mid-cap tech names like Coforge and Persistent continue to remain under pressure.
Aimco Elecon under pressure as a promoter group entity. Tamrock Great Britain Holdings is set to sell stake through an OFS and offer for sale. Almost 24% of the equity is expected to be sold via this particular route.
Well, it's been a recovery from the lows for the markets. The Nifty now nearing that 25,150 mark again. Of course, can't take away from the fact that we are still down for the 4th straight trading session. But you also can't take away from the fact that there's been a 100-point recovery from the lows of the day. 25,027 was the low that the index made. And since then, we are up 100 points now. At the highest point of the day is where the index currently is. So it's been a smart recovery that the index has had. And if you pull up the contributors chart, you would see that it is the FMCG names that have done well in contributing to this recovery, be it Hindustan Unilever, be it Britannia, and even for the likes of other FMCG names like Nestle. Of course, they are non-index names. Godrej Consumer, all of them have recovered anywhere between 2 to 3% from their respective intraday lows, and that is what has contributed to this recovery on the index as well. But you pull up the Nifty Bank, you'd get to know why the index was down to begin with in today's session. And since the Nifty Bank led the index higher, today it is leading the index lower. And even though there has been a relative recovery as well, around 150 to 170 points from the lows of the day, it still remains below key levels, below the 55,500 mark, and also below the 55,300 mark is the Nifty Bank. So this will be the index to watch out for going into the second half of the trading session, because a recovery here could propel a recovery on the Nifty as well. But shifting focus to the broader markets, then there are a lot of stock specific movers in today's trade as well, and Vivek is hopped across to the wall to tell us just that. Vivek.
Well, absolutely right. So many movers, especially as far as the broader end of the markets are concerned. But despite that, advanced decline ratio is still skewed in favor of declines, although it's recovered quite significantly in the last half hour or so. What are the stocks to keep an eye out for? First up, keep an eye out on Tata Investment, almost 8% higher, strong volumes. Minda Corp, ambitious 2030 plans unveiled, stock higher by 8%. Indian Bank, one of the top gainers on the NSE 500 index. Keynes Tech, clarity coming in as far as the management is concerned. And Himadri Chem, one name from the broader end of the markets, almost 7.5% higher. On the other hand, realty players, especially Mumbai-based realty players, are witnessing significant selling pressure. Have a look at most of these names: DLF, Oberoi, Godbridge, all of these names down anywhere between 1.8 to 3% in today's trading session. Some other laggards are a lot of names on the mid-cap IT stack, especially given the uncertainty that continues as far as H-1B is concerned. Look at eClerk Services, Sagility, and some exporters, names like Bharat Forge down 3%, one of the top laggards in the FNO space. Praj Industries down by another 2% today.
Interesting, Vivek. Thank you for those movers in the broader markets. Yes, real estate has been a bit of a pain point over the last few days, especially considering the stress that the IT sector is currently facing. But on to a CNBC TV18 exclusive then, the IRDAI has flagged off some concerns around high insurance commissions. Yash is joining in with more details on this. Yash, tell us more.
Well, that's correct. So this was the first meeting which took place between insurance CEOs and the new IRDAI chairperson, that is Mr. Ajay Seth. What we've been given to understand is that the regulator in this meeting did voice its concern when it comes to the higher insurance commission as well as the distribution costs involved in the business of insurance. This was voiced as far as the meeting with insurance CEOs is concerned. IRDAI had told insurance companies, the CEOs here in the meeting, that the distribution costs and the commission needs to come down for insurance to become economical for the policyholders. Of course, GST cut will do its bit to a great extent, but apart from that, the distribution cost also needs to come down. The commissions also need to come down to make insurance more viable, more economical for policyholders. The insurers that we've spoken to who were a part of this meeting, some of the large insurance companies, they suggest that a proposal to cap commissions or distribution costs can be explored, and this proposal could be on the lines of what the mutual fund industry did when it comes to the total expense ratio. Insurers, according to our sources, are also expected to submit a presentation with the regulator, that is IRDAI, explaining the rationale in terms of how the whole TER model for mutual fund industry worked, how it became beneficial in cutting down the distribution cost, and if it can be implemented for the insurance sector as well. Another suggestion which came from a couple of insurers is disclosing the commission that they pay on the policy document as well. You know, the demands of this has been raised in the past as well, but nothing moved. But again, the demand for disclosing commissions was raised. Apart from that, there were various other priority sectors or areas which were highlighted by the IRDAI chairperson. This included driving growth, enhancing insurance penetration, also focusing on effective processing of health claims. Apart from that, commitment towards social and rural sector as well as motor TP obligation was also highlighted by the IRDAI chairperson in the meeting with the CEOs.
Thank you so much, Yash, for joining us, bringing us the source-based exclusive information. Heightened clarity as well as maybe lower commissions is something that has been proposed. On the back of that, Policy Bazaar or PB Fintech, that particular stock, as you can see, has moved to the low point of the day, down almost 4%. But moving on, Jay Thakkar from ICICI Securities now joins in for a quick technical check of the market. Thank you so much, Jay, for joining us. Once again, we're seeing a lot of congestion as far as the Nifty's attempts to move higher is concerned. Jay, where do you see Nifty especially go from here on?
Good afternoon to you, Vivek, and as well. Vivek, see, it's like almost 4 days now that we have been seeing Nifty trading with a negative bias after having almost 8,000 points kind of a bounce back from 24,400 to 25,400. So as of now, it seems to be taking some pause. Mainly, what has happened, Vivek, is the private sector banks as well as the IT, Nifty IT, has weighed pressure on the index, because of which we have seen this 4 days kind of a correction. Otherwise, if you see market, probably auto is doing good. We had a good bounce back coming in the defense name earlier, and thereafter, realty name, railways, wherein there were a lot of shorts, as well as, the private the PSU banks. I mean, they are well in the upward momentum, and not to forget the metals. So if you see 50% of the market, Vivek, is weighing pressure on the Nifty, whereas 50% of the market is trending higher. So in this kind of a scenario, it seems that market may just take a pause or may consolidate within a range of say 24,700 to 800 on the downside to 25,400. Now that's a broader range of almost 800 points, which is approximately 3%. So I see Nifty at least until the expiry, monthly expiry, to trade within this range of 25,400 to 24,700. Once the expiry is over and once we get to know the rollovers, probably we'll have a better idea. So far, this range is what we see as of now, Nifty consolidating within this.
Interesting, Jay. Thank you for sparing time and joining us today with your views on the index. Looking forward to have you more often. Take a short break, more on the markets and the specific stocks on the other side. Stay tuned.
Welcome back to Midcap Radar. We promised you earlier that we'll get you some interesting insights on stocks from the broad end of the markets. Emco Elecon, one particular stock, is down almost 15%. A large OFS is in the offing. Vamakshi has been looking at this particular name. Vamakshi, give us more details.
Absolutely, Vivek. So this is one counter that we don't talk about very often, but given the kind of fall that we've seen in the stock, worth noting, Tamrock Great Britain Holdings, who is a promoter of, one of the promoter entities of the company, will be selling stake through OFS. Now, keep in mind that on June 4th itself, Tamrock had sent a letter to IMCON, and they had said that they did have plans of, sort of a possibility of a stake sale. And if you look at, the shareholding for Tamrock, they hold 24.68% stake in the company as of June 2025. Now, let me share more details of the OFS with you. Now, they are likely to sell 7.23 lakh shares, which is around 12.55% stake, which is the base offer size for the company. Now, they also have an oversubscription option. So, an additional 7 lakh shares could also be offered if the green shoe option is exercised. So that's another 12.14% stake. So, and if this does go through, the promoter group will sell its entire 24.68% stake in the company. Now, the offer has opened for non-retail investors today and will open for retail investors tomorrow. The floor price of the offer is at 1,400 rupees per share, and if we compare it to the close yesterday, which was about the 2,000 mark, it's a discount of almost 31% coming in for the promoters. So, given this development, the stock is declining in trade today.
Oh, well, another 17% away is the floor price. The stock is already down 15%. Vamakshi, thank you for that very interesting update there. The OFS, another promoter exit in the offing in this market. So, Emco Elecon, 15% lower, promoter planning to sell its entire stake through that offer for sale. The index, well, still 50 points lower, so no major moves there. We take a short break here. On the other side, we get you more on the markets and specific stocks. Stay tuned. Welcome back. Just before we go to Ria on that positive brokerage note on Sri Lotus, pull up PB Fintech, and that stock has now slumped to the day's lowest point, or more than 5% down on the stock. And this is just minutes after Yash did his exclusive on the IRDI. There you can see a very sharp slide on PB Fintech in the last few minutes. Now 5% lower on that stock, 17.15, and IRDI, of course, expressing concerns on their high insurance commissions and distribution costs since meeting with the CEOs of the sector. That is the exclusive that Yash just brought to you a few minutes ago. So that is having an impact on PB Fintech. But what's having a good day today is the newly listed Sri Lotus developers, and that is on the back of a positive brokerage note that has come in from Motilal Oswal, and Ria is here to tell us just that. Ria.
Well, yes, Thomas, just before we go to the details of the brokerage note, let's take a look at what the company does. They are a developer of residential and commercial projects based out of Mumbai. The company is primarily focused on redevelopment projects in the ultra-luxury and luxury segment in the western suburbs of the city. As you said, the company was recently listed and they raised about rupees 792 crores through its IPO. Now, Motilal today has initiated coverage on the stock with a buy call and a target price of rupees 250, which is a 35% upside compared to yesterday's closing. Over the last 3 financial years, the company has clocked a pre-sales CAGR of around 39%. Currently, they have completed 4 projects, and there are also 5 ongoing residential projects with a combined potential value of around rupees 1,900 to 2,000 crores. The company is also currently executing projects worth around rupees 2.6 million square feet, 89% of which fall under the redevelopment model. Now, they also have 8 upcoming residential projects with a GDV potential of 7,000 to 7,500 crores. These are to be completed by the end of FY27, and they're also developing 3 commercial projects with an estimated sales potential of rupees 3,000 to 3,500 crores. The company is also net debt free, which adds to the optimism from Motilal Oswal. They have estimated that pre-sales are expected to post a CAGR of 129% over FY25 to 28, which is guided by the company's strong project pipeline, and they are also expected to generate a cumulative operating cash flow of around rupees 6,900 crores by FY32, with operating margins exceeding 40%. So on the back of this positive note coming in from Motilal, the stock is up around 5.5% in trade at the moment.
Thank you so much, Ria, for joining us, telling us all that's happening as far as Sri Lotus Developers is concerned. This is a newly listed company or a recently listed company, and a positive brokerage note taking the stock higher by almost 5%. Well, a couple of stocks on the radar. Remember, yesterday the Nifty metal was the one that actually outperformed. Today, you're seeing a little bit of that continue. JSW Steel, this particular stock, near the day's highest point. Patanjali, that particular stock too has moved to the high point of the day, and a little bit of recovery being seen among some of the pharma names. Names like Cipla have recovered to the day's highest points. Some movement also seen in the insurance space. While we spoke about Policy Bazaar, some of the life insurance companies, especially HDFC Life, that stock has recovered and has now moved into the green territory after spending most of the day in the negative territory. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon and welcome to your stocks on CNBC TV18. We're coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Today we're seeing that the markets have opened up in the red, and that's why they're managing to hold on to not much any sharp sort of a downtick we're seeing, or an up move as well. Look at it, most of the indices are trading in the red, but they look at the broader end of the markets or even the benchmark indices, they're managing to not hold on to any sort of a gain, and the levels that we've seen them since the morning, that's where they are at, right? So Nifty 25,100 levels is what the Nifty is managing to hold on to. Nifty Midcap continues to be down 0.7%, so that underperformance is coming from the broader end of the market, and clearly that advance decline ratio obviously is in the favor of declines versus advances today that we're seeing. Nifty IT, that continues to be under pressure. Nifty Bank, that's another one that is down 0.5% in today's trading session. Now let's talk about some of the sectors that are managing to hold on to gain. We've seen FMCG that's managing to hold on to gains of almost 0.5%. So that is what we'll be watching out for. And metals, that's flip-flopping between the red and the green right now. So keep an eye out on that one as well. Nifty Metals was in the red. It's coming back to the green, but not any sort of a comfortable recovery that we're seeing. But keep an eye out on Nifty Metals going forward as well. But on that note, let's get started the show for today. This is a show where we solve all your stock-related queries. So for that, we have our guest joining in with us, Parthiv Shah, Director at Tracom Stockbrokers, as well as Somil Mehta, Head of Alternate Research Capital Market Strategy at Mirae Asset Sharekhan. Somil as well as Parthiv, good afternoon and thank you so much for joining us on the show. Let's get started with the first query for today. We have Radha Krishna, who's writing to us from Bangalore. She's holding 400 shares of PCBL Chemicals. This is at a price of 520 rupees per share. So they're making a significant loss on this one because now the stock is just at 389. Wants to know if they should continue to hold this, exit, and maybe look at buying delivery. Parthiv, let me start with you. Good afternoon. And is delivery a better option than PCBL? And they're making a loss. So what should they do now?
Very good afternoon to you too and our viewers. See, I think in terms of PCBL, we know for the fact that it is the largest carbon black company in the country, and they've been continuously upping their capacity. I think the reason why the stock has languished off late, and in terms of the EBITDA by ton is also a little languished in terms of the pricing power, is because of the continuous dumping. But the management was quite vocal, attributing to the fact that this dumping issue would recede over time. And more importantly, I think they gave an update regarding the large carbon black manufacturer globally, which is Orion. They are looking to shut down a lot of their excess capacities in Europe and US, which should bring a lot of relief by the next 6 months for companies like PCBL. So that is, I think, good news. But secondly, I think if you look at the last quarterly results, the carbon black volumes were a little tepid quarter on quarter. And I think the plants are operating at very optimum utilization levels of 97%. The company has huge expansion plans, which will come on stream by 27, 28. And by FY28, the company is guided for delivering almost 1 million tons of capacity. So I think if the investor has a very long horizon for the tune of at least 3 to 5 years, then probably it makes very good sense to hold PCBL. Talking about under 12 months, I think it's very difficult call because the carbon black cycle currently is not looking well. But things can change. So better to have a longer term horizon than stock like PCBL.
Okay, but you wouldn't say exit, right now and buy delivery?
Not really, I think, because the prospects are looking good. The plants are operating at higher utilization levels and they have capex plans. So I believe that it's well placed over longer horizon.
Okay, well placed over long term. So keep an eye on PCBL. Continue to hold it for the long term. Somil, good afternoon. And PCBL, what's your view coming in? PCBL over delivery or delivery over PCBL? What's your bet?
Good afternoon to everyone. I'm okay with both actually.
Okay.
PCBL and delivery both are looking good to me for long term, for short term. In fact, in the very short term, I would prefer delivery because it has taken support at very crucial levels, and it could go up till 480, 490 levels for delivery. And I'm positive in the short term, medium term, long term, all three time horizons for delivery. PCBL, on the other hand, it is in a range between 340 and on the upper end, it is 440. So now this range has to break on the upside. I'm expecting this range to break on the upside because the higher degree momentum indicators are on the buy side. Overall chart structure looks great and the long-term trend is also up. So positive on PCBL, not in the very short term or medium term, but in the long term, I'm expecting it to start a rally after the breakout of this range.
Okay. So long-term view for PCBL is positive. Short-term, yes, you can continue to hold, but long-term is where we should be keeping an eye out on the fundamentals as well as the technical front. Let's move on to the next query. We have Bala Subramanian, who's writing to us from Bangalore. He's holding 30 shares of ACC. This is at a price of 2,561 rupees per share. He's asking if he should book his losses and move to other counters in the same sector, maybe like an Ambuja Cement. What is your view on this one, Parthiv?
See, I think if you look at the strategy of Adani Group in terms of the cement sector, I think they've acquired both the companies, ACC and Ambuja. And post-acquisition, I think they've issued a lot of capital in Ambuja, warrants to the tune of 20,000 crore. And they've used all of that to do a lot of inorganic acquisitions. They bought Sanghi, they bought Penna Cement, they also bought Orient Cement. All of that is currently housed under Ambuja Cement, and probably they have plans to synergize the two acquisitions and also kind of amalgamate with Ambuja Cements. And eventually, our sense is that even ACC will also be part of Ambuja Cements. Of course, it's a difficult integration, but post all the restructuring at ACC, that is going to happen. So it seems like I think the flagship company in terms of the cement sector for the Adani Group looks like Ambuja. So it will not be a bad idea to switch his ACC position into Ambuja Cements. And looking at the long-term plans, I think currently the capacity is around 105 million tons per annum, which is going to go by at least 140 million tons per annum by FY28. So there are huge expansion plans. There are huge cost synergies going ahead with the group ecosystem. And more importantly, the management is targeting long-term EBITDA by ton levels of 1,300 to 1,500, which will be industry leading. So I think good going, and valuations are not very stretched at this juncture for Ambuja Cement. So I think one can hold it for long term.
Okay. You can look at Ambuja Cement and hold it for a long term. Saumil, what's your view for ACC? They bought it at 2,561, right? And when you're looking at it in the last 1 year, ACC has fallen 24%, Ambuja is down 5%. Would you say they should, book their losses and look at Ambuja as well?
I would definitely look at Ambuja more because the structure looks better. And if you want to switch, you can switch half of the, your entire amount. ACC, very specifically, there is a multiple support around 1750 and 1600 levels. So that is a support zone. I'm not expecting ACC to go below those levels. And I'm expecting ACC to make a basing out pattern around these levels and then break on the upside. So overall, if you see very long term, ACC looks all right to me, and I'm not expecting ACC to go below 1600 levels. On the other hand, Ambuja is definitely looking great in the long term, in the medium term outlook. In fact, even in the short term, it has just taken support at 200 daily moving average and has started higher top, higher bottom formation. So Ambuja would be my preferred pick.
Ambuja would be your preferred pick as well. Let's move on to the next query for today. This is coming from S. Jaykumar, who's writing to us from Tamil Nadu. He's holding 1,000 shares of Kalyan Jewellers. Is at a price of 506. They're making some bit of a loss here. He's a long-term investor, wants to know the prospect of his investments in Kalyan Jewellers. Parthiv, your view for Kalyan Jewellers, when you look at it in terms of numbers, they have been strong in terms of the performance in Q1 FY26 and even before that. But what should they keep an eye out on now? And should they look to average or, get out of the stock? Long-term investor.
The gentleman comes from South Tamil Nadu, so no doubt the query is on a gold-related jewelry company. So, see, my sense is that at one point in time when Kalyan's valuations were cheaper to the tune of 25, 30 trade multiples, I think it was an attractive bet. The company was doing all the right things in terms of the growth levers. But my current concern is regarding the trail valuations of around 62, 65. I would any day prefer Titan over Kalyan at these valuations. I would prefer to pay a little premium to Titan over Kalyan because I think it's very simple in terms of the organized jewelry retail market. I think Titan has almost 8% market share, and this market share is continuously growing because of a lot of unorganized players not able to cope up. And I think Titan in terms of its footfalls, has almost 1,100 exclusive branded showrooms, outlets, and they are continuously expanding. So, which is, I think, the reason why I believe that almost 85% of the revenue mix of Titan comes from jewelry, and the watch segment is also growing reasonably well. The eyewear is also growing reasonably well. So overall, I feel that Titan has all the potential. The management is guided for FY26 in terms of growth, almost double-digit growth, and more importantly, sticking with the margin band of 11.5%. So I believe Titan is a better bet over Kalyan at this juncture.
Okay, Titan is a better bet over Kalyan at this juncture, but you were saying, right, what is there in terms of move? Gold prices glittering so high. I think that has given the best returns among all of this in the last 1 year. But Saumil, what's your view, for Kalyan Jewellers? They're making a loss on this one. Would you say this 506 level, which they bought it at, can be achieved in the medium to long term?
I don't think so. View is negative, definitely lower top, lower bottom formation, struggling to go about 200 daily exponential moving average for a very long time now. It was above the average, but it did not sustain. It has broken out of a small triangle pattern on the downside now. So in the very short term, it is looking negative. In the medium term also, it is looking negative. The next targets on the downside would be around 400 levels, and if it does not sustain around 400 levels, then the next level would be 330. So negative in short term and medium to long term as well.
Okay. Negative in the medium to long term as well. So not much of a positive commentary coming in there for Kalyan Jewellers. On that note, we're going to sip into a very short break, viewers. Don't go anywhere. On the other side, we'll still be solving all your stock related queries. Stay tuned in. Welcome back to Your Stocks on CNBC TV18. We still have with us Parthiv Shah as well as Saumil Mehta to answer all those stock-related doubts. As of now, Nifty is just at 25,100 levels, just about that mark. It's just managing to hold on to 25,100. So keep an eye out on that. Let's move on then with the next query for today. We have Ashwin Kumar, who's writing to us from Bangalore. He's holding 150 shares of Metro Brands at a price of 794 rupees per share. They're making a profit on this one. Wants to know whether to hold or to switch to some other stocks. Parthiv, what's your view for Metro Brands? Obviously, that whole GST rate discussions and the rejig that's come in, right? So that does benefit in terms of the consumption side of the story. But Metro Brands as such, should they continue to hold or book out their profits?
I think we can continue to hold because what we like about Metro Brands is they focus more on premiumization. And despite a very sluggish market where we had early onset of monsoon and some of the festivals which were clubbed, I think what we saw was that they did manage to grow the top line to the tune of 9% year on year. And that is good execution if I compare that with the other peers like say Bata. I think that was very good growth. EBITDA margins were held up pretty well at 31%, which is kind of industry's best. And more importantly, I think management's commentary was pretty upbeat. Now, thanks to the fact that the GST cuts have taken place, in the budget we saw government had incentivized entry-level footwear, where I think Metro has so far not targeted, but they can have that segment as well. And more importantly, they had 23 store additions. They rationalized some of the stores. So overall, we believe that FY26 overall should be a good year of growth for them. And more importantly, I think the Fila brand is kind of slightly turning around for them. The Clarks footwear is also doing well for them. So they have very good brands, and with the consumer sentiment improving, this is a very good proxy. So we are a beat on this for the next 2 to 3 years.
Okay, a bit on this for the next 2 to 3 years, so can continue to hold. On the technical front, Saumil, could they expect more profits coming in for Metro Brands?
Absolutely. I'm positive in the medium term and in the long term both. Metro Brands is making a huge triangle pattern, and I'm expecting this to break on the upside. The supports are a little deep because the entire triangle is huge on the monthly chart. So the 200 daily moving average, which is at 1180, that will be a very, very crucial level to watch out for this stock. And I'll be expecting new highs, definitely new highs and above 1550 levels as well in the medium to long term. Long term, you can keep trailing your stop losses and keep holding the stock.
Okay, keep holding the stock. That's the word coming in there. Let's move on to the next query. Again, this is one of those candidates that do benefit from, the GST moves that have come in and the changes in terms of rates. That is Arvind Limited. Now, we have KS Rao, who's writing to us from Andhra Pradesh. He's holding 200 shares of Arvind. Price is 50 rupees per share. He's asking whether to continue to hold or sell at current levels. Parthiv?
We are beat on Arvind for the long term. No doubt, I think major uncertainties regarding the US tariff has impacted the sentiment in this sector. And also it has impacted the Arvind's, and its valuations have derated from the peak. But I think management believes that, overall, this is kind of the peak, can't get worse than that. And probably they are scouting for other opportunities, especially post the FTA with UK. I think currently India exports $1 billion worth of garments in UK, which they feel that it can easily double over the next 3 to 4 years because of the cost competitive advantage post the FTA. So I think they are focusing there. More importantly, I think Arvind's most important vertical, which is the advanced materials division, they're going to have more capacity, and we've seen fantastic growth so far with very reasonable 13-14% margins. The order book there is very strong. They're getting orders from railways, defense, and some other sectors. And once their capacity is there, I think they'll be able to execute it very well. This is one business where we feel that can be valued in terms of some of the part valuations. So we feel Arvind, the gentleman's entry point is at $50, which is very low. Certainly hold on to this company for long term.
Okay, and Saumil, your view on this one?
Positive on the stock as well, but in the medium term outlook, I think it could go till 260 270 levels because it is sliding down in a channel, and all the legs would complete around 260 to 250 levels, and then again an upturn. But in the long term, I'm definitely positive. The long term trend remains positive. I'll be expecting new highs, but the buying price should be around 260, 250 levels. So my suggestion would be to hold on to the stock.
Okay, hold on to the stock. That's a view coming in there for Arvind Limited. But that was the last query for today. So Saumil as well as Parthiv, thank you so much for joining us on the show and helping our viewers solve all those doubts that they have. But with that, we'll wind down the edition of Your Stocks. Thank you so much for tuning in. And remember, you can always email us your queries on the email ID that's flashing at the top of the screens for you all. But don't go anywhere. Last hour of trade is still left. And for that, you have Closing Bell up next.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
So Nikkei also is trading with cuts of almost 0.4%. ESX 200 is seeing a sharper fall, 1% decline almost.
China and India are the primary funders of the ongoing war by continuing to purchase Russian oil.
Resistance here, 55,835 and 56,156.
We got further shocked when we then being told that, this is it that is there.
89 will be targeted by those who are worried.
So 25,150, 25,140, it's about 0.12% lower.
The imports from China have reduced significantly.
Getting done with the first 2 hours of this midweek trading session, and it is yet another down day for the index.
The consensus in this room of a large number of India CEOs is that growth is likely to be between 6.8 to 7%.
An impressive recovery that the Nifty has seen from the low. Still in the red though.
Okay, it is a sideways kind of a day. Market breadth is negative, and I think the pause continues, which began last Friday. So it's been Friday, Monday, Tuesday, and today, Wednesday, middle of the week as well. Not going anywhere after that 1,000-point move that we had from the lows. This is Closing Bell coming to you live from the CNBC TV18 Motilal Oswal studios. Surabhi and Reema with me here. Nigel is joining us from the newsroom floors. Guys, good afternoon.
Hi, full house today.
Yeah, absolutely. So
Why is that said like a surprise?
Because we've not had it,
very
right?
busy people.
It's a full
Yeah.
It's a full house.
But today, all here, so looking good. But actually, I'll tell you what, maybe that pause doesn't hurt, a small decline doesn't hurt today because we're not alone in it. European markets have paused. Asia didn't do too much, thanks to the fact that the US Fed is now making some statements on whether asset prices, especially equity prices in the US, whether they're getting a little overheated. So I think it's kind of just put on the brakes, at least for now, guys.
Okay, and
Nigel is not interested. He's like, I don't care about the Fed.
All right, let's just take it from the top then, right? In terms of just a few things, and we'll move forward quickly. 80 points lower on the Nifty. We're about, 25,080. Which basically means what? Which means we've broken below yesterday's lowest point. Yesterday's low was 25,084. We're actually at yesterday's low right now as we speak. And that was the level that we put out in the morning in terms of a support. We'll see if it holds or not. But certainly in terms of coming off the highs, it's been kind of one way. Fourth day, fifth day? The high was fourth day. The high was made on the 18th of September. The high was 25,448. And you've basically given up about 400 points, a little over 400 points from that particular point. Nifty Bank is the other one. It's down about 0.75%. Yesterday it closed in the green. But here as well, there is some pressure which is coming here. The high recently was about 55,835. So about 750 odd points given up here. The small cap index is down 0.5%. And I think you got the mid-cap index, which is also down. Mid-cap index is down about 0.75%. And I think that's the reason why market breadth is negative. Just a quick teaser of what's coming up here. So markets, of course, off the lows, but of course remain lower as well. So closer to 25,100 now, slightly under it. FMCG, PSU banks or sectoral gainers. Real estate is down 2%. No particular reason that we could spot. There's a big story, and on the back of it, there is a big stock move as well. So Yash will join us shortly, insurance regulator, essentially saying commissions, distribution costs, etc., should be lower across the insurance industry. We'll talk about that in just a bit. There's Minda Corp, which is higher. It's eyeing a revenue scale up to 17,500 crore rupees and other ambitious targets as part of the 2030 target. Stocks, of course, higher. Bajaj Electricals is to acquire brand rights from UK-owned Murphy Richards. So famous brand, and stock is higher on the back of that as well. So this is looking pretty solid. Nigel?
Well, that's right. Let's get straight then to the call. The market's a little bit lower. Mitesh Thakkar joins us from Bonanza Portfolio to help us out with whether or not you should buy the dip. Hi, Mitesh. Good afternoon. Good to see you, Ben. Tell me, how do you see the markets pan out from here on? And will you look to buy this dip?
Good afternoon, Nigel. So I think, the decline has been slightly more than what I was kind of anticipating. I was hoping 25,100 comes into place. But then, we have broken below that. The indicator is still rising, which means that there's still a chance of a pullback happening, or the market's kind of getting into an up move kind of a zone. But now we need to capture 25,150 again. So I think on the index per se, turn positive once 25,150 is being captured, and then we can look at further upsides. Till then, I think people who are trading the index, I think, might want to keep things slightly quiet. And on the stock side, I have a sell on Hero Motors with a stop at about 53.30 and a target of around 5,200 to begin with, and then maybe we'll look at some more correction happening over here. The stock has rallied and could give a pullback. And the second stock which I have, that's a buy on Indian Bank. Keep a stop around levels of 703, and look for target of 750.
Okay, thank you very much for that. We'll reconnect. In the frontline pack, it's many of these power stocks higher in trade. So Power Grid is your top gainer. Crossed the 200-day moving average, inching towards 300. NTPC is up and about. Buying emerging in consumption names. They were down yesterday, but today on the front foot. HUL, Nestle seeing some interest. And Maruti Suzuki continues to be on everyone's buying interest. 50% up so far this year, but buy calls continue to come in. Goldman Sachs today upgraded Maruti, raised the target price to 18,900. Investec too has raised the target price to 18,500. So everyone sees more upside in Maruti Suzuki even after the run-up. IT, though, is on the back foot, and this week the Nifty IT index is down 4.5%. But let's get to the big insurance story, and this is an exclusive. Now, IRDAI has flagged some concerns around high insurance commissions. It's pushed the stocks lower. Yash is joining in with the details.
Well, this was the first meeting which happened after the new IRDAI chairman, Mr. Ajay Seth, took over the position. Of course, it was the meeting between the chairman and the CEOs of insurance companies. And what we are given to understand from our sources is that the IRDAI chairman expressed concerns when it comes to the high distribution cost, the high commissions which go behind selling insurance policies. The chairman was of the view that, after GST changes, there's a large benefit which comes to policyholders. But if the commission cost can be lowered, if the distribution cost can be lowered, then insurance products can become more economical for policyholders. We are given to understand that the industry also in the same discussion did accept that the commission cost remains high and steps need to be taken when it comes to bringing down the commission cost. One suggestion which came from a few large insurance companies in the same meeting was also to evaluate and study the mutual fund model with respect to the total expense ratio, how the total expense ratio for mutual funds was capped, and the insurer suggesting that if some kind of capping on the mutual fund TER model can also be thought through and implemented as far as the insurance sector is concerned. What we've been given to understand that all these insurance CEOs are expected to submit a presentation to the IRDAI chairman in terms of ways in which the insurance commissions can be capped, and then it would be in the regulator's court to take that proposal forward. Also, what we've been given to understand is that the regulator, IRDAI, is expected to make subcommittees on all these strategic focus areas, out of which reducing commissions and making insurance more economical would also be a strategic focus area. And the subcommittee will also give its suggestions on capping commissions. Apart from that, as I said, many more strategic areas like enhancing the health claim servicing facility, like increasing penetration, focusing on growth, as well as commitment towards motor third party and social rural obligation were also flagged by the new IRDAI chairperson.
Just to make it clear that, by the way, the stock PB Fintech, and Yash is with us. PB Fintech was down almost 6.5–7%. It's recovered a little bit from the lows, but still down 4%. Just to make it clear, this is, it's been, it's a long-standing kind of thing. There was, of course, Bima Sugam at one point in time, and that was kind of also aimed at lowering costs, distribution, commissions, etc. But this is now a new one. I mean, Yash, this is the first time this mutual fund TER has been, I don't remember this MFTER model being talked about at all, right?
This is the first time the mutual fund TER model is being talked about and being explored by the industry. In fact, I forgot to mention one important point. One more suggestion which came in the same meeting was if insurance companies can disclose the commissions that they pay on the policy document itself. This demand has come in the past as well, but could not be taken forward. But it's come up again in the meeting with the IRDA chair.
We've reported on that. I remember we reported a couple of years ago, we reported on that, but never went anywhere. So yeah, but again, everything proposal, discussion, exploration, and we're just reporting to you what those things are. Nothing has been decided, and this will be taken forward. We'll keep you posted. But stock, of course, taking note of that story.
It's an important one. By the way, I mean, for PB Fintech, it's been a range-bound year, like it has been for better part of the market, the index at least. Stock is what I think down 5-6% for the year as a whole, and it is off its peak as well. Let's discuss this and more with our first guest on the show. Sudeep Bandyopadhyay is with us. Sudeep, great to have you on. PB Fintech, never a dull moment in the insurance land, but PB has usually weathered most of these storms. It still had a big grip over the online distribution model. How would you view this, even though it is purely a discussion at this stage, nowhere close to being an actual regulation, if there is some sort of cap on commissions?
I think this has to be a very well thought out strategy by the insurance regulator. Insurance is a different product. Mutual fund is a completely different product. While you can distribute mutual fund in a manner, the same cannot be applied directly to insurance products. It does require a certain amount of selling, and it has got certain amount of inherent costs. So, trying to replicate the model may be a bit of a challenge. The bigger question to my mind is the penetration of insurance, which is significantly lower in this country. And, pretty much everybody, whether it's a regulator or the insurance companies, should really focus on that. Of course, bringing down the cost for the general public who are the buyer of insurance product is definitely a right strategy, but it has to be calibrated and done in a very, very thought through, well thought out manner. I think this is the reason why many of the earlier proposals, including Bima Sugam, didn't really catch the fancy of the market, and it never went anywhere. So I would say I will take this with a pinch of salt. It's not so easy to bring down the costs of distribution because it does have certain amount of costs.
So are you, I mean, on the stock, sorry, Sudeep, just to understand, so on the stock, I mean, what's your call? Buy, sell, hold, or not looking at it?
PB Fintech, I'm positive. I think they've done a fantastic job. These kind of daily fluctuations will keep on happening. But if you're looking at a long-term story, I think PB Fintech is a great buy from a portfolio perspective. Insurance penetration has a long way to go. And PB Fintech is the stock if you're looking at a platform play on insurance.
Sudeep, any interest in shipping names? Because shipping stocks are in focus, and there is some buzz that at the cabinet meet later today, we could have some big announcements. So CNBC Awaaz is reporting exclusively that 3 schemes worth 70,000 crores could be unveiled for the shipping sector later today. So they include shipbuilding financial assistance, 25,000 crore, a maritime development fund, again 25,000 crore, and a shipbuilding development scheme, 20,000 crore rupees. I think some of these stocks have come off, but SCI's higher in trade. This is an Awaaz. And just last week, infrastructure status was also given to some of the large ships. Any interest in these stocks?
Well, I do like the shipyards, all 3, Mazagon Dock, Cochin Shipyard, as well as Garden Reach. I think from a long-term point of view, all 3 do look good. But you have to remember that the valuations at this stage are not cheap. So if you are buying, buy with a long-term view. Out of the 3, if I have to buy one, I'll go for Mazagon Dock. I think it's doing pretty well, ticking all the right boxes. But the valuation is rich. That's the only challenge. So it should be bought for long term. As far as the other components of the shipping industry is concerned, I think the fundamentals need significant improvement, whether it's a SCI or the other private shipping companies. At this stage, I won't venture there. I think shipbuilding is what the focus of the government is, and I'll rather look at shipyards than the shipping companies.
Shipyards, but the valuations are on the higher side as of now. By the way, let's talk about IT, because that's a sector which continues to see selling pressure. The Nifty IT index is down 4.5% so far this week. And even today, Mastech, Coforge, Wipro, Tata Tech Mahindra, First Source, Emphasis, we're seeing cuts ranging between 1 to 3%. So there is more news on H-1B visa. Over the weekend, there was news about the H-1B visa fee going up to $100,000. Now what the proposal has come from the US Department of Homeland Security, DHS, that instead of the random lottery system, which is so far up until now used to select H-1B visas, they're proposing a weighted system. Basically, give preference to higher skilled and higher paid workers. So just to give you a context, over the last couple of years, about 80% of the H-1B visas went to level 1 and level 2 employees. These are basically your entry-level or qualified workers, and they earn a median salary of $85,000 to about $100,000 respectively. But on the other hand, the experienced workers or the fully qualified workers, which are categorized as 3 and 4, and they earn a lot more, going up to $165,000, have historically got a smaller share of visas. So therefore, under the new system, they're proposing to abolish the random system, lottery system, and give a higher weightage. There's a higher probability of level 3 and level 4, the more skilled workers, the workers who earn more, they're likely to get more visas. And according to DHS, this could bring in an estimated $500 million of economic benefit in the first year alone. As of now, it's open for comments, 30 days. And after that, I think the government will take a decision on that. So that is the latest blow. It's important because 70% of the H-1B visas have gone to Indians, not impacting the tech companies only, but even the big tech companies, consulting firms, but they do take in Indians. In fact, on this subject, earlier Shireen was moderating a panel of top India Inc. voices. Roshni Nader Malhotra of HCL Tech shared her views on the ongoing H-1B visa fee hike and its impact on India. Listen in.
I'd mentioned this before as well, that we can't let this, never miss a good crisis. And if at all, if you've seen the trend of H-1B visa applications over, let's say, even the last decade, India's the largest proportion, but the number has been coming down.
Yeah.
And a lot of conversations today that you have with your clients, and we're all pretty heavily indexed on the US, is around AI adoption and AI-led deals. This is not just a problem for the industry, it is also a problem for customers, clients, and actually some of the most biggest companies which are hit by this are actually American companies.
Yes.
Innovation and R&D plays a huge, huge role, and also the patent ecosystem. And it's absolutely critical that for a lot of this talent, which is unable to go now to the US or is considering coming back for all these reasons, and could be other reasons as well, to continue to invest in building institutions, continue to invest in building R&D and research, and across various fields, right? I mean, I was mentioning to the Foreign Secretary earlier that sovereign technology. Each country is looking at building its own sovereign technology, whether it's in semiconductor, whether it's going to be in AI, whether it's going to be in quantum. They're actually going to be extremely exciting areas for people to come back and work in and do research in.
Sudeep, there's so much uncertainty surrounding Indian IT, but as Roshni was saying, never waste a crisis. It throws up an opportunity. Is there an opportunity to buy Indian IT right now?
Well, I think it's better to be careful as far as large cap IT companies are concerned. Beyond this H-1B crisis, I have been talking about this entire emergence of AI. I think, beyond whatever we are talking about AI will enable the US corporates to push for reducing the cost of contracts, and that will lead to contraction of margin for Indian IT companies because they don't have their own AI products. They have to depend on third-party products to provide the necessary services. So as far as Indian large cap IT companies are concerned, I think they will face margin pressure, and we have to watch this evolving scenario very, very carefully. I do like some of the mid-cap IT companies who are providing service to niche segments like travel travel and tourism. Now, travel and tourism is booming, and the people who are servicing travel and tourism industry, they are expected to gain and continue to gain momentum. Similarly, there's a transition happening in automobiles from ICE to EV, and a lot of IT companies are providing service in this segment. One should focus on these niche IT service companies and start building position there. So a rate gain technologies, persistent systems, companies like that who are specialized. And these are the segments one should look at, not general IT service providers.
Rate gain? It's been a bit disappointing. I don't think the stock has done very well because it used to grow historically very well. And I think this year they've given a single-digit guidance, top-line growth guidance. So is that on your buy list at this juncture? Let's pull up a one-year chart of rate gain to see. This year it's down close to about 8% and 1 year will also come up. So do you buy it this juncture?
Absolutely. In fact, I've been, talking about this company for some time, and I think it has gone through a phase where the growth was limited and the guidance also was subdued. Performance also was subdued. But I think good times are going to come, and buying at current level definitely makes sense.
Sudeep, very quickly, before we let you go, I mean, today the Midcap mover of the day by some measure, Minda Corp. This whole Vision 2030, and I think we'll have Sudarshan join in just a bit to go over the details again. But just your view on the stock, if you have one.
Well, absolutely. I do like these auto component stocks, and some of them are, transitioning with their 2030 vision into a, global player. They are, of course, doing quite a lot of good work. And you see, this transition from ICE to EV is doing wonders for many of these auto component companies because, their scope of their work for a particular automobile is increasing significantly, and that will give them a leg up going forward. So yes, Minda Corp definitely from a long-term perspective should be looked at. Look at Samvardhana, look at Uno Minda. So I think all of these, are worth looking at.
No, absolutely. Sudeep, we'll leave it there. Thank you very much. Good speaking with you. Appreciate your time here on CNBC TV18. We take a break. 100 points now. So we're down to 25,064. We take a break. We're back with Alok Agarwal on the other side. Stay tuned. Coming up. Well, welcome back. Markets are down, 100 points. So at the day's low, pretty much at the day's low right now. Let's see, the low is 25.27. We're at 25.69, 25.70 at this stage. Alok Agarwal is head of quant and fund manager at Alchemy Capital Management. Alok, good to have you back on the program. Thanks very much for joining us. So, we had a nice move up. Now we got a bit of a downdrift, basically. So the range still stays and still awaiting triggers one way or the other for the market to do something different. And then, of course, you got the rupee as well, which is precariously close to 89. I mean, at least yesterday it was. And unless and until we get a deal quickly, as some have said, perhaps more weakness afoot. We'll see if the RBI comes in heavy. But what's your sense, Alok? Is the lift, has the lift ended that the market got, or is there more?
Yeah, hi Prashant, good afternoon, pleasure to be here. As you hit the nail on the head, one of the key triggers that this market is possibly looking forward to is this deal getting signed between India and US. So that could be a major game changer in terms of us moving out of this range that we are seeing over the last few months. Nevertheless, a lot of steps have been taken both by the government as well as the RBI to ensure that a lot of demand push can be done. Over the last 10 months, we have actually seen the RBI doing a lot of stuff in terms of cutting the rates, cutting CRR, moving from deficit to surplus, and government too, like from a direct tax benefit of about 1 lakh crore to GST cuts. That was the most recent development. A small contribution also coming from the fact that those online gamings have been banned, so some more money possibly at the hand of the households. So demand push is definitely there. Government has been doing that part. But yes, if we can get that deal done, that could be a major victory in the near term. And that would be something that possibly could be the near-term trigger to push the markets further upwards. On the earnings front also, although we are seeing that the earning cuts in terms of estimates was there in the past few quarters, but the pace also has come down. So a lot of things are in place. But yes, that one deal is something that we are waiting for.
All right, hi, hello, good to see you. And that's going to be clearly the sentiment driver, right? Because we're doing as much as possible internally. But the big sentiment driver is going to be a India-US trade deal. But how would you approach the markets? Given that we know the deal is going to come about, it could take a month, 2 months, or maybe 3 months. But would you, look into buying all this weakness that we're seeing in the face of consolidation? Because as you said, we could probably get an RBI rate cut. The benefits of all the measures that have been taken by the central government as well will flow in the second half of the year. So how do you approach the markets from here on? You can't wait for that deal. I guess you'll have to start going in, right?
Yeah, and one has to err on the side of optimism here. So the most benefits, as you really pointed out, the most of these benefits will actually be seen in the second half of this financial year. There is case for possibly RBI for the rate cuts to come in as well. And the government is quite supportive. So that part is definitely there. And the earnings growth numbers have started coming in. Even if you look at the last quarter's numbers, the Nifty 500 earnings growth was at 10%, which in itself may not be a big number, but it is the best number we had in the last 5 quarters. The pace of earnings growth estimates cuts that has come down significantly. So we do expect that we are possibly around that turning around point wherein it's definitely more logical to be erring on the side of optimism rather than being too cautious.
So you're fully invested, Alok? And what have you all been incrementally buying as money flows in?
So structurally and the near-term basis as well, consumer discretionary broader basket is something that we are more positive on. So that traditionally consumer discretionary has included the likes of auto, retail, consumer durables, etc. But there are certain other aspects also that possibly has shades of consumer discretionary, may not be classified directly there. The likes of electronic manufacturing has shades of consumer discretionary. I would actually go ahead and say that savings is also like buying of consumer discretionary services. So the capital market plays comes in there, the premium real estate comes in there, even the private hospitals and travel comes in there. So a lot of those segments, and then the platform-oriented companies catering to the distribution of these. So there's a whole gamut of such companies which are catering to the rising disposable income as well as rising per capita income and the K-shaped recovery as well. So that's one area that we are more positive on. But we do also expect that this is not something that the government is trying to run the economy on one leg. apart from consumption, the investment side is also on. And within the investment side or the capex side, the defense and power are the two major areas that we are positive on.
Defense and power. Alok got that. So yeah, I mean, what you're saying completely makes sense that maybe it's not a good idea to totally look away from capex or the industrial part of the market as well. But how do you find valuations? I mean, defense stocks, they have paused and they're still off many of them are still off the 52-week highs. But are they providing a good entry point? And if that, in that sense, I mean, more on the shipbuilding side or a wide conglomerate like an L&T, how are you looking to play defense?
In case of defense, I think we need to possibly zoom out a bit to look at the broader picture. And the way the defense is, we need to possibly look at the global picture first. Broadly speaking, the global GDP stands somewhere around $100 trillion. Globally, 2.5% of GDP is spent on defense. That brings us to the number of about $2.5 trillion. Even if we take about 3-4% growth in GDP, but going by the pace at which higher defense allocation is happening, it wouldn't be surprising to hit a 5-6% of GDP as a number in possibly 5-6 years. So this $2.5 trillion expenditure over the 5-7 years has the potential to possibly reach $7.5 trillion. So that's a kind of number possibly could be there in the coming years. And it's coming at a time when India has started and decided to move away from being completely import dependent to be more independent by producing in-house and also in some areas trying to export as well. So that's a much larger area. That's why it's nicer possibly to take it as a comparison to the auto sector that was there in the 90s. So initially it is the major OEMs that do very, very well. But as the ecosystem does well, expands, you'll have far more ancillaries coming in. So that's where this sector may look expensive in near-term earnings, but these cuts, this falls, there's this kind of negative returns that comes in the shorter periods. These are the times that makes us far more positive.
Thank you, Alok, for joining in. We need the positivity because markets are slipping now. It's 25,050. That intraday pullback of more than 100 points to levels above 25,100 is being sold into. Now 125 points gone on the Nifty. The day's low today was 25,027. So we're about 15 points away from that level. The Midcap index is down close to about 1%. Small cap index will also come up for you. The Nifty Bank is extending its loss now to 500 points. For today, a weakness for our markets and profit booking. Harmis is now joining in to put the spotlight on individual movers in the market. Harmis, rates are changing very fast, but tell us what you have.
Well, what is also changing very fast is the gears on the auto ancillary stocks, and we spoke about them in the morning. Today is no different, and they are continuing with where they left off in yesterday's session. So putting the spotlight on one such name, Munjal Auto, and up 14% is the biggest single day gain since July of last year. The volumes are the highest in over 2 months. We've had more than 1 crore shares that have changed hands on Munjal Auto today compared to their 20-day average of just over 4 lakh shares, and this is now as a result of which the stock has now turned positive on a year-to-date basis after reporting its best month of the year so far, that is this month of September. The other one is Zuari Industries. Now this stock was up 10% yesterday, it's up 20 today, and it had gained a similar quantum in the month of August as well. Now the last 2 sessions the stock has jumped 31%, and today's volumes are the highest on record for the stock already. We've had more than 60 lakh shares that have traded today. 20-day average here is just over 2.5 lakh shares, and this one too has turned positive for 2025 after this 2-day advance. And since the start of 2020, at the end of 2019, the stock was around 50 rupees. It's up almost 8x from those levels. Now, we spoke about one Tata Group name in the morning. The other Tata Group name that has been buzzing over the last 2 days is Tata Investment, and this one is too up around 25% in the last 2 trading sessions. It has fixed the record date for its stock split, which is the 14th of October. And the last 2 sessions, the stock has had more than 50 lakh shares being traded in the stock, and 33 lakh of those have come in today's session itself. The 20-day average is just a lakh. In comparison to a lakh, we have had close to 33 lakh shares being traded. This one too has turned positive on a year-to-date basis, and since the start of 2020, the stock was around 900 rupees. Today, it's closing in on 9,000 rupees. And Paradeep Phosphates is the last name on the list today. Snapped a 2-day losing streak, up 10% in today's session. The volumes are at the highest in 2 months. We have had more than 3.5 crore shares that have been traded in today's session already. The 20-day average around about 65 to 70 lakh shares. And as a result of this move, the stock has traded above its 100 DMA of 180, and the 50 DMA on the upside comes up to around 199. Although despite this move, the stock has been an underperformer this month, but an outperformer on a year-to-date basis, gains of over 70%.
Okay, Armas, thanks a lot for that. Well, it's time for our favorite segment, D Street Chatter. Nimesh joins in to tell us what is he picking up. Nimesh, some weakness is what we're seeing on the index, but I don't think people are still very, very worried because we're down 130 points at the day's low. Rather, I think people are taking it as par for the course.
Yeah, absolutely, Nigel, and not much from a flow perspective as well. So it's kind of a muted day of trade, not big participation coming in. I guess the next big trigger would be, of course, the expiry next week and the RBI policy. That's something a lot of chatter has already started talking about, and maybe that's the reason why you have to focus on the rate sensitives. Today, for instance, the reality index is down 2%. The banks are also under pressure, but I guess the street seems to be a bit divided at this point in time on whether we're going to see a rate cut or not. So that's going to be a big trigger as far as the Indian markets are concerned. Technically, on the downside, 24,950 is a level to watch. If that gets taken out, you might see some further pressure. But as you rightly pointed out, not much panic, so to speak.
Yeah.
I guess even from a PCR point of view, we normally bounce back from 0.7 to 0.75. So maybe a pullback could be on the cards and short covering. But from a buying perspective, it lacks a bit of buying for sure from large institutions today.
Well, indeed. The other trigger that we'll cover in just a bit is the India VIX is still cooled off, on a day that the markets are down. But what about individual stocks? What are you picking up?
Okay, so the first segment list is Paradeep Phosphate. Hormuz did highlight about the trading activity. But I guess that today's pullback is largely because I understand there is a clean-out trade from a domestic mutual fund. There have been aggressive sellers in the last couple of days. That's the reason why the stock was under pressure. But after today's clean-out trade, you've seen a big vertical move and up 10% in today's market. So that's the first stock. The second stock is Polycab, under pressure today, but of late it's been consolidating. But again, there is an indication of a large block coming in Polycab very soon, so that's a buzz there. The third name is Ethos, that's up 2%. It's generally a illiquid stock, but I understand some bit of interest is back from institutions, and one domestic mutual fund seems to be an active buyer there. And the last one is Himadri Chemicals. Even that stock is buzzing in trade after a large block. 1% equity got changed hands today. And I understand one of the corporate body corporates, they were the sellers in today's block deal. So any disclosures that could be interesting as far as Himadri Chemical is concerned.
Nimesh, just one, I don't know if you have any intel on this IMCO, right?
Yeah.
EIMCO, 14...
IMCO Helicon.
IMCO, yeah, I mean, it's for what, 14% down today. The recent high was 2,300, 2,350, 1,730 now.
Yeah. So Prashant, today the stock is down because of the OFS, which was announced, and one of the foreign promoter, which owns 24%, they are looking to sell their entire 24% stake via OFS, and it's at a deep discount, right? The floor price is 31%. Of course, it's not necessary that the deal will happen at 31% discount, but today is a day for the institutions to participate. So today's closing would be very important as far as what's the cutoff for the retail investors tomorrow. It's a small, I mean, though it's 24% in terms of number of shares, it's a small one of 14 lakh odd shares. So from a interest point of view, Prashant, whatever I spoke to, the feedback is that some family offices are interested in this OFS, so they're going to bid for. Some domestic PMS are going to bid for. No large institution, mutual fund investor or mutual fund was likely to bid. That was the early morning feedback. If things change, I don't know, but that's the sense as far as the interest is concerned. But need to see as to what price the cutoff comes in for retail investors tomorrow to participate in the OFS.
I see. Got that. Very interesting. Thanks very much for that, Nimesh. That's a list of stocks to keep an eye out on as we sort of march towards the end of trade. 20 minutes to go. We'll take another quick commercial break here. What to buy or sell today for a reverse trade when we come back tomorrow? Just a bit.
Welcome back. Nigel is now moved over to the F&O desk with the latest trends on what's happening in the derivatives market.
Well, that's right, Rima. You know, the markets are down, but still doesn't seem to be any kind of reason to panic. And the reason I say that is, you know, the Nifty is lower, but the VIX as well hasn't spiked up. And that normally is an indication that maybe there's no real panic, at least that is now set in. Moving to the options data, then you have a bit of a strategy that's playing out. That's writing the 25,100 put and the 25,100 call as well. It's known as the short straddle. You pocket a premium of close to around 300 rupees and you hope that the Nifty stays in this band. So, you know, if you just, if this is the strategy, then on the downside, the 24,800 level is the important support, while on the upside, the 25,400 level, that's the important mark. So if the strategy is playing out, then this 600-point band is extremely important. Moving to stocks that are in focus, well, you're seeing some kind of unwinding on IRDA today. The stock had a bit of a run-up. That's coming for profit taking. But the bigger unwinding actually is having on the stock delivery. Massive, you know, downtick is what we're seeing on the stock with the equivalent amount of open interest shedding as well. On fresh buying side, we are seeing PSUs that are back in focus, and you have a good amount of open interest build up on NTPC. The stock is high, open interest as well as higher. And finally, you know, Oro Pharma. That's a stock that's seeing considerable amount of shorting in today's trading session. The stock is down 2%, and the shorts are building in. But finally, RBL Bank, I've been talking about this stock. It continues to remain in the band. No sign of it coming out just as yet, and it could stay in the band for the next few trading sessions. That continues to outperform, even though the Nifty is under pressure. So I'll continue keeping an eye out on this particular name. Back to you.
RBL Bank, thank you very much for that. Swiggy is now down close to about 3%, despite the positive announcement of monetization, raising 1,200 crore rupees with that stake sale in Rapido. Swiggy is down, and Urban Company hit a high of 201 on Monday, and since then, the stock has been seeing some profit booking. Mitesh is now back with us. Mitesh, that pullback is now being sold into.
Yeah, as I said, I think, staying below 25,150 is something, which is not keeping the market strong. So I think unless until that level is captured again, you might see the index, go into some more or, lack the strength to continue on the upside. On the stock side, I have an estimate on Geo Financial. It's broken that base area of around 305, 306, just trading below that. In fact, 308 over 309. So keep a stop at about 309, look for a target of roughly around 300 on the downside over here. So might pull back and still extend on Geo Financial. And the second stock which I have in the run, that's STBT as well on Mankind Farm with a stop at about 25.42 and a target of around 2,500.
Okay, all right, got it. Thank you very much for that. Mitesh, good to have your advice today, and we'll connect again with the market first thing tomorrow morning. For the time being, let's move on and also put the spotlight on some more stocks that have been in the news today, and they've been on the move as well. Bajaj Electricals was in the news because they're looking to take over the Murphy Richards brand, something which would be pretty well known to many in the country. Upasana, fill us in. The stock started with a big flourish in the morning. Now, of course, it's cooled off.
Well, the board has given its consent to acquire Murphy Richards brand rights in India and across neighbouring regions from Glen Electric Limited for a consideration of 146 crores. Mind you that the company's licensing agreement for marketing and distribution in India. Now, company positions these brands in its premium category with products in kitchen, home appliances and personal grooming segment, which the company believes has a wider appeal and a higher sales growth as compared to other categories. Now, company continues to maintain its leadership position in the small domestic appliances category as well, and this strategic move is expected to strengthen its position in home appliances and consumer electronics portfolio. So summing up, overall with this acquisition, company will secure outright brand right in regions such as India, Nepal, Bhutan, Bangladesh, Maldives and Sri Lanka. So we can certainly see that this bodes well for the company, and the stock has been in the radar today since morning, up nearly about 4%.
All right, 2.5 now, so come off a little bit from the high point of the day. Upasana, thanks very much for that. Minda Corp is the other one on the back of 2030 vision put out by the management. And this one is holding strong, even though the markets come off. So does here with details.
So in today's week session also, one stock is holding the gains, that is Minda Corp, and that is on the back of Vision Document 2030 that company has released yesterday, and it has given some ambitious targets. On the revenue front, companies saying that by 2030, revenue might increase by almost 4 times to around rupees 17,500 crore from the current level of rupees 511 crore. On the margin front also, there might be an increase of almost 100 basis points to 12.5% from 11.4%. And on ROCE, companies saying that it might increase to 25% from the current level of 20%. And growth drivers, on the growth drivers, companies said that it will focus on premiumization. Kit value, it's looking to double in the next 3 years. And contribution part, companies say it will increase from the passenger vehicle segment. It will look to increase to 25% from current level of 14%. And in contrary, contribution from other segments like commercial vehicles, two-wheelers and three-wheelers will come down. So on the back of these factors, you are seeing a big move in Minda Corp today.
Indeed, thank you very much for that. A revenue scale-up of 3.5 times is a 28% top-line CAGR, and plus they're talking about margin expansion. Sudarshan, thank you very much for that. Get into a break. We'll come back with more on the markets. 10 minutes to go on the other side.
Welcome back. Markets again at the low point of the day, down 110 points or thereabouts. Mayuresh Joshi from MarketSmith India joins us on the show. Hi, Mayuresh. Good to see you in. Well, real estate, that's coming for some profit taking today. Even a company like Godrej Properties is now down close to around 5%. How would you approach, the real estate pack? Anything you like?
Afternoon, Nigel. Now, again, I think if you probably look at Q1 numbers across the real estate pack, I think a large part of the universe got impacted because of lower pre-sales. The second aspect also was that collections were more or less in line with estimates. And therefore, I think the expectations in terms of new launches, the pre-sales velocity, how does that pick up the expectations in terms of collections as well out of the existing projects at hand? And at the same time, I think what is the overall perspective that one probably looks at in terms of key areas? For Godrej Properties in particular, I think last quarter's numbers more or less in line with estimates. The collections probably came down around 20% year on year. 89-90% of their contribution came in from projects in NCR, MMR, and Bangalore as a region. And therefore, I think new launches in each of these operating markets with expectations of realization, growth, and collection efficiencies, the gross development value itself expected to be reasonable in the coming year as well. But how do all these factors probably stack up is something that the market would and the street would ideally like to see. Yeah. So I think let's watch out for Q2 numbers as we see it at the management.
Mayuresh, Minda Corp, bold ambition for 2030. Had a look at it?
Yes. And again, I think FY30, I think the targets are very, very optimistic. Obviously, I think the expectations that they have put out in terms of the overall sales growth with margin expansion, debt reduction, the capex plan that they've probably put in place makes the street believe that the kind of numbers can be achievable. So, Rima, if you probably look at the auto space in general, I think the underlying thesis has been a large part of this auto universe is making its new products EV agnostic. So whether it's plastic products, whether it's mechatronics, whether it's the control systems, the sensors as well. And therefore, I think the content per vehicle is expected to grow significantly higher. And you would have seen that in a lot of management presentations across the auto universe. Four-wheelers content per car expected to go as high as 70, 75 or 1,000. Two-wheelers to 20, 25 or 1,000, which is a 3 to 4x jump from the current ICE vehicles that they're probably servicing. And therefore, when capacities start getting built up towards these new age products, incrementally, as numbers start coming through, auto anchors will benefit quite significantly. So yes, I think Minda Corp, along with a lot of auto anchors, you look at Lumax Autotech as an example. I think they've given a 20% rise, 20% in revenue, 20% in ROC, 20% in EBITDA margins. And therefore, I think a large part of this auto anchor pool is probably looking at strong growth coming from OEM and strong pricing remaining within the replacement market as far as their aftermarket sales are concerned. So yeah, I think the momentum can continue. But again, these are long drawn out targets, which is going to take time as the transition happens towards EV in the next few months.
Yeah, no, got that, Mayuresh. Just a quick look at what else is going on. 2,000 stocks are down, by the way. 2,050 stocks are down on the NSE, and about 1,000 stocks are higher. So this is clearly gone the other way. Mayuresh, on real estate stocks, is there any particular reason why the index is down 2% today?
No particular reason. But again, Prashant, I think what you've probably seen in terms of fresh registrations that are coming through, I think last month, I think you probably saw for the first time as a trend, where registrations have probably got lower in an area like Mumbai, MMR region as well. NCR is still holding strong. But I think in a falling interest rate scenario, as we are ending that 6-year cycle, we are probably in the 5th year as we speak. It's a surprising data point because I think the stronger real estate sales that we saw for the better part of last so many quarters seem to be plateauing out, at least from last month's data. So this is a trend, which is something that the street probably fears, which probably might plateau out as we speak, in spite of a falling interest rate scenario. There is some element of concern in terms of, as I said, the new sales launches, the new launches that are happening in terms of the new sales velocity, collections, margins, and therefore the overall earnings growth.
Mayuresh, stay on, just counting down today's trading session. Tough one. Markets consolidated, but with a negative bias, lower now for the fourth trading day. The Nifty sheds 100 points, ending below 25,500, closer to 25,050. Sensex down 350 points. Midcaps underperformed today. Midcap index down 1% with an advanced decline ratio, which had nearly 2,000 stocks in the red. On the way down, real estate took a big knock, 2.5%. Capital market plays weak. Autos on the back foot, retracing after last week's gains, and IT continues to see selling pressure. On the way up, you had power names. Power Grid, NTPC were the top two. Nifty gainers, HUL, Nestle. Add that to the list of gainers.
Yeah, but bigger sell-off in the broader market today, 1% lower on the mid-cap index. And today was one of those days where a lot of stocks, saw selling into news. Dilip Buildcon would be one of them. They announced an order win, 1,100 crores project in Kerala. Stock started off positive, but it ended with a cut of about 5%. Let's see what else was weak. A lot of real estate stocks actually had a very weak session today, especially the Mumbai-based realtors. Godrej Properties, 4% lower. Oberoi Realty, 3% lower. Lodha was down 2.5%. Even DLF was down 3.5%. So very, very weak session for some of the real estate names. Speaking about other key losers of the day, you have some of the Adani Group stocks coming in for a lot of profit taking. Adani Power, Adani Total Gas, they were on the downside. There's Gokuldas Exports, something like a Zen Technology, some of these defense names which have rallied hard. Today was a down day for many of them. Must end with Minda Corp in terms of positive reaction to news. It probably was the stock that really stood out, 8% up as the company has announced its Vision 2030. Well, the bell has gone, so we'll take your leave on that note. Thank you very much for being with us. But, all the updates coming up on the market action. Up next is Markets Forward.
Indian markets end in the red amidst mixed global cues. Nifty fails to hold 25,100 and Sensex ends below 82,000. All sectoral indices closed in the red except for FMCG, realty and auto stocks among the top laggards in today's weak market.
Swiggy will sell its stake in Rapido to raise around 2,000 crore rupees, a move to sell Instamart on a slump sale basis to its subsidiary for cash. Will also add to its resource pool as it opens up fresh fundraise possibilities.
India Inc. expects FY26 GDP growth in the range of 6.8 to 7%. CII President Rajiv Memani tells CNBC TV18 the GST cut will play a major role in achieving this growth. Also, India Inc. expects RBI to cut rates further.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vamakshi and with me is my colleague Vivek Iyer. Well, hi Vivek, it has not been a great session so far. The recovery that we saw midday had been sold off into and we're marking the fourth consecutive day of decline. And a trend that we've been observing is, the Nifty has been posting lower lows every single day this week. So, it doesn't seem like, it's going well for the, if you're a bull, but if you're a bear, I think it's going quite well.
That's right. Good afternoon, Vamakshi. As you mentioned, another session where we saw lower lows. The Nifty did attempt a brief intraday recovery led by PSU banks, but that too got sold into. Most of the PSU banks, at one point of time were trading significantly in the green, but towards the end of the trading session, actually ended near the day's lowest point. Well, we have a lot lined up on the show, and now on to our first segment of the day. Sudarshan joins us now from the big wall with the top movers and shakers of the day. Sudarshan, over to you.
So it was another day of weak trading session, but one segment or one index that closed in the green is FMCG. So some of the stocks from that index that have closed with gains. So first one, HUL Nifty, top gainers around up almost 1%. Same move was seen for Tata Consumer and Jubilant Food. PSU banks still half day of the trading sessions. Most of the banks were higher, and one bank that continues to outperform and has been giving strong quarterly results, that is the Indian Bank. And today also at one point it was up almost 3%, but at the end this too also closed with a gain of almost 2%. After this, some of the stocks have reacted to news flows. First on the list or top on the list is Tata Motor. Yesterday, if you remember, we were talking about JLR has extended the production pause till October 1. So the real impact on the stock we have seen today, and the stock closed with a cut of almost 3%. Another stock that has seen a sharp fall is PV Fintech, because our colleague Yash Jain has reported that IRDAI is considering basically to ask insurance companies to cap commission charges. If this happens, this will have an impact on PV Fintech, and that's the reason stock was down almost 4%. Coming to SBI Card, yesterday we saw that monthly data came and it was positive for SBI Card, and that's the reason stock was up almost 1%. Minda Corp has released Vision 2030 document in which company is expecting revenue to grow almost 3.5 times to 17,500 crore, and on the back of that, stock has risen as much as 9%. Lastly, in that segment, Keynes Technologies has appointed new MD. Remember, last week we were talking to company after its MD had resigned, and company had said that within 2 to 3 days it will be appointing new MD, and today company has made that announcement, and on the back of that the stock has closed with a gain of 3%. Now, over the last few sessions, you would have seen that all the auto stocks have been moving higher on the back of GST cut and its impact on the sales of these companies. Maruti has made comments, Hyundai has made comments, but due to that, auto ancillaries, all the stocks have been moving higher for the last few sessions. Today also, all the stocks were up somewhere in the range of 6 to 14%. Munjal Auto was up 11%, Bharat Gears were up 14%, and similar move was seen for other three names also, Ask Automotive, Lumex Autotech, and Munjal Showa. Lastly, some of the stocks were notable movers. Adani Group stocks, after seeing a big move in previous few sessions, today it was a profit booking days for most of the names. Adani Total Gas fallen 8%, Adani Power has fallen almost 11%. Two stocks that have been hitting upper circuit continuously, and today also both these stocks have seen a big move, and those names are Zuari Industries and Tata Investment.
Well, thank you so much for that, Sudarshan. But let's take this forward then, we have Marish Joshi of MarketSmith India and Shrikant Chauhan, who is the EVP at Kotak Securities, joining us today. Good afternoon to you, gentlemen. This is Vamakshi. Now, I'd just like to ask you about, Shrikant, to you. Actually, the markets have not been doing quite well. After the near 1,000-point rally that we saw, we've cooled off almost 400 points from, the recent high. So, where do you think the market is headed now? Are we headed for more weakness in the coming days?
Yeah, good afternoon, everyone. So I think if we see the trend of the market, then we are seeing some correction in the market, but we cannot forget that we saw the rally of 1,000 points in such a muted phase of the market. Whenever there is such type of activity in the market, we see a little bit extended correction. Close to 25,000, 24,900, the market is having good amount of support. And around these levels, we should look for taking some specific stock bets in these markets, because I am of the view that the market is now going to spend time between the range of 25,000 and 25,500 on the high side. So now we are very close to the lower boundary of the range, and we should look for taking some specific bets in this market.
Right, Shrikant, so you're expecting the Nifty to trade in a tight range between 25,000 and 25,500. Well, moving on, some news flow as far as Swiggy is concerned. Remember, the company plans to sell its stake in Rapido to raise just under 2,000 crore rupees. The company also plans to transfer Instamart to its subsidiary on a slump sale basis for cash. Vinny Motiwala joins us now to tell us more. Vinny, over to you.
Hi, thanks so much for that. So yes, Swiggy is going to be divesting their stake, that is 12% stake in Rapido. Now, this is two parts. One part is going to be sold to Porus. The other part is going to be sold to Westbridge. So Porus will be for Porus, the sale is going to be 10 equity shares as well as 1.64 lakh Series D CCPSs, which will be sold for Rapido. From Rapido, it will go to MIH, which is Porus. Now, other than that, do not forget, Porus is a shareholder of Swiggy with around 23% stake that they were holding as on June 30th, 2025. The other one is the company will be selling around 35,000 shares, 35 to 36,000 shares of Series D CCPSs of Rapido to Setu AIF, which is the Westbridge company, that is for 430 crores. So one is, the Porus one is 1,968 crores, the other one is 430 crores. That totals to around 2,500 crores in terms of the total money that Swiggy will receive for the sale of Rapido. Now, do not forget, this was in line with the guidance that the company had mentioned in Q1 FY26 as well. Apart from that, there is a restructuring that has happened as well, where the board has approved the transfer of Instamart business of the company, including all those assets and liabilities, to Swiggy Instamart Private Limited, which will be a wholly owned subsidiary of the company. Main purpose of this is to smoothen the process of Instamart being treated and now easily being treated as an Indian owned and controlled company. Now let's look at the cash balance and the cash book, like you can see. Now, what is the cash book? As on 30th of June, it was around 5,300 crores for Swiggy. Now, post this Rapido sale, they'll receive 2,400 crores approximately. So overall cash balance at the end of Q2 would come somewhere around 7,750 crores. This is important because the cash burn in Q1 FY26 was around 1,300 crores. Now, with this cash, it indicates that the company can sustain for maybe 6 to 7 more quarters which this cash, and if the cash burn remains at these levels of 1,300 crores. Now, key risks that come in. One, there's expansion plans that could come at risk if the cash starts depleting at a faster rate. Increased competition that's there from newer players as well as already from Blinkit, because Blinkit is expanding at a faster rate. They are expanding in terms of stores that are launched every quarter by Blinkit is around 250 stores, while Swiggy is adding only 40 to 50 stores. So there's a gap in that front as well. And cash burn for Zomato or Eternal is much lower than what we're seeing for Swiggy. So key risk coming in there, as well as the quick commerce business, the losses are widening much faster, though what analysts are highlighting that this is a positive move, at least in the short term, and that is what they're keeping an eye out on.
Absolutely, Vinny. Thank you so much for bringing us those details. But on to a CNBC TV18 exclusive then. As per sources, IRDAI has flagged off some concerns around high insurance commissions and distribution costs in meetings with insurers. Yash is here with more details on this. Yash?
Well, after the new IRDAI chairman took over, that was Mr. Ajay Seth, this was the first meeting between the chairperson and the CEOs of insurance companies. According to our sources, there were a few important strategic points which were flagged by the chairman, by the insurance regulatory chairman in terms of points that the industry needs to work on. And one of those important points was the concern around high distribution costs and high commissions which go behind selling insurance products. According to, of course, what we understand from our sources, GST has made a huge benefit for various policyholders, potential policyholders, in terms of bringing down premiums for them. The chairman expressed that these distribution costs and commission also need to come down to, bring more benefits as far as potential policyholders are concerned. What we are also given to understand from our sources that the industry, certain large players of the industry suggested that, there could be an option to explore what the mutual fund industry did with total expense ratio, where commissions and not the expenses could be capped as far as, insurance companies are concerned. What we are given to understand post that is that the regulator, that is IRDAI, is expected to make subcommittees of insurance companies themselves who would be giving a presentation or recommendation when it comes to how capping can be done as far as commission costs itself are concerned. Apart from, of course, higher commission and higher distribution, there were various other important strategic areas. Claim servicing was one of them, penetration growth were other two sectors, social and rural commitment, motor third party commitment were all those strategic areas which were flagged by the insurance regulatory chairman.
Thank you so much, Yash, for joining us. And that story did have an impact, especially as far as the share price of PB Fintech was concerned. That stock ended lower by over 3.5%. Well, we still have Mayuresh Joshi as well as Srikanth. Thank you, gentlemen, for staying on with us. Well, Mayuresh, let me come across to you. Do you track this particular company, Policy Bazaar? Especially, how do you feel this particular move, if it fructifies, will impact the insurance companies and especially PB Fintech?
Afternoon, Vivek. Again, I think that entire fortunes are dependent on how the insurance market itself grows. And therefore, I think when there is a lot of circumspect areas that probably still are existing in terms of how premiums might actually grow, what is the impact in terms of the cost structure itself? Because all these companies, specifically the life insurance companies, are running at elevated cost except SBI Life, which is in high single digits. So I think if you account for marketing stroke commission costs, they account almost 21%. And therefore, I think how premium growth is expected to shape up. Obviously, the expectation in terms of premiums falling might be a spur factor for the industry as a whole. But does that really compensate in terms of higher costs that these companies have to probably go through? And ultimately, I think if there are lower commissions that probably get passed through, I think that is going to impact forward-looking numbers as well. So I think we have a neutral view of the sector, not just the life insurers, but the non-life as well. And again, ancillary players like PB Fintech as well, which might, again, get impacted depending on the fortunes of how the entire sector might probably be.
All right, thanks for that, Mayuresh. But moving on then, Minda Corp. This stock surged in trade on the back of management's bullish outlook. The company is expecting its revenue to jump almost 3.5 times by 2030. And Sudarshan is here with more details on this. Over to you, Sudarshan.
So Minda Corp stock has surged on the back of its Vision 2030 document. Company expects revenue to increase 3.5 times, EBITDA margin to increase to 12.5% and ROC to increase to 25%. And in contrary, net debt to equity ratio to decline to 0.3 times. And the focus going forward would be more on passenger vehicles. And that's the reason company expecting its contribution to increase to almost 25% from current level of 14%. And because of these reasons, stock was sharply higher.
Thank you so much, Sudarshan, for taking us through what exactly Minda Corp unveiled as far as their Vision 2030 was concerned. Well, another stock that gained in trade today was Bajaj Electrical. This was after the board approved the acquisition of Morphy Richards brand. The company has been marketing Morphy Richards products in India since 2002. Upasana is here with more details on this particular acquisition.
Well, the board has given its consent to acquire Morphy Richards brand rights in India and neighbouring regions from Glen Electric for a consideration of nearly about 146 crores. Mind you that the company is associated with this British brand since April 2002 through a licensing agreement for marketing and distribution in India. Now, company positions this brand in a premium category with product across categories such as kitchen, home appliances and personal grooming, which the company believes has a higher appeal and higher sales growth as compared to other categories of the company. Now, this strategic move is expected to strengthen the company's position in the home appliances and even consumer electrical category portfolio. With this acquisition, to sum up, the company will secure outright brand rights in countries like India, Nepal, Bhutan, Bangladesh, Maldives and Sri Lanka, as what is indicated in the press release. So this stock remained in focus today on the back of this.
Thank you so much for that, Upasna. But Shrikant, I'd like to ask you, in terms of all of these consumer durable sectors names, right? They've been, doing well on the back of that GST 2.0 reform. Now, what is your take? Like, do you have any sort of top picks when it comes to the consumer durable names?
See, most of these stocks are finding a lot of difficulties to sustain at higher levels. Despite there was news flow, we saw very limited sort of activity in almost all the stocks. But in this particular space, if we really have to focus on any one or two stock, then in that we feel Hitachi India, Hitachi Energy, that stock looks good, which is around 18,000, 19,000 sort of levels. But if we consider Havells or Bajaj Electricals or even let's say Voltas, there we are not seeing any specific strength. It is better if we try to exit from these levels at current levels, or even from the even if there is any rally from current levels, then that will be an opportunity to reduce exposure from this particular space.
Well, thank you so much, Shrikant, as well as Mayuresh, for joining us, giving us a view both on the technical aspect of the market as well as the fundamental ones. Well, before we head into a short break, we leave you with commentary on GDP growth. India Inc. expects GDP growth in the range of 6.8 to 7% on the back of GST rate cuts. Speaking at CNBC TV18's event, CII President Rajiv Memani said nominal GDP growth remains a major concern and suggested that rate cut by the Reserve Bank of India could help ease inflation. Let's listen in.
I think GST will definitely help. I think firstly, the first quarter GDP growth was also was a very positive surprise, and from what we are seeing with the monsoons and the uptake because of GST on the consumption, just some of the early sentiment that we are seeing. We haven't seen the numbers as yet. I think 6.8 to 7% should be achievable. We are also seeing, if you look at steel, if you look at cement, the broader trend on the construction sector, which contributes a lot, that's very positive. We just saw yesterday mining sector is starting to show very positive growth. So I would say overall 6.8 to 7% is probably a safe number to go with right now. I think India's bigger challenge is not the real GDP growth. I think it's the nominal GDP growth. Yeah. Because from a tax revenue collection, from a fiscal deficit number, I think that becomes more relevant. I think that's where we'll have to see if inflation continues to stay as benign as it is, and with GST it may come down a little bit, currency stabilizes, then the likelihood is that the nominal GDP growth will be a challenge. So we're hoping that if RBI was to reduce the interest rates, in some ways, push for greater growth, and then if that has a mild impact on inflation and it comes to closer to 2 to 3% in that range, if it ends in that range, then hopefully the nominal GDP growth number should catch up.
Welcome back to Market Forwards. Well, now on to a CNBC TV18 exclusive. Steel Secretary Sandeep Pandrik expects industry to grow in the range of 9 to 10% in FY26 on the back of the GST rate cut. He added construction, autos and consumer durables are set to boost steel consumption in the country. And that's not all. On DGTR recommending safeguard duties on steel imports, he said imports from China have dropped significantly compared to last year due to safeguard duties. He is of the view that domestic steel sector should get reasonable pricing. Further, he said DGTR has recommended adding 2 more product categories from imports from China as well as Vietnam, and the decision on the safeguard duty is expected before November 1st. Commenting on China's anti-involution policy, he said Indian steel sector will not be impacted by this.
Well, that was an exclusive interview to us, but now let's go across to key corporate voices. The management of Zaggle has given an upward guidance of 40 to 45% as against their earlier expectation of 30 to 35%. The company further guided its margins to be in the range of 10 to 12%.
Next up is the Lodha Group. The management expressed disappointment over the corporate governance issue involving Director Rajendra Lodha. It added in a preliminary inquiry, wrongdoings worth 85 crore rupees was unearthed. The management added that the total fraud could exceed 85 crore rupees and the final impact will be determined after a detailed forensic audit.
All right, and before we wrap, we bring you some key market events to watch out for the trading session tomorrow, and Upasna is standing by with those details. Upasna.
Well, first up, let us look at the global economic cues. Coming to US, the US will be reporting its Q2 GDP data, even initial jobless claims data. Now, let us look at the key stocks that will be in focus on the back of corporate action. Stocks like Afcons, Infra and Gayatri Projects will be in focus as board meeting will be held tomorrow for the fundraising plans of both these counters. Now, Trualt Bioenergy opens for subscription tomorrow, while on the flip side, Sheshasai Technologies, Jaro Institute of Technology, Anand Rathi and Solar World Energy Solution, all these IPOs close these for subscription tomorrow. Now, PM Narendra Modi to inaugurate World Food India, and also PM Modi will be launching 1.2 lakh crore nuclear projects in Rajasthan. So all in all, looks like quite an eventful day tomorrow.
Well, thank you so much for that, Upasna. It looks like a clearly an eventful day tomorrow. With that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan and these are the top headlines that we're tracking for you. Stocks slide on Dalal Street. Midcap see a sharp fall. Nifty fails to hold 25,100. Rupee regains some lost ground but remains closer to the 89 mark against the US dollar. A majority of India Inc. expects GDP growth to be near 7% this fiscal. A CNBC TV18 poll among 80 top CEOs shows industries expecting RBI to ease interest rates further. Top executives also expect rupee to stay in the range of 88 to 89 against the dollar. That's an exclusive.
We expect to increase our trade with the US on energy products and liquors to come.
Commerce Minister Piyush Goyal says India wants to increase the purchase of oil and gas from the United States as trade talks resume. Minister Goyal is in the United States for the first time since US imposed 50% tariffs on India, partly as a penalty for buying Russian oil. External Affairs Minister Jaishankar calls on the Global South to renew commitment to multilateralism at a meeting in the United Nations. US President Trump meets Pakistan's Prime Minister Shehbaz Sharif at the sidelines of the UN summit after claiming credit for the ceasefire between India and Pakistan once again. US government could consider scrapping the current lottery system for H-1B visas. HCL Tech's Roshni Nadar and many other IT executives do not see any major impact due to the visa fee hike. Majority of Indian CEOs expect India and the US to stick to the proposed timeline and sign a trade deal this year. Walmart-owned PhonePe files draft papers to go public through the confidential route. Plans to raise 12,000 crore rupees according to sources. Existing investors, Walmart, Tiger Global and Microsoft, likely to sell about 10% equity. Swiggy exits Rapido by selling its 12% stake to Prosus and Westbridge Capital for nearly 2,400 crore rupees. Swiggy will also transfer Instamart to a wholly owned subsidiary in a slump sale to open up fresh options to raise funds. Union Cabinet approved shipping and maritime projects worth 70,000 crore rupees. This includes financial assistance and a development scheme for shipbuilding worth nearly 45,000 crore rupees. Also clears a maritime development fund worth 25,000 crores. Those were the headlines that we're tracking for you this evening, but let's start with the day's market action. Broad-based fall across the market with Nifty failing to hold onto the 25,100 mark. Financials and mid-caps dragged the market lower, while FMCG stocks turned positive for the day. Prashant Nair joins us now with the day's trading action. Prashant, a bad day for the market there?
Well, the pause, the sideways move, whatever you want to call it, continues. The Nifty down another nearly 100 points or so. And from the highs, of course, we've now given back about 400 points on the Nifty. The Nifty Bank also some 650, 700 points off the highs. Mid and small cap indices also under pressure today. Market breadth has been poor for the second day running. Let's just quickly take a look at what else really came through. By the way, the real estate index was the top loser, about 2.5% cut on the Nifty real estate index today. In terms of large caps, you had Tata Motors, Bharat Electronics, Adani Enterprises, Wipro, IndusInd Bank and Jio Finance, which were the top losers. Power Grid, NTPC, Tata Consumer were stocks on the other side with some amount of gains. Broader markets, again, I mean, you know, the one pack which saw like a frenzied move over 2 days was the Adani pack, but it's been giving back some of that equally vigorously. Adani Power down 10 today, Adani Total down, Adani Energy Solutions down sharply. NetWeb continues to pull back, but very small, right? I mean, the outperformance has been so large that I think it barely pricks. Dilip Bilkon, Godrej Properties, Emco, where of course the OFS was down sharply, 14%. Reddington, Quality Power were some of the other stocks which came under selling pressure, with volumes as well. On the upside, Tata Investment Corp, which is like a investment vehicle, was up very sharply, has done well over the years. Minda Corp, Paradeep Phosphate was another one. Lotus, which is the recent listing. Sirma, there was Zuari, Bajaj Healthcare, Munjal Auto are some of the other single stocks which did well. But not far and few in between. Breadth, of course, negative with many more stocks on the downside with volumes as opposed to what did well on the upside. Yesterday, of course, was a big day for the dollar rupee. But today, of course, it was quieter, but I think that at the margin is starting to weigh as well in terms of spillover risks, etc. At least it's been spoken about as we go into the next couple of sessions. Back to you.
All right, Prashant, many thanks for those details. But speaking about the rupee, the Indian rupee regained some lost ground against the US dollar. After a sharp rally in early trade, the rupee gave up some of those gains in late trade to end the day higher by just 6 paise. $1 now costs nearly 89 rupees. 10-year bond prices saw a minor drop and the yields hardened in trade. On to a CNBC TV18 exclusive, a majority of India Inc. is expecting GDP growth to be in the range of 6.8 to 7%, which is largely in line with the government's expectation. A CNBC TV18 poll among 80 top CEOs showed that the industry is expecting RBIs to ease interest rates further. CNBC TV18 Shireen Bhan was at industry body CII's National Council meeting in Chennai. We polled the CEOs on several macroeconomic indicators, including the rupee, which majority expect to stay in the range of 88 to 89 against the dollar.
With the GST boost coming in, the chief economic advisor suggests that growth will be higher, perhaps closer to the upper end of the band that was presented in the economic survey, which was 6.8%. What is your growth expectation for FY26? Ladies and gentlemen, option 1, 6.5%, option 2, 6.8 to 7%, and option 3, more than 7%. Those of you who think that growth is going to be 6.5%, please raise your hands. Okay, no hands here on 6.5%, between 6.8 and 7%. Okay, quite a few. And those who believe that it is likely to be higher than 7%? Okay, so that's the mood of the House. Just what the chief economic advisor told us, 6.8 to 7%, a little better than the economic survey's estimates. That's the mood as far as industry is concerned. The second question, and again, I'd appreciate a vote, a show of hands here. Do you see inflation easing further, and do you expect the RBI to cut interest rates again? Yes or no? Very, very simple. Those who believe the RBI will cut rates, a show of hands, please. So most people in this room do believe that the Reserve Bank is going to cut rates. And the third question to kick things off here, we've seen what's happening as far as the currency volatility is concerned. Do you expect the rupee to end, option number 1, in the current band, which is between 88 and 89, to be stronger, which is below 88, or weaker above 89? Those who believe that the rupee is likely to trend in the current band, if you could raise your hands, please. Okay, and those who believe that it's expected to be stronger, that is above 88, just about 2 hands in the room, and those who expect it to be weaker, that's below 89. So majority expect the rupee to be in the band between 88 and 89. So let's get straight off. Rajiv Mani, I'll come to you to start with. What was your vote, 6.5 to 6.8 or 6.8 to 7%?
No, 6.8 to 7%.
Okay, and you believe the GST is going to help drive that number?
Yeah, I think GST will definitely help. I think firstly, the first quarter GDP growth was also, and the uptake because of GST on the consumption. Just some of the early sentiment that we are seeing. We haven't seen the numbers as yet. I think 6.8 to 7% should be achievable. We are also seeing, if you look at steel, if you look at cement, the broader trend on the construction sector, which contributes a lot, that's very positive. We just saw yesterday mining sector is starting to show very positive growth. So I would say overall 6.8 to 7% is probably a safe number to go with right now.
And moving on, Commerce Minister Piyush Goyal said that India expects to increase its trade with the US in energy products in the years to come. Speaking at the US-India Strategic Partnership Forum in New York, Goyal said that India's energy security goals will have a very high element of US involvement. Meanwhile, External Affairs Minister S. Jaishankar hosted a meeting of Global South nations on the sidelines of the United Nations General Assembly in New York. Speaking at the meet, Jaishankar called on the Global South to renew commitment to multilateralism at a meeting in the United Nations.
The world recognizes that this is one area where we all have to work together. India is a big player in the energy field, as Pankaj just mentioned. We are big importers of energy from across the world. and put it on the US. We expect to increase our trade with the US on the energy products in the years to come. And be close friends, natural partners. Our energy security goals will have a very high element of US involvement, which will ensure price stability, which will ensure diversified sources of energy for India, and help us unlock limitless possibilities with the US on various fronts, energy and beyond.
We meet in increasingly uncertain times when the state of the world is a cause for mounting concern for member states. The Global South, in particular, is confronted with a set of challenges which have heightened in the first half of this decade. They include the shocks of the COVID pandemic, two major conflicts in Ukraine and Gaza, extreme climate events, volatility in trade, uncertainty in investment flows and interest rates, and the catastrophic slowing down of the SDG agenda. Most of all, the rights and expectations of developing countries in the international system, which has been so assiduously developed over many, many decades, are today under challenge. In face of such proliferation of concerns and multiplicity of risks, it is natural that the Global South would turn to multilateralism for solutions. Unfortunately, there too we are presented with a very disappointing prospect.
Meanwhile, US President Donald Trump has claimed that India and China are the primary funders of the war in Ukraine because of their Russian oil purchases. In his first UN General Assembly speech since 2020, he also hit out at NATO countries, saying they have not cut enough of their Russian energy imports and hence they are funding the war against themselves. Trump once again claimed credit for the ceasefire between India and Pakistan. He also had a brief interaction with Pakistan PM Shehbaz Sharif on the sidelines of the 80th session of UNGA. Let's listen in to what he said about India and China.
China and India are the primary funders of the ongoing war by continuing to purchase Russian oil. But inexcusably, even NATO countries have not cut off much Russian energy and Russian energy products, which, as you know, I found out about 2 weeks ago, and I wasn't happy. Think of it. They're funding the war against themselves. Who the hell ever heard of that one? In the event that Russia is not ready to make a deal to end the war, then the United States is fully prepared to impose a very strong round of powerful tariffs, which would stop the bloodshed, I believe, very quickly.
Russia has called President Trump a businessman trying to sell U.S. oil after the U.S. leader's criticism of China and India purchasing Russian oil. The Kremlin said that Trump is trying to force the world to buy American energy at higher prices. However, the Kremlin spokesperson lauded Trump's willingness to work with Russia and find a solution to the Ukraine crisis. The Trump administration has announced plans to replace the current H-1B lottery system with a weighted selection process. The Department of Homeland Security has said that the selection will be based on wage level. The notice said the new process would give heavier weight to applications by employers who pay high wages. The criteria would apply if annual requests for the visas exceed the statutory limit of 85,000. And speaking of H-1B visas, India Inc. expects that there won't be a major impact from the Trump administration's decision. Speaking at the CII town hall, the industry expects the bilateral trade agreement between India and USA to be completed this year, as proposed by both the nations.
What is the expectation on the India-US BTA being done? Those of you who believe that we are going to see the India-US BTA conclude, the expectation, the hope, the assumption was that by fall this year. Those of you who believe that it will be done by fall this year, by November, which was the timeline estimated, do raise your hands. And those who believe that it will perhaps spill over into next year, raise your hands. So those who believe it will be done by this year, the India-US bilateral trade agreement, if you can raise your hands, please. Okay, a fair number. Those who believe that it's likely to slip into the next year, next financial year, or next calendar year, well, there's more who believe that it'll probably get done this year. So that's certainly good news.
I'd mentioned this before as well, that we can't let this, never miss a good crisis. And if at all, if you've seen the trend of H-1B visa applications over, let's say, even the last decade, India's the largest proportion, but the number has been coming down.
Yeah.
And a lot of conversations today that you have with your clients, and we're all pretty heavily indexed on the US, is around AI adoption and AI-led deals. This is not just a problem for the industry. It is also a problem for customers, clients, and actually some of the most biggest companies which are hit by this are actually American companies.
Yes.
On that note, it is time for us to head into a short break. But coming up next, Union Cabinet approves shipping and maritime projects worth 70,000 crore rupees. More details on the other side. Stay tuned. Welcome back. You're still with us on Business 360. Swiggy has exited Rapido by selling its 12% stake to Prosus and Westbridge Capital for nearly 2,400 crore rupees. Swiggy will also transfer Instamart to a wholly owned subsidiary in a slump sale to open up fresh options to raise funds. Walmart-backed PhonePe has set its eye on going public. The payment aggregator has told CNBC TV18 that they have filed IPO papers via the confidential route with SEBI, BSE and NSE. Ritu Singh joins us now with more details. Ritu, what are your sources telling you?
Well, Walmart-backed PhonePe has filed draft papers with SEBI for a mega IPO through the confidential pre-filing route. Now, the IPO, of course, has been in the works ever since PhonePe shifted its base from Singapore to India back in December of 2022. It later confirmed its IPO plans in February of this year, and now sources are telling us the company is looking to raise nearly 12,000 crore rupees, that's $1.35 billion, through an offer for sale in this IPO. Now, Walmart, which owns about 84% stake in the company, along with Tiger Global and Microsoft, are the three shareholders that will participate in the OFS, which will involve a combined dilution of around 10% stake. Now, PhonePe launched its digital payment app in 2016, and since then it has expanded into financial services and even consumer tech. It recently received RBI's final nod to operate as an online payment aggregator and remains a clear market leader in UPI payments. But on the numbers front, while losses are narrowing, PhonePe is not profitable yet. For FY25, revenues jumped more than 40% to about 7,100 crore rupees, while net losses came down by 13% to about 1,727 crore rupees. But this is shaping up to be one of the most closely watched listings in India's fintech space, simply because of the company's sheer scale. PhonePe was, remember, last valued at around $12 billion in the private funding round, and reports suggest it could now be eyeing a $15 billion valuation when it hits the public markets.
All right, Ritu, many thanks for those details. Now, the Cabinet has approved shipping and maritime projects worth 70,000 crore rupees. This includes financial assistance and a development scheme for shipbuilding worth nearly 45,000 crore rupees. The government has also cleared a maritime development fund worth 25,000 crores. Abhimanyu Sharma is here with all of those details. Abhimanyu?
Well, a host of schemes which have been approved by the Union Cabinet, but the biggest approval has been given for the maritime and the shipping sector. Now, the three sub-schemes which are a part of the overall approval within the Union Cabinet aim to improve overall shipping infrastructure, aim to improve shipbuilding capabilities of India, and also want to promote shipbuilding within India. It also wants to promote shipbuilding in lieu of shipbreaking, which already takes place at several places, several ports across the country. Now, there would be a 25% financial assistance which would be given to green and hybrid vessels, and a 20% financial assistance which would be given to vessels over rupees 100 crores. Now, this is being initiated to ensure a larger gestation period is easily given to several ship makers who often find it difficult to raise capital and often find it difficult to get these amount of funds allocated to them. So the large gestation period as far as shipbuilding is concerned is going to be covered by means of such schemes. Also, the government aims to support the overall investment of rupees 4.5 lakh crores and 4.5 million GT shipbuilding capacity. It also aims to generate 30 lakh jobs in the period of next 10 years, for which this scheme has been approved. Also, the government wants to ensure that the overall shipping infrastructure and investment within the ecosystem is going to be promoted by means of these three sub-schemes which have been approved.
So big boost there for the shipping industry. Thank you so much for those details, Abhimanyu. And before we wrap, a setback for Elon Musk's social media platform X. The Karnataka High Court has dismissed a petition filed by the company against takedown orders issued by the government of India. Delivering its verdict, the court said social media cannot be left in a state of anarchic freedom and every nation regulates it. The court went on to say unregulated speech transcends into lawlessness and warned no social media platform is exempted from the law of the land. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The equity market has been testing investors' patience over the last 12 months. The Nifty is actually down 3.5% over this last 1 year. And the Midcap index is actually down 5%. If you look at the small cap index, well, even worse, it's down about 7%. So it's been a tough year, to say the least. Now, in the last several months, the market has had to, of course, grapple with many issues and challenges, including, of course, the US tariffs, the whole tariff storm, shifting US policy, and some will say perhaps, a bit of anti-India policy coming in from the United States. There are shifting geopolitical equations. We've had to deal with the Indo-Pak war. And of course, there is the issue of lackluster corporate earnings. So all of this has meant a fairly challenging last 12 months where investors have had to keep their patience, and they have kept their patience so far. Now, does the onset of the festive season and the mega GST reform, does it really mark a turning point in the fortunes of the equity market? And if yes, then do we as investors need to reassess our MF strategy, our portfolios to be in sync with the times? Well, today we have a very special guest joining in to answer some of these slightly complex questions and to make it simple for us in terms of a 3-year mutual fund portfolio strategy. Ashish Gupta, CIO at Axis AMC, is with us. Usually we always pull in Ashish for all of these complex market issues, some of the ones that I highlighted in my opening remarks. But today Ashish promises to simplify it all down for someone who's only looking at mutual funds in at least a 3-year horizon. Welcome to the show, Ashish.
Thank you for having me, Sabhi.
So, Ashish, you tell us. I think my opening remarks were a summary of everything we've discussed with you on our market shows in the last 12 months. How are you feeling right now? Semi-optimistic, more optimistic, less optimistic? How do you feel as we get into the festive season?
No, certainly more optimistic. I think what's happened in the last 3 to 6 months, and I know it's very difficult to kind of be constructive consistently, because the amount of news flow that we have seen, the amount of uncertainty and unpredictability that has come our way, both in India and globally, not just last 6 months, but last couple of years, has been unprecedented, right? There have been wars, tariffs. Now, recently, there's been talk of H-1B visas, etc. But I think for investors, what's important is that we should continue to look internally. I think for India, domestic growth is the primary driver of demand. And I think on that front, since beginning of the year, there have been multiple positive factors. I think since January, there has been a decisive turn in RBI policy. And as you know, for me, some of that has the monetary side, and the banking side is always kind of superimposes itself on my views. But since beginning of the year, we have had a very large infusion of liquidity. We have more than 100 basis points of rate cuts in India, and there is potentially some more that may come through in the coming months. We have seen government getting much more active in terms of spurring demand. In the budget, we saw income tax cut for the significant part of the population, and that has been topped up. The direct tax cut has now been supplemented by indirect tax cut in form of GST, right? And really 99% of items that were there in some of the highest slabs, GST has been meaningfully brought down. This is coming at a time where already in the rural economy that had been sluggish post-COVID. After 2 good monsoons, we had seen better activity in the last 6-9 months. So we were seeing already some signs of pickup in demand revival. If you, for example, see the demand for Nrega work, that is down nearly 25% last month. So you are already seeing some of that mass market demand pick up. And now if these other factors also start contributing to it, I think clearly we will expect GDP growth, we would expect corporate earnings growth in the next 6 months to kind of look much better than the last 6-9 months, where we have seen significant amount of earning downgrade. This is not to say that we don't have the headwinds of the global uncertainty, whether it is on account of tariffs or actually more importantly, the fact that next 12 months don't look great for the global economy, right? So those uncertainties will continue to weigh, but I think for us, really, domestic growth is a more important driver of the economy, and that certainly is looking up.
Yeah. You know, Ashish, I'll tell you, and these are conversations we hear around ourselves. I've definitely heard it in my friend and family circle. I'm sure you have, right? When investors look at their equity mutual funds, that part of their portfolio, most of them are static, maybe slightly lower, and then you've waited for 6 months, now 12 months. We all know that, yes, we need to remain invested, which is what investors have done, right? We've not seen massive outflows from equity funds. So that maturity is there. But investors are also now contrasting that performance with gold, with silver. Some are saying there are new asset classes like REITs, and the regulation for REITs is now getting, easier. So people are asking, should I be diversifying away from equity? Has that time come? Should I look at these other asset classes as well in a more meaningful manner? Till now, it was just buy Indian equities and that's your road to riches. So is that changing on a more structural basis?
I think I will certainly vouch for diversification. I think it is, particularly if you are investing for long periods of time, you need to have a diversified portfolio. And particularly if the asset classes, as you mentioned, are uncorrelated, right? So I think that kind of really improve the expected return of the portfolio. Of course, the question can be, should gold or silver be 5% of your portfolio, or 10% of your portfolio, or 15% of the portfolio, right? So I think those are bigger questions, but I think certainly you should have some of that in your portfolio. I think it's also a good hedge in terms of the risk from sustained currency depreciation. I like REITs as a product, both REITs and InvITs. They are good long-term cash flow generating assets. And given the fact that equities, particularly on a 3-5 year basis, have given very strong returns already, and even as I'm optimistic about equities, as I mentioned, going forward, we may not necessarily repeat the kind of returns people have seen in the last 5 years, right? So as in mutual funds,
that's a headline. That's a headline. He's the top boss who's picking all the stocks, and he's responsible for all the investments at Axis AMC, and he's being very realistic. Ashish is telling us, don't look at the hindsight. The last 5 year returns cannot be always projected in the future. We hear you loud and clear. So therefore, Ashish, it's so important to have this conversation today to reset some expectations and reset the portfolio, if at all if it's needed. Now, before we come to the big debate today on the show is consumption or capex, or should you do both? Before I come to that, let's talk about the headwinds which still exist for Indian equities. And US policy definitely seems to be that one headwind. Every time we think there is a thaw, now they're exchanging tweets and these social media messages, and now the trade deal will get done. One new missile gets fired, and the latest one is this H-1B visa issue. How do you sum it up, not just for the IT sector or IT stocks, but overall? I mean, is this a new overhang now?
So it is an overhang, but for frankly, medium to long-term investors, I don't know how much can we really invest on this basis, right? Most of these theses turn on their head within 6 months, if not sooner, right? And I'm sure you have seen the news flow where India was kind of being penalized for buying Russian oil, and now I think the focus is on other countries and European Union, etc. Right? What will happen in US elections? I think now they are 4 years away, right? So I think we cannot take any of these policies as long-term. In fact, you would have seen news flow that the government expects by November they should get to some sort of trade deal with India. So I think we have to be very careful, particularly as you said, if people are looking at a 3-year investment in mutual fund, make decisions based on such news flow, right? So these will drive equity market reactions over the next 6-9 months. But beyond that, continuity of these policies, to me, is very uncertain, because whichever way you cut it, right? We are saying that these US policies are harmful for India. But actually, if you see the real harm because of tariff is on the country itself, right? So, so what will happen to the US economy, because there the effective tariff rates have literally gone up from single-digit percentages to high teens. So I think as that impact comes in, they may have to rethink policies themselves. So I think we should not make long-term investing decisions based on all these news flow. I think we have to remain focused. Where do we see structural advantages? Where do we see? I think India and Indian companies have competitive advantages, and that is what will stand the test of time.
Okay, perfect. We take your point completely that we can't be, basing our investment decisions, that too 3-5 year, out investment decisions based on everyday news flow. So then how do we take a holistic view of our portfolios in this very dynamic market? And as I mentioned, that consumption versus capex debate, we dive straight into it, but after a very quick break. Back with Ashish in just a moment.
Let's talk money. talk money.
Well, welcome back. You're with us on Let's Talk Money. And this week we are in conversation with Ashish Gupta, CIO at Axis Mutual Fund, who's helping us figure out how we need to take a complete a view of our portfolios, look at our mutual fund investments, looking at the very dynamic market and the number of issues which it is grappling with. So one thing Ashish has already established is don't get carried away every time you hear a new tweet or a new, soundbite from the US. Stay focused on the medium to long term. So on that, Ashish, now I want to get to the heart of this. What we've seen with these GST reforms, with maybe the income tax cuts, is for the first time I've seen in the last, I think, maybe 7, 8, 9 years, that there is interest now in the consumer side of the market, mass consumption. But is this a passing trend, just some sector rotation, or is this something more serious that we should take note of as investors?
So, I think consumption always has been the underpinning of India's growth story, right? So 60% of GDP, as you know, is driven by consumption. Even as you mentioned, in the last 7, 8 years, consumption as a theme may not have been very exciting, but there has been several pockets within that have provided a lot of growth opportunities, right? So, we have had pockets of discretionary consumption doing well. We have had changing consumption patterns benefiting us. We have had and I count stuff like real estate, hospitality, all part of the consumption basket. They have done very well over the last few years. You have had a new should I say, channels of consumption like quick commerce come to the fore. So I think as a broad theme, it might not have done well, but there have been pockets that have continued to do well, and I think that will stay true. I do believe that overall consumption expenditure growth that had slowed down to about 6-7% in the past 12 months is set for the pickup for the multiple reasons. Which are the new forms of consumption? Which are the businesses and companies that are gaining market share? Because that's really that will drive returns. We have seen some early signs of broad-based consumption and GST cut announcements boosting the theme. So if you see in the last 6 months on the consumption side, we have seen the index go up nearly 13-14%. And it's also relative to where the valuations were, right? So many of these companies were trading at lower multiples compared to the kind of optimism that were there in other parts of market, including on the investment side. But again, on the investment side, equally, there are some themes that continue to be very strong, whether you look at, let's say, energy transition, right? So, so the renewable space or all the announcements around hydrogen. In fact, even more broadly, the power sector continues to be a very strong theme for us. It is there on the generation side as well as the transmission side. You also have continued capex happening towards all the EMS, OSAT. We are seeing actually increased capex even in many cement companies. Defense is another theme, if we can club in that bucket. So I think it's not that the capex side of story is seeing slowdown across the board. I think there are opportunities there that continue to be very attractive.
Okay, so it's not really either or, it's perhaps both as we look at a balanced portfolio over the medium term, consumer as well as investment or capex or the industrial side of the economy. Take that point, Ashish. Now, on consumer itself, and I don't know if you have data offhand, maybe you can shed some light on it. Because the theme, and I'm talking mass consumption, I mean high-ticket consumption, like you said, like, top dollar real estate companies or jewelry companies, they were anyway doing well. But I think mass consumer stocks were absent from most portfolios, or at least were in very little quantity, I guess, across the industry. So now, as you feel quite convinced about this consumption theme lasting, as an investor, should I just stick to diversified funds and eventually hope that, my asset manager will eventually start buying these stocks if they're doing well? Or is it strong enough to warrant a thematic look? Should I be looking for consumption funds, actually, to look at playing it in a secular way over the next couple of years?
I think if you are looking on a 2-3-year view, I would say you stick to diversified funds. I think we have seen fund managers, I'm not just saying RAMC, but if you see across the industry, they have been very good in terms of kind of generating consistently alpha across various market cap cohorts. So I think touchwood, the Indian portfolio management community has been able to catch the trends, have been able to differentiate among the companies that are going to benefit very decisively. So I would say stick to kind of diversified funds. I think investors who are looking at sectoral thematic funds, I think they have to take more tactical views, right? So those are, I think, 6 months, 1 year views. Otherwise, I think it's best to stick to diversified funds.
Okay, got that. That's really helpful. Now, Ashish, we're coming to the final few minutes of the conversation. So I have a request. You're a veteran of the financial markets and the financial services landscape in India. But for the next 1 minute, 60 seconds, if I could ask you to don the hat of an advisor, right? And I'm sure you get asked these questions to your friends and family. If you were to tell someone, what kind of a mutual fund portfolio, this is a medium risk investor with at least a 3 or 5 year horizon, with that caveat in place. If you were to help someone design a portfolio, how much should be equity, gold? And gold is still booming. Every day we get asked the question saying, should we buy more silver funds or silver ETF or gold? Then there is, of course, fixed income. Looking at the overall environment, the RBI, expectations of rate cuts. What would be your recipe for that portfolio? And which are the thematic categories that you would perhaps consider for this medium risk, medium term portfolio?
Sure. So I would say that I will still put kind of 60-65% of the portfolio in equities. I think between fixed income and REITs, and to the extent REITs get classified as equity now, either through the fund or directly, maybe another 10-15%, and 15% or so can be precious metals. I think take your pick between gold and silver. I think silver is outperforming for now. But I personally believe that if you are going for the kind of precious metal, it's kind of better to stick to gold. So if you are doing 15% there, I would say majority should be gold. Silver can be more tactical. And within equity, as I mentioned earlier, my preference is for the diversified funds. And rather than go for any market cap cohort, I would recommend doing a multi-cap or a flexi-cap fund. For thematic, rather than a narrow theme, do a broad theme like services or consumption. So even as I'm positive on, say, power sector or defense sector, I don't think it's appropriate for the medium-term investor to do a very narrow theme. You kind of play it through diversified funds, and for themes, you go for Broadway themes like consumption or services.
Oh, you've been so charitable. Thank you so much. It gives a great framework for our viewers to go back and reassess with their own advisors on how they can perhaps think about designing their portfolio. And I'm glad you brought up the point on REITs, Ashish. Actually, that's a cue for our viewers as well. We've done a REITs classroom earlier. We will revisit it because the regulation has changed. So let me just end with that, Ashish. Now, for the benefit of our viewers, SEBI is coming out with new rules, which means that equity mutual funds, wherever they're a little short on their equity allocation, they may want to add a bit of REITs as well, real estate investment trusts. Just Ashish, broad sort of view on this. What should we expect? Will more REITs get added to equity funds? Just what should we expect on this? Let's say a year down the line, as this is adopted.
I certainly think so. I think more should get added, and particularly, and as I said, where the multiples in the market are, we are not kind of expecting equity returns to be of the magnitude they were post-COVID, right? So from 2020, when the valuation levels at the market were very low, the returns have been very high. But from this level, if you expect market returns to be more in line with the nominal GDP, etc.,
which means 10%, Ashish? I have to try and pin you to a number, which means what, 10% CAGR equity returns?
So we hope nominal GDP growth recovers to a number higher than that. But it would be about 12-13%.
Oh, that's good.
Right. And so in that context, I think REITs offer a good stability. Yields are around 6-7% in terms of regular return and with some potential upside of capital gains, right? So I think given that construct, I think REITs should form an increasing part of equity portfolios.
Okay, sounding absolutely great, and that's very reassuring. We can still work with 12-13% kind of compounding returns over longer periods in equities and have perhaps a new asset class like REITs for added stability to the portfolio. Fantastic conversation, Ashish. Thank you so much. Extremely helpful for all of our viewers. Thank you very much for joining us on the show today.
Thank you, Sept.
All right. Well, there you have it, a view from Axis Mutual Fund. And with that, as a wrap on this edition, do let us know what you thought of the conversation. Send us your questions, anything new that you're interested in, and we'll take up those issues in the coming weeks. Thanks for watching.
Let's talk money.
Hello, welcome to News Center. I'm Parikshit Luthra. The top story today, a setback for Elon Musk's social media platform X. The Karnataka High Court has dismissed a petition filed by the company against takedown orders issued by the Government of India, delivering its verdict. Ashmit Kumar now joins us with more. Ashmit, take us through what the High Court said and what are the implications.
Well, you pointed out quite correctly a big setback coming in for Elon Musk-backed X Corp. X Corp was challenging various multiple takedown orders that had been issued by the government. The High Court has made it unequivocally clear that as far as social media regulation is concerned, that is what is required, that is the need of the hour, that social media companies can't be left to their own devices. That will lead to a sense of anarchy, going on to say that free speech without regulation will transcend into lawlessness. So very strong language being used by the Karnataka High Court there. The High Court further goes on to say that no social media company can come before us and then claim exemption from the law of the land. This is the law of the land that has been passed by the parliament, that has been passed by the government. This is the way. There is regulation that needs to be done here in India. Now, the situation here is not unique. Regulation of social media is true across multiple geographies. That's what the Karnataka High Court is saying. And finally ending by saying that even X Corp, which is an American company, abides by the takedown regulation, the social media regulation in the US. Having done so in the United States, there's no case that X Corp has made out for not complying with the law of the land in the country. So with that, the High Court holding that there is no case made out by X, that their petition has no merit, it needs to be dismissed. So a strong setback this, as far as X is concerned. Bear in mind, there are two sections, there are two provisions under which the government can can issue takedown orders. One is Section 69, the other is Section 79 of the IT Act. Section 69 has safeguards, Section 79 not so much, and that's the latter. Section 79 takedown orders is essentially what X had challenged. X had also challenged a Sahyog portal. The government introduced a Sahyog portal where social media companies need to come on board, where the government can facilitate takedown orders. On all of these aspects, the High Court has upheld the centre stance, saying that X needs to comply with the law of the land. So clearly, a setback coming in for Elon Musk-backed X, but this is not the end of the road. This is an order passed by a single-judge bench. X does have the option of appealing this before a division bench of the Karnataka High Court.
All right. Yes, indeed, an important order there. Thank you very much, Ashmit, for joining us. Now, let's get an important reaction from Senior Supreme Court Advocate N.S. Napinai, who joins us on the phone now. Ms. Napinai, how do you see this order from the Karnataka High Court, which virtually says that the centre can give takedown orders, blocking orders, and it's well within its legal right to do so? What is the larger implication here?
Yeah, hi. Thank you for having me on this. Absolutely right. This is a very critical order and much needed for ensuring that social media platforms and chat apps comply with the law of the land. Otherwise, there has been a lot of back and forth with respect to the jurisdictional aspect on whether they are bound by our laws or not. Secondly, there are two aspects to it. 69A deals with blocking, and 79 and takedown orders are under 79. It would be incorrect to say that 79 is not sufficiently ring-fenced, because you now have very clear regulations that set out what are all illegal content which a platform should ensure is not hosted on its platform. And if such content perchance comes on their platform, then a takedown order is issued, which is to be complied with. There is also a procedure for a protest on that. And we in India are bound by two things. One is reasonable restrictions are a part of our free speech. So it is not unbounded. The second aspect is reasonable restrictions from a government's perspective also has to follow through with due process and with a parliament enacted law for a legitimate reason. So once that is established, and that's what the Karnataka judgment says, where an order is issued with fair, proper reasons, then it is to be actioned. It does not say any kind of order should be complied with.
Right. That's an important point. And finally, ma'am, what does the Supreme Court say on matters like these? Eventually, that's a precedent that will be followed. This order too can be challenged by X. It can go to all the way up to the Supreme Court. But as of now, what does the legal precedent say?
The legal precedent is very, very clear. So in fact, in the Shreya Singhal judgment, 69A also was taken up by the court in terms of deciding on the constitutionality. And this judgment struck down a provision under the Information Technology Act for being excessive, which was 66A. Whilst doing so, it says that blocking orders carry with it checks and balances to ensure that free speech will be protected, but illegal content will be blocked or taken down. And that is the the first landmark judgment you have in terms of blocking or takedown orders. You have many that have followed thereafter, and the law is very clear. When it is under a parliament-enacted law and for a legitimate reason, and two, when you as a social media platform are extending your services to users in India, you're amenable to the laws of India, you have to comply with them, and you will have your right to be heard, like how Karnataka High Court heard Twitter and then decided that the takedown orders were legitimate and appropriately issued. Similarly, if an individual or a company has a concern about the correctness of an order, you have a procedure for contesting it. And as long as that right rests in you, it is not like an absolute mandate against you, then the constitutionality can be questioned.
All right, Ms. Napinai, thank you very much for joining us for that quick reaction there, explaining us the ramifications and telling us that the Parliament had already passed a law and it is important for social media companies to comply with that as well. Let's move on and focus on India-US ties. Commerce Minister Piyush Goyal says India expects to increase its trade with the US in energy products in the years to come. Speaking at the US-India Strategic Partnership Forum in New York, Goyal said that India's energy security goals will have a very high element of US involvement. Minister Goyal is in the United States for the first time since US imposed 50% tariffs on India, partly as a penalty for buying Russian oil. External Affairs Minister S. Jaishankar is also in the US and he hosted a meeting of Global South nations on the sidelines of the UN General Assembly in New York. Speaking at the meeting, Jaishankar called on the Global South to renew commitment to multilateralism.
We expect to increase our trade with the US on the energy products in the years to come and be close friends, natural partners. Our energy security goals will have a very high element of US involvement, which will ensure price stability, which will ensure diversified sources of energy for India, and help us unlock limitless possibilities that the US on various fronts, energy and beyond.
The rights and expectations of developing countries in the international system, which has been so assiduously developed over many, many decades, are today under challenge. In face of such proliferation of concerns and multiplicity of risks, it is natural that the Global South would turn to multilateralism for solutions. Unfortunately, there too we are presented with a very disappointing prospect.
All right, let's move on. Global diamond jewelry giant De Beers has launched its first flagship store for its most popular brand, Forever Mark, in New Delhi. The company is planning to open 100 outlets across the country. The debut comes in the middle of the festive season as the brand bets on rising demand for natural diamonds, even as prices of lab-grown diamonds tumble worldwide. Shivani Bazaz spoke to Shweta Harith and Sandrine Kunsela on the company's plans in India.
So I think the growth is coming from tier 1 and tier 2, and it's coming from e-com all the way. So we'll have a different price point because people still want to, after a particular point, they want to see and touch the product. It's just e-commerce gets me in there faster, but we will open our own stores. So our ratio is going to be 1:3. So 1 own store and 3 franchise stores. And I think that's the way we want to capture India versus having just 1 store in 1 mall. I think India has much more to offer than that.
Okay, we're speaking about India and the festive season has just begun. Is this launch, just placed in this time, and how do you see the growth in revenues and sales in the festive season?
So I think the sentiment is pretty high. I mean, I've been going to the Southex store every day. I can see people walking past. We actually had people walking in already. So I think festive is going to be good for everyone, and there was a reason why we opened now, because we believe people are in that mindset. So it's a good time to start.
But from last year to this year, there are a lot of reforms that have happened. Income tax cut happened earlier this year, GST reforms happened. So, of course, I mean, in a simpler way, more money in the hands of the consumer. Do you see that this can probably push sales this year?
Absolutely. I think the GST reforms have come at the perfect time. They haven't impacted us because it stayed consistent, but I've seen it across the board. All consumer products. I think HUL has announced that they will take price down. So I think it's great for anyone who wants to spend in the season. So it's a great action.
Okay. So, Sanjay, last question to you would be that, as Shweta was saying, that the expectations are of course high, and 100 stores, as we mentioned, as we discussed earlier as well. My question to you is that from a global perspective, where does India stand in Forever Mark's global strategy now? We have always associated luxury with New York, with bigger cities like this, but now coming to New Delhi, how do you see the next 5 years going on?
Yeah, there are 3 big markets for diamond in the world: US, India, China, in that order. Last year, India took over China, so India has definitely a place in the map from the number perspective, but as well from the history perspective. There is a space in this market between the big chain, whom we love, we know them very well, and the international brand. That space is today almost empty, and that's where Forever Mark will fit. And that's why I think we have a great potential.
Focusing on the automobile sector now, electric vehicle player Ultraviolet has launched its new electric motorcycle, the X47 crossover. The motorcycle will be priced at 2.4 lakh, and this will be applicable for the first 1,000 bookings only. Speaking to company CEO Narayan Subramaniam, he has also went on to say that $70 million has been invested in the company so far, and they are targeting 10,000 units by the end of this fiscal year.
If you look at this motorcycle, it is perhaps the world's most tech-loaded, power-packed motorcycle, right? We are talking about 300 plus kilometers of range on a single charge, 600 Newton meters of torque, and a tried and tested platform from the F77. And today, all of this coming together with tech like radars for the first time in the world in this segment. So our challenge has been developing the tech, one, and two, to figuring out how to make it affordable at scale. So today, all of this comes together at a 2.49 lakh entry price point, which I believe is quite disruptive. There's nothing else in the market today that offers this amount of tech and specs. India is now live in 30 cities. Ultraviolet is live in 30 cities. And globally, we're live in 10 countries in Europe, including, we've got bikes on the roads of London, Paris, Berlin. And so this year has seen active expansion in India. Next year, we'll see more active expansion in Europe.
Has GST simplified your input cost and also supply chain?
It's helped for sure on the electrification side, not just the GST. There have been a lot of government push around the whole country getting electrified. So we're glad to be part of leading that revolution. And I hope, you're talking about policies, I hope even the PLI schemes become conducive for startups like us to benefit from.
So any plans of going public anytime soon, launching an IPO?
It's something we'll have to take a measured call on. I foresee us probably spending another 2 years or 24 months at the minimum in terms of establishing presence across India and a couple of other global markets with multiple product lines. And I think it would be a stable point in time to think about an IPO.
On that note, we take a short break, but next, corporate social responsibility spending in India is projected to exceed 1.2 lakh crore rupees annually by 2035. This according to a report by the Convergence Foundation. We speak to the foundation CEO, Ashish Dhawan, when we return. Welcome back. You're watching News Center. Corporate social responsibility spending in India is projected to triple and exceed 1.2 lakh crore rupees annually by 2035. This would make it the largest pool of philanthropic capital in the country. The finding is based on a Convergence Foundation report, which observed the earnings growth of the top 100 listed companies. The report highlighted the rise of catalytic funding directed to organizations which support governments in strengthening public systems. India was the first country in the world to legally mandate corporate social responsibility in 2014. Joining me now to speak about this report and more is founder and CEO of the Convergence Foundation, Ashish Dhawan. Ashish, the importance of CSR in the current context. You know, you're seeing immense geopolitical volatility, trade uncertainty and restrictions on H-1B visas. How can CSR be more impactful and create real change and help India, especially when it comes to addressing our vulnerabilities?
No, so it's a great moment. As you know, CSR spend right now is 30,000+ crore, almost 33,000 crore. We estimate that at a regular growth rate of profits, it should reach about 1.2 lakh crore by 2035. So it is significant now. It started with a small amount 10 years ago, but it's quite a meaningful amount today. And government actually is spending 26 lakh crore on the social sector. So CSR today is about 1.3% of government spend in the social sector. So I think CSR spend is important because it's almost like a catalyst. It's that catalytic capital that can add to what the government is already doing, which can really help accelerate India's goal to attain the SDGs. India is already doing well. I think irregardless of tariffs, irregardless of H-1B, why can't we ensure that we attain our malnutrition goals, our gender goals, our education goals, etc.? And CSR can clearly play a role with regards to that.
Your report also points out that CSR spends may be small right now compared to the 23 lakh crore social spending by the government. But if we combine the two, that is corporate CSR with government social spending, then this can be a catalytic force. Which company CSR policy or models, according to you, and the examples of corporate social responsibility and a partnership with government stand out for you?
No, so it's a great moment. As you know, CSR spend right now is 30,000+ crore, almost 33,000 crore. We estimate that at a regular growth rate of profits, it should reach about 1.2 lakh crore by 2035. So it is significant now. It started with a small amount 10 years ago, but it's quite a meaningful amount today. And government actually is spending 26 lakh crore on the social sector. So CSR today is about 1.3% of government spend in the social sector. So I think CSR spend is important because it's almost like a catalyst. It's that catalytic capital that can add to what the government is already doing, which can really help accelerate India's goal to attain the SDGs. India is already doing well. I think irregardless of tariffs, irregardless of H-1B, why can't we ensure that we attain our malnutrition goals, our gender goals, our education goals, etc.? And CSR can clearly play a role with regards to that.
Also, how do you think we can achieve scale with CSR, and which would be some of the sectors where CSR spends will be most impactful?
So I think companies are very interested in education. It's already, as you've seen the data, the #1 spend area for CSR. Government already spends about 8 lakh crore on education. So I think here there's a great opportunity for partnership between CSR and government. The new education policy came out in 2020. Government is looking to implement that. Nipun Bharat, which works on Bunyadi Shiksha, foundational learning. So I think there are lots of avenues for CSR to plug in to a very large government mission and work at scale. And there's a lot of interest from the side of corporates. A second area is skilling. I think companies need talent. They recognize that skills is a pain point, and so they're very passionate about it. Large companies like Infosys, Bajaj have prioritized skilling as an important area. So here, again, there's the opportunity. Government had this skills mission. Now they're working on apprenticeships, internships. But in addition to working with government, I think there's the opportunity to create a large-scale collaborative amongst the corporates themselves, that they can pool their resources, come together, pool their know-how, and work together at much bigger scale. Tens of millions as opposed to just a few million. And a third area is healthcare, where corporates are very interested. And again, working at the grassroots level, primary health centers, looking at improving malnutrition, women's health, child health. These are all important areas.
Also, you spoke about skilling. In the last few years, we have seen this race for artificial intelligence and high-tech manufacturing. But there is a skill gap, and there is also a need to upgrade industrial training institutes across the country. How can CSR spends help in bridging the skill deficit in areas where China has an advantage?
No, I think it's a very valid point that you made. So I think government is seized of the opportunity. If you look at two areas, one is ITIs, lots has been tried. There are about 4,000 government ITIs. But government has now said, let's pick a smaller set of ITIs and 1,000 ITIs. And they've come up with a new 60,000 crore scheme where there's going to be a public-private partnership. Central government puts in 30,000 crore, state governments 20,000 crore, and corporates will chip in 10,000 crore. Now, these corporates will willy-nilly look at how do we get people future ready. So I think corporates are better equipped at bringing in the know-how in terms of how do you leverage AI, how do you make people AI literate and skilled for a human plus AI. So you can leverage AI to the fullest. So that's in the context of the ITIs. And then you have this apprenticeship scheme, NAPS and NATS, which are run by two different ministries, the Skills Ministry, the Education Ministry. And in addition, we have a PM internship scheme. I think in all of those, it's a chance for students to now work in companies as an apprentice or an intern. And again, companies, you can learn cutting-edge skills, upgrade yourself, and be future ready. So I think these are two ways where there's a real partnership opportunity between government and the private sector for future ready skills.
Also, what developments do you expect in the CSR ecosystem in India in the coming 5 years?
So I think one is the quantum of funds is going to go up in the next 5 years, probably from 34,000 crore to 60,000 crore. So fairly large scale. Second is, I see that we went through the teething problems the first 10 years. Now corporates no longer look at it as a compliance. Early on, I think they came at it grudgingly, saying government has put this burden on us. How do I do it? There were lots of teething problems. Now the companies have gotten themselves organized. So what I see different in the next 5 years is three things. One is, I think, greater commitment from top leadership. We just did a forum 2 hours ago, 8:30 in the morning, where we had 10 CEOs come in. And all of them were talking about how they personally sponsor CSR in their company. So Amitabh Chaudhary at Axis Bank, Hitendra from HSBC, many other leaders were in the room today. So I think that top leadership sponsorship, the sponsorship of the board, that's something that I see. Second is, I think right now, if I look at it, the CSR leader in the company doesn't have the same power as the CTO or the CHRO or the CFO. They're often someone who just been thrust into that role. In the next 5 years, I see the CSR leader having a seat at the table, much like any other CXO within the company. And right now, only 10%, as I said, of companies have hired top-notch people. I think they need to pay up, they need to invest in talent, given the scale. And finally, I think the idea that you need to measure, you need to monitor these projects and really look at driving for impact and working long-term not just working for a year or two, but working for 10 years in a focused area and measuring, monitoring regularly, that's a change that I see. Companies no longer just want to spend the money, they want to see impact.
That's all the time we had on this edition of News Center. More news and updates when we return.
Good morning, ladies and gentlemen. Welcome to the CNBC TV18 Mega CEO Centimeter. I'm Shireen Bhan, and we're coming to you live from the CII National Conference here in Chennai. And of course, this is an engine of growth for India. And we are going to be talking about what next now to drive reforms and to drive growth for India. Before I get my audience and the CEOs present here, this is one of the largest platforms that you will see. Almost 80 CEOs present here under one platform, live right on CNBC TV18. Before we get the Q&A started, I decided that this was a good opportunity, since we have everybody here in the room, to actually do a dipstick survey and sense and gauge the mood of the nation, to gauge the mood of India Inc. So without further ado, let's get started. My first question, and this will of course result in a show of hands from each one of you, so I would request you to raise your hands depending on which way you decide to vote. With the GST boost coming in, the chief economic advisor suggests that growth will be higher, perhaps closer to the upper end of the band that was presented in the economic survey, which was 6.8%. What is your growth expectation for FY26? Ladies and gentlemen, option 1, 6.5%, option 2, 6.8 to 7%, and option 3, more than 7%. Those of you who think that growth is going to be 6.5%, please raise your hands. Okay, no hands here on 6.5%, between 6.8 and 7%. Okay, quite a few. And those who believe that it is likely to be higher than 7%? Okay, so that's the mood of the House. Just what the chief economic advisor told us, 6.8 to 7%, a little better than the economic survey's estimates. That's the mood as far as industry is concerned. The second question, and again, I'd appreciate a vote, a show of hands here. Do you see inflation easing further, and do you expect the RBI to cut interest rates again? Yes or no? Very, very simple. Those who believe the RBI will cut rates, a show of hands, please. So most people in this room do believe that the Reserve Bank is going to cut rates. And the third question to kick things off here, we've seen what's happening as far as the currency volatility is concerned. Do you expect the rupee to end, option number 1, in the current band, which is between 88 and 89, to be stronger, which is below 88, or weaker above 89? Those who believe that the rupee is likely to trend in the current band, if you could raise your hands, please. Okay, and those who believe that it's expected to be stronger, that is above 88, just about 2 hands in the room, and those who expect it to be weaker, that's below 89. So majority expect the rupee to be in the band between 88 and 89. So let's get straight off. Rajiv Mani, I'll come to you to start with. What was your vote, 6.5 to 6.8 or 6.8 to 7%?
No, 6.8 to 7%.
Okay, and you believe the GST is going to help drive that number?
Yeah, I think GST will definitely help. I think firstly, the first quarter GDP growth was also was a very positive surprise, and from what we are seeing with the monsoons and the uptake because of GST on the consumption, just some of the early sentiment that we are seeing. We haven't seen the numbers as yet. I think 6.8 to 7% should be achievable. We are also seeing, if you look at steel, if you look at cement, the broader trend on the construction sector, which contributes a lot, that's very positive. We just saw yesterday mining sector is starting to show very positive growth. So I would say overall, 6.8 to 7% is probably a safe number to go with right now. I think India's bigger challenge is not the real GDP growth. I think it's the nominal GDP growth. Yeah. Because from a tax revenue collection, from a fiscal deficit number, I think that becomes more relevant. I think that's where we'll have to see if inflation continues to stay as benign as it is, and with GST it may come down a little bit, currency stabilizes, then the likelihood is that the nominal GDP growth will be a challenge. So we're hoping that if RBI was to reduce the interest rates, in some ways, push for greater growth, and then if that has a mild impact on inflation and it comes to closer to 2 to 3% in that range, if it ends in that range, then hopefully the nominal GDP growth number should catch up.
Mr. Mukundan, what did you vote when I asked whether interest rates are likely to be cut or not? Do you expect the Reserve Bank and the MPC to deliver on another rate cut?
I took a safe one. I actually voted with the president.
Which way did the president vote on that? You were looking at him. So yes or no on a rate cut?
Yeah, we do believe, I think there'll be I think we are in an era of, I think, a continuous rate being eased, because I think the inflation trends are down, and the long-term trends on inflation are also pointing towards going to be, and with hopefully we are seeing the peak of the tensions, trade tensions. We are the peak in the sense that it may last 90 days or 100 days, but I think post that again, I think the trend will be easing it down. So all directions are in the same direction. Clearly, I think we are in a very good spot in many ways. If interest rates are going to be benign or coming down, and our many things which government has done, including if you look at what they've done in power sector, what they've done in the roads, the logistics, all the every aspect is now in place. So our own expectation is this is a time when we need to be positive. I think industry is a bit cautious because of all the tension around, but I think once that eases, you're going to see a massive push going forward. That's really the way
The question is, what is the timeline for that massive push going to be? But I'll come back to you in just a second on that issue. So industry expects rates to be cut, or at least hopes that the RBI will deliver with another rate cut. And the consensus in this room of a large number of India CEOs is that growth is likely to be between 6.8 to 7%. You know, I should have polled a question on gold as well, Mr. Muthoot. Let me come to you. Gold prices at record highs. I mean, you're talking about peaking as far as trade tensions are concerned. Any signs of peaking on gold prices?
Gold has been always lucky with Trump, and Trumpism is driving gold. And the uncertainty in the global economy is driving gold prices. I think now the new gold is silver, with silver going to be the next driver of investment for the common man, because gold now has become unaffordable.
Gold has become unaffordable. Yes, I would imagine consumers will agree with that. But do you expect the rally to continue?
I could say that 40% of the Indians have become wealthier now, with the gold prices moving up 40%.
That certainly is the case. But do you expect prices to continue to edge higher from here? And what's the expectation on silver?
Silver would be around 45 is what market outlook, and gold would be somewhere at 3,800 per ounce.
3,800 per ounce. So the rally is likely to continue. Mr. Trump has been good for gold prices. Roshni Nadar certainly not been good as far as the IT sector is concerned. So let me come to you now, because the issue that has captured headlines has been what's happened as far as the H-1B visa issue is concerned. While we have seen some sort of a pullback, there have been clarifications issued by the White House that it comes into effect only from the next lottery year, that is 2026. It doesn't apply to renewals. But now they're changing the lottery system. In itself is what the expectation is and what the proposal is. Roshni, to start with, the impact on Indian IT on account of H-1B, not just in the near term, but in the medium to long term.
So, Shireen, I actually think that, I'd mentioned this before as well, that we can't let this, never miss a good crisis. And if at all, if you've seen the trend of H-1B visa applications over, let's say, even the last decade, India's the largest proportion, but the number has been coming down.
Yeah.
And a lot of conversations today that you have with your clients, and we're all pretty heavily indexed on the US, is around AI adoption and AI-led deals. And there is a certain non-linearity in a lot of deal constructs in the way the entire sector is having to reimagine itself and restructure itself and reorganize itself. So, I mean, I think the pain is much more short-term and medium-term, but this is not just a problem for the industry. It is also a problem for customers, clients, and actually some of the most biggest companies which are hit by this are actually American companies.
Yes.
So one will have to navigate this. I think that it would probably drive those many more actual decisions on AI-led conversations and AI-led deals. And those are non-linear in nature anyways.
Yeah, you know, Roshni, you're right in pointing out that this is going to impact US big tech far more than it will impact Indian IT, because the proportion of H-1B visas has been higher on the US big tech side, and India has been seeing a decline over the last few years, in fact down over 30% in the last few years. But in the near term, as you said, in the near term there will be pain. Do you expect a repricing of contracts? Do you expect that between clients as well as IT companies there will be an absorption of the higher costs?
I'm not sure, Shireen. I think it's only been 2 days, and that was Saturday and Sunday.
Yes.
And I think, and today is, of course, yesterday has already showed that there will be some difference in changes in, the way they're going to actually structure the new plan for H-1B and looking at highly skilled. Perhaps there will be, again, in the short term, but it could also drive more outsourcing, which then again goes back to a very different sort of pricing model.
But do you worry about the fact that now that the first salvo in a way has been signaled on services, because so far the battle has really been on the goods front, now with services getting into the fray on the outsourcing front as well, while there's a long way to go for the higher bill to become an act, to become legislation, that this really opens up a new front between India and the US as far as our trade relations are concerned?
Maybe, but I also think that it's impacting different companies very differently, and I think business mix makes a huge difference. At least for us, in the last 6 years, we've invested more than $3 billion in IP, and that itself is non-linear in nature, and we have a huge investment and business line in software. So I think that business models are changing, and we just have to adapt.
me take the H1B conversation forward, because Shashwat Goenka, as part of the group, you also have First Source, and I know that you've been hiring locally in the US, so perhaps less vulnerable to the changes. But as a company and as an industry, how prepared is India to move to product and platform, and whether this is in fact going to be the opportunity that this crisis presents?
I think definitely. And earlier today, we heard that an opportunity is only worth its weight in gold if you take that opportunity. And I think it's for us as Indians to take that opportunity. And I think for us as First Source specifically, we're not very impacted with H1B, as you mentioned. But I think with this, there will be a rethink on the industry, and the push towards AI, which is what all of us have already been building towards, will probably translate to it much faster.
Move towards AI much faster. I'll come to Vivek Raghavan, the AI man on the table, in just a second. Sarvam AI, Vivek, I'll come to you in a second. But Satish Reddy, let's come to you. H1B, this was the sword that was hanging, and now it's out there in the open. On pharma, we still don't know. President Trump keeps threatening that something's coming, but we still don't know when, and we still don't know what. How ready is the Indian pharma sector for the possibility of higher tariffs?
I mean, like you said, we don't know, right? So we still hope it won't be anything which is punishing, because, again, if you see the outcomes, Indian exports to the US in pharmaceuticals is largely generics, and that goes to the people. So when it comes to the payers, finally, it's mainly the government, and also it's the common people who will be hurt the most. Right, so we certainly hope it won't happen, but even if it were to happen, I think it has to be an issue of who will be able to absorb the additional tariffs, which we assume will be low, right? So between the distribution
when
chain,
you say low, what is the expectation or the assumption that you're working with?
There's no assumption, but we just expect it to be low because of the reason that I said. It's going to have a deep impact in terms of, the cost to the governments as well as to people. So we hope it won't be high. But at that point of time, then the question comes, how much of will it be absorbed by the distribution chain and also by the company? That's something we have to watch out for. But all of us hope the best case prevails, which is no tariffs.
But yes, of course, that would be the best case. What's the expectation? And that's another question that I'm polling here. What is the expectation on the India-US BTA being done? Those of you who believe that we are going to see the India-US BTA conclude, the expectation, the hope, the assumption was that by fall this year. Those of you who believe that it will be done by fall this year, by November, which was the timeline estimated, do raise your hands. And those who believe that it will perhaps spill over into next year, raise your hand. So those who believe it will be done by this year, the India-US bilateral trade agreement, if you can raise your hands, please. Okay, a fair number. Those who believe that it's likely to slip into the next year, next financial year, or next calendar year, well, there's more who believe that it'll probably get done this year. So that's certainly good news. Janmejay Sinha, you just did a presentation on why you believe that American exceptionalism is over, and you believe that this is going to be an opportunity for India. What's the best case? What do you believe India needs to deliver on to ensure that we leverage on this?
See, the basis of American exceptionalism was limitless risk-free capital, talent, and R&D. All of those become available. So India needs to, of the $27 trillion of risk-free capital floating around in the US, even if we target 100 billion, which is nothing, but 100 billion, even if we create 9 centers of advanced learning or whatever, with 1,000 crores each, then we can attract and get these H1Bs and students to land. And if we, instead of having R&D at 0.56, move it to even 1% of GDP, then we are already on that way, in the sense that it is tragic that an opportunity of this magnitude, of this size, if we don't capture it, then we can sit here and in 10 years from now say, India misses opportunities. And to blame, it will not be the government.
Yeah.
It will be everyone sitting in this room. So everyone should look inside and say, I'm a loser. Fine, then India will be a loser.
So to borrow from John F. Kennedy, ask not what your government or your country can do for you, ask what you can do for your country. Let's throw this open. What is the number one thing that India Inc. needs to do to leverage on the opportunity?
Get talent. Everyone in this room should be trying to hire 50 people from the US. And I don't think they've got the plan.
Does anybody here have the plan to bring back those who are dealing with the uncertainty of H-1B to India? Anyone here who wants to take up Janmejay Sinha's challenge? Shobna, go ahead.
I want to be proven wrong, Shobna. I want to be proven wrong.
No, I go with Roshni that says it's just been the weekend and this thing is still evolving. But I think it has been part of today's conversation that we look at it as an opportunity and we understand that there's enough talent. And many of these companies are looking for such talent as we transition into AI. We know that there'll be the best of healthcare. So for us, it's an opportunity. But the second opportunity I see for us is when it becomes tougher for the rest of the world to go to the US, India becomes a really good place. Like the Proton we have here in Tamil Nadu is the only one in Asia, and people can come from all over. So I think every one of us should introspect at this time to see how we can make this crisis work for us.
Roshni?
So, I mean, Shireen, just from our experience over the last 25 years of, at least investing in educational institutions for the country. But, I think it's time to also retrospect and question that why did that talent leave in the first place? And was it that they were just looking for better opportunities and jobs, but it was also the ecosystem? And if you have to create the ecosystem in the country, and at the risk of sounding repetitive, because I've said this before as well, innovation and R&D plays a huge role, and also the patent ecosystem. And it's absolutely critical that for a lot of this talent, which is unable to go now to the US or is considering coming back for all these reasons, and could be other reasons as well, to continue to invest in building institutions, continue to invest in building R&D and research, and across various fields, right? I mean, I was mentioning to the Foreign Secretary earlier that sovereign technology. Each country is looking at building its own sovereign technology, whether it's in semiconductor, whether it's going to be in AI, whether it's going to be in quantum. They're actually going to be extremely exciting areas for people to come back and work in and do research in. And then, of course, Tamil Nadu wants to take even leadership in space tech. So there are very interesting opportunities, but people want to harness also the investment.
Yeah.
And that's going to be absolutely critical.
So short question. Will we see a step up, for companies like HCL Tech on R&D spends, on innovation, on setting up perhaps these centers of excellence?
Absolutely. I mean, we've done it previously. We'll continue to do so. And, I think it's a great opportunity for everybody.
Vivek, let me come to you because there's a lot of conversation around AI and how AI could probably help tide over some of the challenges that we're currently faced with in the US. I mean, one of the reasons a lot of people attribute that the US has not gone into a recession is because of the AI-related investments running into hundreds of billions of dollars at Sarvam AI. How do you see the current developments, and do you believe that we're now going to become this sort of land of talent that we will be able to optimize as we look at an AI era?
I mean, AI as a technology, I think, is going to impact everything. And I think that, and with all these big changes, I think it is potentially an opportunity if we play our cards right. But it is something that, when you're looking at some of these sunrise technologies, we have to invest significantly to actually make ourselves a major player there. And I think that we are starting down that journey. And I think, for example, the government through the India AI mission is actually made some moves. But I think still, if you look at it, I think we have much more to do for us to become a top-level player. I think both the US and China are far ahead of us in this field today. But I think this is the time to actually take this opportunity and invest so that we are a serious player in this space. And we have the scale, we have the talent, we have everything that needs to be to actually be a serious player in AI.
So give me the specific next steps. You said we have a long distance to go before we catch up with either the US or even China. The specific next steps that you believe are warranted, both on the part of the government as well as on the part of industry.
See, I think if you look at, I think AI is an interesting technology in that it is actually very expensive when your scale is small, but it becomes cheap when the scale is large. And so therefore you have to actually create these kinds of things where the scale becomes large and the use of AI is actually happening within the country, right? For example, we have we talk about that India has one of the largest users of ChatGPT, but actually that inferencing is not happening here. And the reason they are actually able to achieve scale, and I mean they still lose significant amount of money doing this, but I think the reason they're able to do that is because they have scale, and everybody is playing the game of scale. And India is obviously one of the big scale countries, and that's really what we need to be able to do is we need to double down on this technology, and scale is something which is very important.
We saw the IT minister nudge people to say that, look, I'm moving to Zoho Work Suite now. Do you believe that a nudge is the need of the hour, or do you think more than that is the need of the hour for the government to say that, look, do Indian platforms? Is that the way forward?
No, I think that is very important. I think that's a great thing that a nudge is important, but a nudge alone is not important. Is not
enough.
Not enough. Yeah, I mean, I think, but I think the people understand that we need, if this is a sunrise technology and we want to be a serious player here, then I think the investment needs to be, and we've made a great start, but I think it needs to be an order of magnitude or more than what it is today.
Okay, Amit, let me come to you on the manufacturing side. What's now on the wish list in light of all the measures that have already been undertaken? And give me a sense of confidence at this point in time, at Zetwork, you're of course dealing with, the global challenges, the global headwinds as well, but what's the confidence, what's the mood like?
I think as people mentioned, in every crisis there is opportunity, and in fact, at least what we are seeing is the AI supply chain itself is a big opportunity set. For us, in the last year, maybe close to 5% of our revenue comes indirectly or directly from the AI supply chain, whether it's selling transformers or power equipment to data centers, to developers in the US. And at least what we have seen is that market is a little, price insensitive or different economics. Like today it takes 18 to 24 months to get a transformer built, and if you can shave that time by half, people are willing to buy. And so at least what we have seen is most of the tariffs we have been able to pass along. And if we can make that 5% into 10% or 15% of our revenue, that's where I would want to spend time versus spending
What
time.
What will take that from 5 to 10?
I think it'll happen on its own. It's the pace of investment. I mean, just yesterday we saw NVIDIA investing $100 billion into OpenAI. These are just orders of magnitude. These are numbers actually hard to fathom. Like 1 gigawatt becoming 10 gigawatt, becoming 100, becoming a trillion gigawatt of compute. I think these are things which have never been done before and have never happened. And so yeah, I mean, there is crisis, but there's opportunities.
But, you know, Vivek, and I want to quickly come back to you on that. When you hear of these numbers, you know, 100 billion of Oracle investing in NVIDIA investing in OpenAI investing back. I mean, you know, how do you react and respond when you hear the quantum of these numbers?
I think it comes back to the same thing. I think people understand that this is a generational technology. And I think that they want to make sure that they are players in this technology. And the number one thing to actually this is scale, right? And I think that's why I don't know where these things will fall out eventually, but I think that people realize that these technologies become much cheaper when you achieve scale. And that's really what people are attempting to do there. And you know, we in our country, we have scale in a different way, and we've got to leverage that and make sure that when we are using a large scale, we actually use things that you know, where things are happening in India, and then actually, you know, we'll get the same benefits of scale.
Okay, scale. Malika Srinivasan, I'm going to hop across to you. You know, since we're talking about what next now, the government is using this opportunity to unleash the next wave of reforms. We saw that happen as far as the GST is concerned. What would you put on the table as what you believe should be the next steps in that endeavor?
So I think we've seen, I'll set that against a specific context. We've seen investment in public investment grow. We've seen the public sector invest, government invest, public investments grown much faster than private investment. And that makes you think what should be done. Why is private sector not investing the way it should invest? And if you look at that, then I think it comes down to really, firstly, the ease of doing business, entry, compliance, regulations, exit, that whole space, the ease of doing business. Second, I think it reflects on cost of infrastructure. Infrastructure, our infrastructure cost, we've had Gati Shakti, we've had a whole host of developments and progress, but still we have some way to go with respect to infrastructure. And a third, maybe these are the two biggest points that I'd like to stress.
Okay, so let me then use this opportunity to again do a dipstick poll here. You know, on the back of the measures already undertaken, is there confidence in industry to start the capex cycle? Are you going to be investing in adding fresh capacity, in setting up new capacity in the next 12 months? Those of you who intend to spend money in adding capacity, if you could raise your hands in the next 12 months. Okay, so quite a few. Let me hop across to Sunita Reddy. Sunita, of course, you've got a big expansion plan as far as Apollo hospitals are concerned, but that's a sector that is, of course, poised for growth. So you feel confident of being able to spend over the next 12 to 18 months?
I'm very confident because I believe the structural demand is there, intact in the market. And with the reforms that we just heard, the budget with the lowering of taxation combined with the GST, I think there's more money in the hands of the consumer. So with the GST lowered on insurance, I'm sure access is also ensured. So yes, I think for the healthcare sector, it's been...
So what is the quantum that we can expect you to spend in the next 12 months?
12 months, I think you should look at it 36 months for a long term.
Okay, 36 months.
6,000 crores.
6,000 crores in the next 36 months for the Apollo Hospitals Group. Madhav, let me come to you. We've seen that big cut coming in as far as cement prices are concerned on the back of the GST cut from 28 down to 18. What's the sense that you're getting on in terms of demand visibility? And, you know, are we likely to see, we've seen significant consolidation in industry, are we likely to see capacity addition as well?
So, firstly, Shireen, I feel it's one of the boldest reforms that we have seen, GST 2.2, especially bringing GST in cement down from 28 to 18. It was unfortunate, it was a part of the sin goods, but I'm glad that one of the basic building materials of the nation is becoming more affordable. On the demand side, we definitely will see probably some more. It's too early to say, but demand has been good over the last couple of days since this thing has happened. And on the consolidation side, I feel consolidation, I would say, is good for any sector, provided you don't get consolidated yourself. So my limited point there is that as an industry, we are adding about 30 to 40 million tons
every year, which is about 35 to 40,000 crores of capex. And as JK Cement, so are we investing in capex.
Okay, so what would your capex number be for the next 12, 36 months? You can decide which number you want to go with.
It's about 4,500 crores for over the next 24 months.
Okay, 4,500 crores over the next 24 months. Deepak Shetty, let me come to you. The JCB has taken on a whole new meaning in this country, but nevertheless, let me ask you, sir, what is the plan as far as the capital goods sector is concerned? Infrastructure front loading, we've seen that across both the central government as well as states. What are you picking up in terms of demand?
The demand comes from two sectors. One, the central government projects, particularly driven by NHAI, but a big role is played also by the state government. So we have seen some great progress on the central government side, new projects being announced last few days by the Honorable Roads and Transport Minister. Where we are struggling a bit are the investments by the state government.
Okay.
And that is something which I'm sure with the improvement thanks to GST2, more collections, etc., particularly the rejuvenation of the rural economy, that will start improving. So that is something that we are hoping for from the construction equipment.
So is it a capital issue or is it an approval issue at the state level?
I think it's multiple. First of all is ability to invest because of, sometimes the priorities change. There are different priorities that state governments deal with. And also the whole approval cycle, which certainly needs to be improved. But at a national level, particularly NHI and other projects, I think the progress is good. But we expect that coming year, and we recently had interaction with the minister where he also spoke about further investing on infrastructure, particularly the road projects.
Okay.
That should be very positive.
So, in light of what you're seeing at this point in time, CapEx plans for you?
Yeah, absolutely. At JCB, we have continued to invest. Even during COVID times, we built a new factory. And we are not only looking at the business in India, we are exporting to 135 countries, so we are looking at the global market. And we'll continue to invest as we are doing both, not only in capacity, capability, but also in R&D.
But do you feel the need to add capacity at this point?
Probably in the next 36 months' time, not immediately.
and welcome to Startup Street. I'm Shruti Mishra, and with me is Arundhati Ramanan. These are the top headlines from the startup space. Walmart-owned PhonePe files draft papers to go public through the confidential route. Plans to raise 12,000 crore rupees, according to sources. Existing investors, Walmart, Tiger Global and Microsoft, likely to sell about 10% equity.
Swiggy exits Rapido by selling its 12% stake to Prosus and Westbridge Capital for nearly 2,400 crore rupees. Swiggy will also transfer Instamart to a wholly owned subsidiary in a slump sale to open up fresh options to raise funds.
Ulka, an agentic AI credit management platform, has raised $7 million in seed funding. Round was led by Lightspeed India and Z47 with participation from 8i Ventures and angel investors. Ulka claims to have already processed over 100 crores in credit repayments and is on track to cross $1 million in ARR.
Gulak, a goal savings app, has raised $7.5 million in a Series A funding round led by Chirate Ventures and others. Funds will be utilized for brand building, expansion into Tier 2, Tier 3 markets, and deep jeweler partnerships to co-create innovative solutions.
After agreeing to a $100 billion investment from chipmaker NVIDIA, OpenAI has inked deals with 2 other tech giants to build 5 new data centers across the United States. It would work with SoftBank and Oracle to build computing facilities. OpenAI said that it now had agreements in place to build more than $400 billion in data center infrastructure.
Those were the headlines that we're tracking for you from the startup world, but let's go across to the big story that we're tracking today. Walmart-backed PhonePe has set its eyes on going public. The payment aggregator has told CNBC TV18 that they have filed IPO papers via the confidential route with SEBI, BSE and NSE. Ritu Singh joins us now with more details. Ritu, what are your sources telling you?
Well, Walmart-backed PhonePe has filed draft papers with SEBI for a mega IPO through the confidential pre-filing route. Now, the IPO, of course, has been in the works ever since PhonePe shifted its base from Singapore to India back in December of 2022. It later confirmed its IPO plans in February of this year, and now sources are telling us the company is looking to raise nearly 12,000 crore rupees, that's $1.35 billion, through an offer for sale in this IPO. Now, Walmart, which owns about 84% stake in the company, along with Tiger Global and Microsoft, are the 3 shareholders that will participate in the OFS, which will involve a combined dilution of around 10% stake. Now, PhonePe launched its digital payment app in 2016, and since then it has expanded into financial services and even consumer tech. It recently received RBI's final nod to operate as an online payment aggregator and remains a clear market leader in UPI payments. But on the numbers front, while losses are narrowing, PhonePe is not profitable yet. For FY25, revenues jumped more than 40% to about 7,100 crore rupees, while net losses came down by 13% to about 1,727 crore rupees. But this is shaping up to be one of the most closely watched listings in India's fintech space, simply because of the company's sheer scale. PhonePe was, remember, last valued at around $12 billion in the private funding round, and reports suggest it could now be eyeing a $15 billion valuation when it hits the public markets.
Well, thank you, Ritu, for those details. Moving on, and also on what's brewing, UK-based business management platform Tide has secured $120 million in a strategic investment led by TPG, valuing the company at $1.5 billion. Now, the fresh capital will fuel Tide's international expansion, accelerate product innovation, and deepen its push into agentic AI. India has emerged as Tide's fastest growing market, with over 800,000 SMEs onboarded in just 2.5 years. To talk to us about Tide's next phase of growth and its global ambitions, joining me now is its CEO, Oliver Prill. Oliver, welcome to Startup Street. Tide has secured $120 million from TPG, like I mentioned, at a valuation of $1.5 billion. Tell us, what does this fresh capital mean for you at this stage of growth? TPG has invested through the RISE funds, which focuses on impact. So how does Tide's model and mission align with the thesis on financial inclusion?
Absolutely. So Tide is, as you say, the leading business management platform, and we really focus on small entrepreneurs and enabling them on their finance and admin. And I think the RISE Fund was particularly attracted that is really helping financial inclusion and, building economic prosperity. And you mentioned India, and India is now not only our fastest growing, but in terms of members, actually our largest market.
All right, Oliver, picking up from what you just said, India has become Tide's fastest growing, largest market with more than 800,000 SMEs onboarded in just 2.5 years. What's driving this adoption, Oliver, and how critical is India to Tide's global strategy? Also, what does the next phase of Tide's India journey look like? Are we going to see newer products tailored for this market?
Yeah, so I think that the key thing is we actually estimate that India has 130 million MSMEs, so there's a large part in the informal sector. And what Tide really supports is the formalization of this. And, you know, the UPI, the GST, you know, ADM, and various other things that, you know, the Indian government is doing is leading to this enormous adoption of, formalized financial services by micro SMEs. And Tide is benefiting from that and in many ways facilitating that and hopefully making its contribution to the Indian economy.
So, Oliver, if you could elaborate on the newer products that you're tailoring for the Indian market especially.
Yeah, so, you know, we have a current account and a card, and you can already do invoicing, bill pay. And so we're going to massively expand that into acquiring. So we already allow merchants to accept UPI payments. So we're going to introduce POS devices, savings. We already are one of the larger credit intermediaries in the UK. We have launched that proposition in India. And so credit is very high on the agenda as well in terms of our rollout in India.
Okay. Now, beyond India and the UK, Tide has entered Germany and most recently France. What are the learnings from your mature markets that you're taking into these newer markets? And Oliver, what kind of impact are you hoping to create in these new markets?
So the key learning for us is to work off one global tech platform. So you mentioned this earlier, and you said about the other tech players. We are really working off the same platform, and so the functionality we have in the UK, we can rapidly deploy in other markets. We're working through adapters, so with minimal adaptation. So that's how we've been very able to very quickly roll things out in India, and that's why we're rolling out things fastly and quickly in France and Germany. The lesson learned from India is really, and to extend France and Germany, is that SMEs everywhere have the same problem. They're really underserved by the banks. The owner managers really want to get on with running their business, and so they need minimum involvement in finance and admin. And that's what we are here to do, right? We're really there to help them with their finance and admin so their businesses can thrive.
Sure. You know, Oliver, Tide's mission has been to save SMEs time and money by solving business management tasks end to end. So take us through your tech edge. What kind of efficiencies are we talking about? And what's next on the product roadmap?
Yeah, exactly. So small businesses really have jobs to be done, right? And so think about it. I write an invoice as a small SME. I then want to factor the invoice. I need to control the current account to see whether the money was paid, whether we need to automatically chase it, put all of that into your accounting system. So that's what Tide does, right? It makes everything work seamlessly together and therefore saves time. And so we think the time saving, is something like, 2/3 of the time that it would take to do this manually. So there's an enormous time-saving element that then business owners, and that's typically what our customers are, can actually use to actually go and help build out their business as opposed to spending it on useless finance and admin.
All right. But what's next on the roadmap then?
Yeah, so I can't give you the exact products, right? But you had mentioned what we're doing at pace is actually AI adoption. So a lot of the platform is already uses AI in one form or another. We're going to massively scale that up. We have a number of products that we want to launch. I can't talk about them now, but they will be accelerated through this investment. And also, thirdly, the big growth factor is internationalization. So our India business, as you reported, is growing very, very rapidly, and we want to give it all the resources we can possibly give it to make sure it continues to thrive the way we've seen it thrive over the last 2.5 years.
All right. Oliver, you spoke about accelerating growth at Tide, and you are going to accelerate Tide's investment in agentic AI. How do you see AI transforming SME-focused fintech, and what edge does Tide have here?
So the key thing, I think agentic AI, right, in many ways will make things even faster and more easy to use, right? So I don't think it fundamentally changes our strategy. We are, in the end, in finance and admin, this is not something that can be disintermediated very quickly. Quite the opposite. I think with agentic AI and this enormous pool of data that we have, we can actually accelerate the adoption of our platform. Simply put, what LLMs are very good is understanding the public, all the proprietary SME data we've got. So training generative AI models or getting them to use proprietary data and using it in our advanced processes on finance and admin is actually an ideal combination. So we want to combine that for member impact.
All right, Tide already supports 1.6 million members worldwide. Oliver, what's the long-term ambition? If you could take us through the revenue growth targets, the revenue mix you envision, and how you see the business scaling over the next few years.
So we want to be in a whole number of markets and be recognized as the global #1 in business management platforms for the small SMEs, right, that we actually serve. And so this is a big milestone in that. You talked about the 1.6 million members we've got already, out of which 800 in India. We think by year.
All right, Oliver, on that note, it's time for me to wrap up our conversation. But many thanks for joining us on Startup Street today, and wish you the very best with all your aggressive growth plans.
Thank you for your time.
All right, moving on, electronics company Incal Technologies landed an investment worth $20 million from its existing investors. The startup aims to use this fresh capital to fuel growth of its brand Wobble displays. In addition, the company will deploy funds to strengthen Incal's research and development, enhance its sales and service network. To discuss the company's growth plan and its vision for Wobble displays, we are joined by Anand Dubey, the CEO of Incal Technologies. Anand, thank you so much for joining us on Startup Street today. It's great to have you back on the show. Before we get into the rest of the fundraise, what strategic advantages does this recent $20 million Series B bridge funding provide to Incal Technologies and its brand Wobble displays?
No, my pleasure, and thank you for having me again. It's obvious. I mean, obviously, we are a product company. We rely on our capability to create better products which are tailored for the Indian market, and that's something that we've created a real emphasis in the past 5 years of our existence, and that's where I think fresh impetus is going to be put in. The new funding obviously allows us to strengthen our product development capability. Helps us take these amazing products that we're developing in display technology to different parts of the country, and then make sure that we're strengthening our after-sales service capabilities, which are obviously something that play a very large part in the trust that we're going to be able to build with our customers. And that's essentially what we're going to be using this new round of funding for.
Sure. And, how does Incal Technologies plan to sort of utilize this fresh capital in, to innovate and expand its product portfolio? What's new on the anvil, especially, in the premium television and display segment?
It's going to be important to see how the market evolves, because the television market in India has been, in general, hasn't seen a lot of growth. Which means obviously you're fighting for place in customers or consumers' homes. With a lot of different brands. And what sets us apart is our emphasis on developing larger screen size televisions. That's something which we've been working on for a long time. We've introduced larger and larger screen sizes in the past. And then developed display technologies like QLED, and then even on top of that, now a mini LED television in a large screen size television. We think the market is shifting towards more premium products. Even if the volume growth hasn't been there, we've seen the average screen size in India rapidly grow. It's now in 40s, more than 40 inches. We expect it to get closer to 60 inches eventually. That's where a lot of more developed markets are. China market is close to 60 inches in terms of the average display size that we see in a television being consumed consistently. That's where we see the shift happening, and that's why the emphasis is on developing not only large screen size televisions, but also developing display technologies which
create a better immersive experience for our customers.
Absolutely. So you are seeing this shift to a more premium segment. So in light of this, how significant is the launch of the Maximus series with the 116.5-inch TV in the context of India's consumer electronics market and display technology innovation?
Sure. It's disruptive. It's disruptive because now the screen sizes which were unheard of in the past, 116.5, 98 inches, 86 inches, which are typically not consumed in the Indian market. Our effort will be to bring them closer and closer to more accessible price points without compromising on the technology that is available. A lot of it is now being enabled because there's such emphasis from the Indian government as well to try and push for the research and development to happen here. Component manufacturing ecosystem is developing very rapidly. So next 3 to 5 years, we see that very, very quick jump from where we were, which was a very EMS assembly-based infrastructure for product development and manufacturing, to a genuine hardcore research and development-based infrastructure, which will allow us to democratize some of these very large screen sizes, which we definitely want to consume, but have been sort of out of reach in the past few years.
Absolutely. So you're calling this a disruptive move. And if you could then take us through, the kind of revenues you're currently clocking, and where do you sort of hope to end this year? Also, what's the kind of impact that you hope to see from the GST rate rationalization?
Right. We closed last year at around 850 crores of revenue. This was our third full year of business. So we've consistently seen immense growth, and we've been fortunate that way. The GST reform is massive. It is closer to 8% on larger screen sizes. And this sort of reassures what we were talking about in the earlier conversation, which is a shift towards larger screen sizes. Anything above 32 inches was at 28%, which is now at 18%. So that massive drop in prices, along with what is happening on the product manufacturing infrastructure setup that we have, both for the finished goods and component level manufacturing, this will spur up the demand. And we've seen a lot of latency in the past 3 years in the television market, where the volumes haven't increased much. That is probably attributed to the fact that the screen sizes were expensive, and most households were still consuming only one television in general, and max 2. I think that is going to change rapidly, and now we're going to see larger screen sizes being adopted because of the price drop, and the number of screens per household increase rapidly in the next 24 to 36 months, which will give even more motivation to companies like us to come in and try and develop better products, bigger products at better price points for the India market.
Sure. And, if you could quickly tell us in 30 seconds, what challenges does Incul foresee in scaling up its premium product offerings and expanding its sales and service network across India?
I think the challenge will be, obviously, we're new to the market, and this is something we will have to demonstrate on how much progress we've made and how far we are in terms of our product development and quality infrastructure that we've built. We've seen our portfolio in televisions. We're among the top 5 players now in the country in terms of volume across all our brands. The hope is to obviously get into top 3, and then for that we will have to continuously demonstrate that not just the product but also the service infrastructure is developing rapidly, and customers even in deeper pockets of the country can look at Wobble as a viable option for their television consumption needs. I think it's a slow process. It's something that we obviously have to keep on reinforcing through high quality products and great service. So more than challenge, I think we see it as an opportunity to continuously keep doing this over a longer period of time, something that we've done in the last 4 years. We have to keep on doing this over 1 decade for us to be able to get that position.
Also, this $20 million is part of a bridge round, right? So you're also looking to raise a further $80 million. Can you sort of elaborate on the fundraising plans and when you hope to close this larger round?
So I think it's still, because we're still closing the bridge round, we will start taking in the process. We will start the process of building the larger round. The hope is to finish it off by the end of this financial year. So March is when we're hoping to finish off the larger round. I think a lot of things depend upon what happens between now and towards the end of the year. Obviously, with the GST reform, there's a lot of optimism in terms of the growth of business. Obviously, we're also trying to reassess and try and see where we can get after this massive opportunity has been created. Financial year end looks like a good timeline for us to think about the larger round being completed.
So you're looking at the financial year end to see the larger round close. All right, Anand, thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thanks for having me.
Well, with that, it's time for us to head into a short break. But coming up, fintech startup Ulka adds $7 million to its kitty. How does it plan to use the funds? We find out on the other side.
Bengaluru-based fintech startup Ulka has raised $7 million in a seed round to scale what it calls India's first agentic AI credit management platform. The funding, led by Lightspeed India and Z47, with participation from 8i Ventures and other angel investors, will help the company scale engineering, data science and product teams while accelerating the rollout of advanced AI features. Founded in 2024, Ulka has already processed over 100 crores in repayments and onboarded nearly 2 million users. For more on this, joining me now is Utkrishta Kumar, the founder of Ulka. Utkrishta, thanks so much for joining us here. Start by telling us the gap you saw in the credit ecosystem which led you to build Ulka, and you call it an agentic AI credit companion. How does it go beyond traditional credit tracking apps, and what makes it agentic rather than just analytical?
So Ulka was founded on a simple belief that every Indian should have an access to better and more affordable credit. What we are seeing right now is some sort of an explosion in people's credit awareness in India. So their awareness of not just credit score, but their intent to get a more affordable credit is through the roof. And if we look at recent data from credit bureaus, the number of users who are checking their credit scores are actively working towards it, is on a J-shaped curve. So Ulka is a means to help that pursuit of our users. We are here to democratize the entire process of accessing better credit and improving financial health. And there we are leveraging the power of AI, power of agentic AI. So what we are trying to do and what we are already doing is our ability to provide a tailor-made solution, a tailor-made response to a user depending on their specific queries, depending on their specific financial health.
Well, with this $7 million round, what are the immediate priorities for deployment, and what will success look like in 12 to 18 months from now?
So the funding that we have raised will be used in scaling up our engineering, our product, our AI teams. Building AI is expensive, and our ability to work with multiple LLMs, orchestrate that framework, and have a stellar team power it will be our number one